Well, good morning, everyone. How you guys doing this morning? Hopefully everyone's doing well, and I take it we got sound. We get a couple replies here. Good to hear. Well, we'll go ahead and get started here. I was going to jump right into a topic, but I'm going to just address one question real quickly. The person who asked about it is here, and we're still missing a few people this morning, so I'll just answer a question real quickly, and then we'll get into our presentation. Let me just get a chart up here. The question that I was asked was again about what I was using to measure the moves the other day when I was showing you guys where it measured the time and the point value. And that is on version 7. So I believe you're using version 6.5, Jim. So on version 7, you'll notice in your drop-down menu that it does have a ruler. And there was something else I wanted to highlight about this because it is a handy tool. If you take that ruler, and let's just say that we're watching price as it comes up into this high, we've got an idea of what the acceleration or what the momentum was when it came up into this high. But of course, as time goes by, we can lose that perspective, or that time can change. So in looking at that, simply the way this is going to work to be accurate with it is you've got to start it at the low of the candle that you want to start measuring from, and then you're going to measure to the high of the move, and then put a second click, and then you're going to drag that over, and it will show you that that was only 16 seconds, that little final push up, 16 seconds that took it up 9 points. As we start stepping sideways through this chart, and let's just expand this out a little bit, and we see price move back up into that. Obviously this had further to go, it's not really comparable, but we again come up and see a final thrust after a pullback, and we notice as that pulls back, we come back into the same level. So we can take that tool and draw again real quickly from where this move started to move up, which was this candle here, up into this high, and we can again get an idea of what kind of time was going by here on it. 10 seconds, 11 ticks, very quick move up. One thing that I was going to mention to you guys is you can take this and highlight that and hit Control C, Control V, and you can make a duplicate of that you could then drag around to the low and say if that continues at that rate, you would expect that move essentially to take about the same amount of time. And you notice what happens is it didn't have the same acceleration. It didn't take the same amount of time to get back up there. And when you come over and measure that, from the time that came to this level, and this one, I think something got messed up on it. Let me just get these out of the way here so they're not on top of each other. That's showing 34 seconds to the rollover. However it's measuring it, I guess that's the time it's measuring. 43 seconds for the total move versus 3 minutes and 18 seconds for a subsequent move the same size. So that feature is not going to be available on your platform, Jim, until you upgrade to version 7. But it is handy because you can come back in and you can draw these and drag them around, and if you're wondering about it, copy it and paste it, have another one ready to go. If price moves back down and starts up, start timing it and see, does that meet your expectations? If it does the same thing as the last rally, it should arrive up here in about 3 minutes, give or take. And if you see that slow down or speed up significantly, it tells you there's some additional acceleration there. So hopefully that addresses that. If anybody else has questions on that, just let me know. I wanted to just address the question real quick. A few of you have showed up here as I was talking, and I just wanted to make sure that everybody was in here. But just a quick question on that. Okay, so for today, day 7, a couple things that I wanted to do. We had some topic yesterday that we didn't get covered, and so I do want to go through that, make sure that information gets covered. Standard disclaimer again, we're going to be talking about some trades in a hypothetical sense today, as we have been the last few days. Of course, the risk, we always know there's a risk there. So a couple things that I wanted to address today. Pete had asked yesterday one of the questions. I guess he didn't ask it yesterday, but he had asked over the last couple of days about the failure patterns. And so I'm going to go through that again real quickly, because sometimes you can use those patterns on a 2-minute or a 3-minute chart to pick up continuation moves, or you could pick up reversals depending on what happens. But you can kind of use that to spot areas where people get trapped. I'm going to go through just a quick trade setup. I apologize yesterday. I got the video out kind of late yesterday, and I took some additional information and put in there. So if you didn't watch the video that I sent yesterday, there is a recorded trade at the end of that. And I went through some of the trades that I had already recorded and trimmed down and edited with all the dead stuff out of it. And there's a few of the trades that were very beneficial for what we're talking about, so I just put that on the end of the trade, the end of the tape. And then there will be another one tonight, another one tomorrow night, and so on, that will have a pre-recorded trade on there, so you guys can see these concepts we've been talking about. If you watched that trade, you'll notice that there was an RSI on there, and at the time I taped that trade, I was working with a couple of clients on this specific setup, and that's why that RSI is on the chart. And then we're going to talk about the trade management. Karen, with your question before we go on, the Y value is the price move. It'll show you the number of bars, but the Y value, yes, that is the number of ticks or points that it moved up. So depending on what it is, you'll see that as ticks on the YM. That's points, obviously. So okay, so let's take a look first at the failure patterns, and I'll go through what I was talking about with that. I do have a video that deals at that with a little more detail, but it was essentially a way of coming in and looking at a market to try to find areas where people were likely to get trapped, where people were likely to initiate trades, and then being able to take advantage of that. So I'm going to just put up a 2-minute chart here, and you could do the same thing on a 3-minute or a 5-minute chart. You'll get more setups on a 2-minute. The ones on the 5-minute will typically be bigger moves. So it kind of depends on what you're looking at. Two things that you can do with this setup, Pete, that I have used and that have worked pretty well with me over the years. You can do this just on the price action alone without anything else being here, or you can do this using a moving average. And if you're going to use a moving average, I would put an SMA, a simple moving average, put a 20 period on there. And the reason that I have always suggested a 20 period simple moving average is that over the years there have been many thousands of traders told that is the best moving average to use. Lately, over the last few years, you see guys talking about a 13, you see guys talking about a 21, but there is an entire generation of swing traders and intraday traders who were taught that the 20 period simple moving average was by far the best one to use. So many people have been taught that still, by most technical analysts, is one of the most commonly used moving averages. They'll use a 20, they'll use a 50, a 100, a 200. They'll use some very common moving averages. But on the short-term basis, the 20 period tracks the oscillations pretty well. So we're going to look at this both from the standpoint of using a moving average and not using a moving average. And we're going to just come back to this point in time right here, just from this morning's session. And you'll see this type of stuff print off every day. If we compress this down, you can see that we're up against a high, and that high has been in place. We've been butting up against it over the last few days several times, that we've been trying to work up into this area. But for any price action trader, if you're going off the right edge of your chart, what would you be thinking? You're up against resistance, you're extended, you got a doji at the top, you got topping tails, and now you've turned around, you put in this big red candle that traded lower and closed lower than the prior candle. And in those scenarios, exactly, going to reverse. So if that's the case, then where are the stops? Remember, we've talked about it earlier this week. Majority of people in the S&P 5 or 6 tick stops is about all they can handle before they they get nervous and bail out. So if that's the case, we're going to look at the potential entry as people saw this moving to the downside. If they're getting short at 22.50, 22 quarters, 22 even, they're at their threshold just over this high. They may feel in this case they have to give it a little bit more room. If they're getting 22 quarters, they're going to look at it and say, 22 3/4 is just going to put them right into the high. So they may say, well, I'm going to have to give it 8 ticks or 10 ticks this time. So normally in that kind of a situation, you would anticipate that there's going to be a stop somewhere 2 to 3 ticks above that high. That would be 1 tick, or we could come up there 2 ticks. But just within a couple ticks of that high, there should be stops. Now the question, as we see the trade develop, is how many people actually come in here and get short. So if we look at that candle, the negative candle, which when we see a negative red candle like that, if you're watching the tape on that candle, you're going to see the delta go negative. If you're watching, the number of trades here, you have to say the majority of those prints coming in were going to be market sell orders, and you've got around 8,000 contracts there. So if that's the case, we could come in and say a break of this high is going to have each of these people scared and feeling trapped, as you would no doubt if you were in the trade. It's looking like you've got a nice target. You're looking down here to the 19s, decent risk reward on it, and all of a sudden it's coming back against you. But it's going to be a break of that high that's really going to put the pressure on these guys and make them bail out. Marty, with your question, you say when you're referring to the stops being 4 to 6 ticks, are you including only the small traders or everyone like the HFTs? That is what I've asked several brokers about it over the years, what they see their customers using for stops, and they're referring to your average trader who has a little account somewhere between $3,000 and $10,000 at the brokerage. 4 to 6 ticks on the ES is about all they can take. They said they do see guys that are using 3 points and 5 points. If they're swing trading, they're doing something a little bigger. But for their intraday traders, their active traders, 4 to 6 ticks, and they're saying 6 ticks is pretty common. But that's about all they can take. The HFTs, you don't see them stop out as much. Difficult to tell what they're doing when that goes. Anyhow, so as we step forward in this, if we were looking at this as a failure, there is a basis to view this as a short, and you have to say there's a valid basis to see this. It's up against resistance. You're turning a negative candle pattern here, and then as it moves down, you have to say, did it get far enough? And this is something I always try to look at. Did it get far enough to get them to cover? If you went short at 22.50 and you've only moved down to 21 3/4, you've only moved 3 ticks, would you have taken your position off yet? And I think where I approach this from, Pete, when I look at this, I think of a 2-minute trader. This is probably not a scalper who's going to be in and out for 1 or 2 ticks. Most scalpers are going to be very, very short term on their charts. They're not going to be looking at 10 minutes. I'm sorry, at 2-minute charts or 5-minute candlesticks. If they're just trying to get 1 or 2 ticks, they're likely drilled down inside of that, looking at the little wiggles on a tick chart. That would be more common. Karen, your question, aren't the HFTs the ones who take advantage of these stops? Yes, increasingly they're the ones who try to just poke it through the stops. It actually used to be something that happened on a fairly manual basis, where a large trader would come in, and I've seen traders do this in person after years of watching it on the time and sales. And they would look for a scenario like this, and they realized that they could push the market short term 10, 15, 20 minutes. They knew they couldn't run it for a morning. They knew they couldn't run it for a day, but they knew they could push it for 10 or 15 minutes. And manually, to get people to do this, they would come in on the dome, and let me just find the dome over here somewhere. They would come in on the dome and they would stack this dome real thick. If they were in a scenario like this, they would stack it real thick up through here with big offers. And you would come into a level and see this go from 1,000 at each level to 2,500, 3,000 at each level. And when you think about what this is doing in people's minds, if you're looking for some kind of confirmation and if you're watching your dome, what does that tell you? You know, for the way that most people think. If they look over here on the offer and they see that there's, let's say that they see there's 15, 16,000, and you don't see that as much as you used to. But let's say there's 15, 16,000 right here, and you look over here and there's only 6,000. What would most people look at there? Right, Jim, supply and demand. And they're looking at this saying, here's the supply, there's a ton of supply over here and there's not very much demand over here. So, right, Karen, they're trying to trick you into saying there's sellers coming into this, there's resistance here, and it's turning now. So if you're going to get in on the S&P and there's 3,000 lots sitting here, do you have even a remote expectation of getting filled with a limit order? You're going to come in behind all 3,000 lots, and you have to have 3,000 print off at the market at 18 quarters. You're going to look at that and say it ain't going to happen. I will not get filled there, and this is going to roll over now. So guys will say, step in front of that and just hit the offer. So what these traders used to do, they would come over here and they would put an iceberg order to buy. They would put big, huge size over here on the offer, which they would pull away immediately if they started getting hit or if it started moving up prematurely. They would immediately just pull those orders back up. And then they would allow everyone to step in and sell to them, and they would just keep refreshing. And very quickly, in the course of 3 to 5 minutes, they could build a 15,000 lot position. So they build this position, get the long position, and then they would disappear. These orders would just disappear, and all of a sudden you go from 15,000 down to 7 or 8,000. All the size flips over here onto this side, onto the bid, and they start throwing buy market orders at the remaining offer. Now what they've already done is they've got their take profit orders already sitting up here where the stops are. So all they have to do is come in at that point, goose it, get people backing up, get people nervous. They get nervous Nellies starting to cover, that cascades, and the next thing you go right through the stops, hit the stops, and as they hit those stops, that's what takes them out of their position. So basically they've tricked you into taking a position. When they do this, they know where your stop is, 6, 7 ticks away. You see a big, exactly, Karen, you see that big flurry on the tape at the high of the day. It blurs through, gets 3, 4 tick new high, cleans those stops out. That allows this guy to go flat, and he disappears and is done. Now, I watched this for many years, and I came to the conclusion that this is what was going on. And after seeing this for years, I had the opportunity to go trade with a trader in Aspen, who was a multi-billionaire who sits up there and trades. And as I watched what he was doing, it was like, this is one of the guys that I've been watching. And everything at that point, this was about, I guess this was about 2 years ago, 2.5 years ago. He was doing every bit of it manually. He had 3 women executing orders for him, and he was doing every bit of it manually. And what he was doing, and I told him, I said, can I tell you what I think they're doing? Because I couldn't see what they were doing on their orders. And he says, yeah, I'd like to know what you think. And I told him, I said, they've got a big offer stacked up over here. They've got an iceberg order sitting there on the bid buying. They're making it look very heavy, and they're going to pull that offer, flip it onto the bid, or at least pull it, and then they're going to sweep it and take it up 2-3 levels and punch right into those stops. And he just looks at me and smiles, and he says, "You're very shrewd." And over the course of sitting there with him during that session, that's what he would tell them. He would just ask them, he's like, accumulate a position in the S&P. And he had one lady that was trading that, and he would tell them, "Get me 20,000 lots." So they would sit there and talk about it, and he kept on asking them, "Are we filled? Are we filled?" He had the little, I can't do an English accent. We should have Pete do the voice work for us here. But he kept on asking, "Are we filled? Are we filled?" And they'd say, "We've got 6,000. We've got 8,000." And then he's like, "Okay, take it up a level. Sweep 2 levels. Sweep 2 levels and offer out." And it was all manual. Well, what's happened over the last couple of years is the bots for doing this have become so fast that I honestly think guys that were doing it manual probably had to go to the bots in order to compete, in order to keep up. But when you think about the HFTs and what they're doing, remember, some of those strategies are pattern recognition strategies, where they're looking for specific patterns and then they're trying to take advantage of those patterns. And some of those HFTs are running off of order flow. And if they can look at the order flow and see people going short on the order flow, they have the money backing them to run over the top of them. So, you will still see that to a degree. You will still see that thicken up and look heavy. But I do think in some ways it's changed a little bit from what it used to be, where now we have to pay attention. If you look at that pattern and you're watching people get short, if you see buying come back into that aggressively, there's a good chance that that's an HFT that's going to run it 6-8 ticks, run it through the stops. So, Karen, you ask, where would you enter since it happens so fast? There's a couple things that you can do for entering in a situation like this. If you were going to do it just off of price action, what would be the sign that they're in trouble? And that would be, to my way of thinking, at some point, if they had enough buyers come back into this to get it above a prior candle. So if you recognize it and you see it working, I would say here's your best strategy. If we had to lay out 3 strategies, the best strategy on this would be watching your tape, and you're seeing what's happening. You're seeing all these sell orders come in, and you're saying, what are these sell orders? Are these sell orders primarily 1s and 2s? Is it giving the appearance of bot orders, which is actually the execution engine, which could be big market orders? Or is this big orders coming in here? So if you look at this and you see it's primarily 1s and 2s, you're trying to get an idea, and it can be difficult, but you can get a rough guess looking at it. You start watching the amount of size that comes in on your time and sales at the bid price. And this would be market sell orders, but you compare that to the size of the bid. And if you watch screen after screen after screen after screen of time and sales flooding by, or if you've written something to track those, like your delta is not going to give you a complete count of the total volume coming in. But as you watch that coming in and hitting the bid, you're saying, okay, wait a minute. The bid, yeah, Karen, I do have, it's actually, you already have it on that original tape reading video. There's a number of examples of this happening. There's a number of trades with this happening where I go through that on that original video. So I can put one, I can just excerpt one out of there and put it on here if you guys want to see it. That's not a problem. I can take a clip and just produce that out of the original video and put that in here. Let me just write myself a note, and I'll just put that in tonight's video. The strategy, though, what I was getting to here is you're comparing the amount of volume that's coming in, hitting the bid with what the bid is. So let's imagine that we look on our dome and we see at the best bid 300 lots. But we watch screen after screen after screen after screen after screen print hitting that 300 lot bid, and the 300 lot bid is still there. See, what does that tell you at that point? Iceberg, exactly, Karen. They're taking an order, whether they're using an iceberg off of Xtrader, which is how it used to be done, or CQG, or they're doing it with a bot. Either way, it's the same thing. It's an iceberg order where their position size may be 10, 12, 15,000, 20,000 lots, but they tell it only display 200. So if that's the case, and we see them accumulating that right there, is that not the safest entry, while at the same time the riskiest entry? Here's why I say that. It's safe from the standpoint that you're getting a good price level, and you don't have to have much of a stop to be proven wrong. But it's risky because you're doing it without much confirmation. I've always said it's a double-edged sword, and you have to decide which side you want to be cut with. Personally, I prefer to see them accumulating it and go in with them down here. But that would be, to me, the safest strategy, because then I could give it 4 ticks or 5 ticks, and if this guy isn't able to hold it, I'm out, and I didn't have to lose a lot of money. If I wait all the way until up here, I may need to give it 8 or 9 ticks, just in case it goes into a sideways range. So that would be the first way of dealing with a scenario like this, would be to take it on the basis of the tape as it pulls back, if we see that type of behavior. Now I'm going to get into 2 other ways of going about it, but I'm going to reset the tape. It seems like, as I've been doing this the last few days, the first tape of the morning is the one that causes the problems, and once that's loaded into Camtasia Editor, the others, even the 42, 45-minute ones, haven't had the problem. So I'm going to reset, be back in 3 minutes. Okay, so we got that saved and going again. Karen, you made a comment here. She says when you're at a high and it seems to sit up there for a while and you see it move up and down a few ticks, is that the people accumulating? Not all the time. I would say it's more common when you see a pattern that convinces people that something is about to happen. It could just be basing at a high, just going sideways. Does that mean that there are people accumulating? It's tough to say. Some people could be selling and closing their positions, which they bought lower. Some people could be initiating new shorts. Some people could be accumulating up there. But specifically what we're referring to would be like the candlestick patterns that indicate a reversal is there, where I've seen that happen most commonly would be at support and resistance levels. Get a candlestick pattern that everybody's taught to look for, like dojis, engulfing bars, and so forth, and you witness the selling come onto it, and then it's just grabbed and they run it right backwards over everybody. So not so much necessarily where you're just up at the top going sideways in a consolidation. Doesn't mean that somebody won't play games up there. Karen, just on that note, before I get back to this, remember the other day you asked about the 5-minute chart with the consolidation, and I told you what I see frequently is it starts to break down out of a consolidation and then blows up through the high, or it starts to rally and then it just blows down through the low and heads for the low of day. And I do think that is, some large traders manipulating that. They're trying to move it one direction. Even if they move it at a loss, they'll move it one direction just to get people on board, just so they've got stops on the other side, and then they'll reverse it and blow it backwards over everybody. So I always watch for that. I'm always leery of the S&P, especially coming out of a consolidation, because of that frequent head fake and then going the other direction. Let's get back to the failure setups here. We're talking about entry number 1, which would be off of the tape, and that entry being at the best price point, but with the least confirmation. So that entry could be the most difficult to take advantage of. Number two would be to say, take a little line here, mark off the next candle. Initially, we were looking at this as the seller candle, and the stop's up here. Let's just draw that in. We know our stops are up in here, but if we have this candle close, realistically, if we trade over that, again, these guys know they're in trouble. So an entry number two would be watching for these guys here, that are going to really panic when you get over that high, and you go over that high, and you can do that with a stop entry order if you want to. You can just drag your stop entry order down, put it a tick over that candle. If it goes above it, now you know you've got your position. Here's the downside to that. If you take that type of an entry, let's just use this as our hypothetical, you're getting an entry on this right dead in the middle of that range. You're getting an entry, a tick above the middle of the range right here. So if that's the case, now you've created a situation where you need a larger stop to protect yourself to the downside. And now to get a target to the upside, you have to get through that high. So while it can still be a valid entry, you're going to have to look at that carefully and say, how far is it? Now again, remember we had this set up, and let me just change the parameters on this. If we take our entry and we're one tick above this at 23, and we've got our stop, let's say we've got to get a tick below that for a stop. See, we now look at this and say we have to get clear up to 24.5 to get a 1-to-1 risk reward. And that's where that gets dangerous. By the same token, if I was able to come in down here when I saw the buyers, I don't even have to get to the high to get a 1-to-1 risk reward. So that can be pretty beneficial for me by being a little more courageous there. Where that becomes especially juicy is if I know that I'm able to hold on to that and get through the high and take it out up here, all of a sudden I might be at a 3 or 4-to-1 instead of a 1-to-1. So that would be entry number two, was just waiting for it to trade off above a candle. And then I would say that number three would be waiting for the original selling candle. And that to me is the most risky, even though you've got the most confirmation. Because now you'd have to give it a couple points realistically in case this started going sideways. And there's probably not a chance that you're going to break through here to a new high and get 2 points or 3 points on the first thrust. Some guys that like the other side of that equation, that like the breakout or the momentum side of that, would actually come in here and put their buy order into the stops. But where, to me, that becomes dangerous is frequently there aren't enough stops to take it up another 2 points. If you've only got enough stops there to take it up 4 or 5 ticks, you just bought a rollover. And so you have to be very familiar with the market. I look at the S&P and say the S&P is a fading market. In other words, when you get new highs, it's more likely to see it faded than it is to see it bought and break out and run forever. So if that's the case, you have to be cautious with your market. If you look at that on crude and say a breakout on crude, it can flat out run. Breakout on the 6E can run. You may take that differently depending on the instrument you're trading. The thing that I see frequently, you come through there, and did you get a whole lot out of it? Well, you got another 6 ticks through that high, and then you see the sellers actually come in and hit it and drop it. So I've always said, if you've got the failure pattern, if you can see it on the tape, it gives you the biggest reward with the least risk. And if you can't, if you take it on the basis of the candle, could you have pulled off your 1-to-1? If you took it a tick over this high and you put your stop a tick under that. Let me just change the template back on this. And you have to say, yes, you were able to get to your 1-to-1, had a tick through it to spare, and you would have been fine. But you would have been in a lot better shape, getting that thing down here at 22 and bailing out at 24 quarter as it's printing through that high. If you happen to miss all of that, to me, it's something that I would watch for at any point. Would be a break through a high, and you see sellers coming back into that, and if you realize what just happened here, that you just got some stops and there wasn't a whole lot there, and it started being sold right away, to me, I would just flip and say, okay, instead of looking at it as trapping these guys, I'm going to go ahead and just reverse it up here. I missed that trade. I'm going to reverse my mentality, and I'm going to view this as a fade. They got through. It didn't blow up to 27s. Let's just, if we see sellers, let's short it up in here, head back for the low of day. But that's kind of the basics, Pete, and I don't know if that covers your question as in depth as you would like. If you're still awake, you're getting close to 1 a.m. over there. So the only thing that would change with that, with a moving average, if you take your 20 period SMA and put that in there, that would be the situations where you're taking, instead of just taking this up at a high, or taking this, like say at support or resistance, or your value area high or low, or point of control. If you were taking this at one of these other areas, you may not want the moving average, may not need the moving average. But if you're using the moving average, this would be the scenario where you come in, where you reverse lower and then immediately pop through and trade back higher. And once you've traded 3-4 candles away, you never really traded lower sufficiently enough to get people into it. You have to look at the pattern and say, does that pattern really make me want to go short right here? And you're going to apply those same steps. Either look at it on the tape, you're going to look at it on basically the candlestick pattern itself, or you're going to try to pick it up late. So that's the only difference in doing this when you come into the moving average. You start making some lower highs right in here, and you see a big red candle, looks like sellers. Remember, at some point this candle was red all the way down to 19.5, and I would say it was red all the way down to 19.5 before it was green. The moving average is sloping down. You've hit it, you've rolled. You've got 2 candles worth of sellers in there. You've got 14,000 lots go off. If you trade higher, or you see the buyers on the tape, can you take a chance here to exploit them? Take a move back to the upside. If you got it fast, you might be able to. It's a fairly tight range there, but that's kind of the mentality with it. You're looking for areas where people have a compelling reason to take a trade one way or the other. I personally think the most dangerous thing with doing this, by the way, on a moving average, is observing the price starting to go sideways. And if the price is going sideways and you're trying to fiddle around with this on a moving average, it's a good place to get destroyed. It's definitely better when you get out far away from it and rally back into it than it is when you're up tight just kind of cruising along it. Pete, Karen said, thanks for asking the question. She appreciated that comment. So, but anyhow, that's what I was referring to when I was talking about the failure setups. It's just looking for candle patterns, and you don't have to have anything specific. You could come in at times. Let me rescale this. You could come in at times and see this. You may be looking at it on a 5-minute chart. Take this moving average off of there. You may not be at support or resistance, but you may just look at a move, and let me just see if I can find a quick example of it. You may just look at a move that looks like it's gotten up and gotten extended. I don't want something in the middle of the night where there's no volume, but well, I don't know what this thing is doing. Let me just change the templates on here. I was going to say somehow I've got some goofy stuff printing off on here. But you may just take an extended move and it may not be at support or resistance, but you may see a candlestick pattern, that convinces you that that the thing is over, and it may not be over. You get your topping tails up in there. You're not really at support or resistance number, but you see sellers come onto it, and then immediately they pop it higher, take it up another 1.5. It's just areas to be looking for tape, and another way of approaching it. If that answers everything there, let's see a couple other things. I touched briefly on tracking the manipulators using the DOM and the time and sales. I don't know if the example that I gave there was sufficient, or does anybody still have questions about that? Because I can go through that a little more in depth here. If anybody has any questions about it, give me a Y, and then I'll wait a minute and you can put your question out. Go ahead and I'll just wait for you. Go ahead and put your question out there then. Okay, so your question, Karen, it's actually a good question. I'm glad you asked this. You said, how much do you look at the large number sitting on the DOM or the level 2, and how would you evaluate those? I would say that the answer to that is going to depend almost entirely on the market I'm trading. And you have to pay attention to the market you're trading. Let me just give you an example of why that's the case. Give me just a moment to get a level 2 open here. I don't know if you guys have used the level 2s or not. They show you 10 levels. If you're on some platforms will show you. But we're already rolling into the January contract, and I don't have that added. Let me bear with me for 1 minute. I'm going to just pause the recording here and get this set up. It may just be that thin, but it looks too thin to be the active contract, and we're getting to that point. It's probably all rolled into January. Yeah, I was hoping we'd see something. You see this on Beans all the time. So remember, here's the question. How do you look at a large number sitting on a DOM or a level 2, and how would you evaluate that? I'm going to take a DOM, and if I can get it in here quick enough, and we're going to just use this and get rid of the other stuff for just a minute. There's a lesson here that I want to point out that you don't get to see all the time. Got a level 2. This is January beans, January soybeans. And the reason I'm going through this, and I'm going to freeze this just in case it changes while I talk. Reason I'm going through this in addressing Karen's question is that when you see large numbers out there, to try to understand what it means, you have to understand what's going on in the market you're trading. Do you guys, as you look at this on the level 2, do you see anything there that stands out at you as unusual? Maybe you guys could just comment on it. Exactly, 414. Gerardo and Brian, and you guys probably see that. When we look at this on the DOM lets us see 5 levels, and we see a very large offer sitting out here at $13.30 a bushel. And when you look at the cumulative size on the entire visible 5 levels of the book, you've got 555 contracts bid, but 414 of those are at one price. We look at the other side, totally abnormal. You've only got 161 on the visible book on the other side. So when you see something like that on soybeans, it frequently is done deliberately. And, we've talked about it at this point in the presentation, and I want to kind of tie this back together and make a point of this, so bear with me, because this isn't something I was intending to talk about today. You have a scenario on your time and sales where you're tracking aggressive buyers and sellers. These are people who were not content to just sit out here and come over on this column and say, I'm going to offer to sell it here, and you're not content to come over here on this column and say, I'm going to bid hoping I can buy it here. For a time in sales, you are seeing someone who's so aggressive as a buyer that they're willing to come over here and give up a tick and hit one of these guys, or you're looking at somebody so aggressive as a seller that you're willing to come up and give a tick over here in order to get your short position. So when you look at the time and sales, you have to say the time and sales is tracking aggressive buyers and sellers. These are the ones who cared enough to make the transaction happen. If that's the case, what would you call these guys then who are trying to sell? And no doubt many of them want to be sold just as bad. Wouldn't you say that in a sense that would represent passive buyers and sellers on our dome? Yeah, Tuba Tom, exactly. Passive buyers and sellers. So what would we say then was the pattern of behavior for a passive seller in soybeans? Now, Sean, you're asking if I could explain the different grids. Some of this doesn't matter. We're not going to worry about the graph over here. That graph just kind of shows you where the largest size is on there. It tries to make a visual depiction of it. But what this upper piece is doing is this is showing us the inside price, which is 31 by 31 and a quarter. And if we look at our dome, let me get off the drawing on the dome. We can see that's where our spread is, 31 by 31 and a quarter. So that's what this top line represents. And that just shows us what we see right on our dome. 42 out on the bid, 13 on the offer. If we come one price away and we move one level down on each side, one level up on one side, one level down on the other, 17 on the bid, 50 on the offer. We come another tick away, which would be at 30 half, 30 on the bid, 63 up here on the offer at the 75s. So this kind of lets us see 10 levels of what would be visible here on our dome instead of the 5 levels that we're seeing on the dome. Now in the sections down below, this splits it down, and this was designed more for trading equities. And you see this column ID. If you were tracking a stock in here, this would actually show you the market maker ID or the ECN who had the bid and offer out there. And at that price at 31, you may have 5 or 6 guys out there at 31. So you may see Goldman, and you may see Smith Barney, and you may see Knight, and you may see Instinet sitting over here all bidding 31 for it. And you may come over on this side and you may see 5 or 6 other market makers that are offering to sell it at 31 quarter. So this portion down here doesn't apply as much to a futures contract because it's just a central exchange engine, and we don't see how many participants are at each price. We just see an aggregate. So here's the point of all of this. If you understand what goes on with soybeans, in a market like beans, this is what I would call a real market. It is made up of large commercials who have to transact with each other. And do you guys mind if we just take a little detour on this from our lesson, just because we've got something here that, if we deliberately came in and looked for it, we may not find it for a week. We may find it in an hour. But I'm just going to explain a little bit about this market so that it all makes sense. You come into a market like soybeans, and you will have participants who are transacting in a real item. And let's say that we've got 3 categories of participants in the bean market, just for the sake of simplification. Number 1, you would have the farmer or the guy who produced the beans. And you think about a farmer, if we talked about him in terms of a market, when he has a crop in the field, is he long or short? Anybody want to throw that out? I don't know what your guys' experience level is with stuff like this. So, farmer has a crop in the field. What would that equate to? Right, Brian? He would be long. Now we think about why he's long relative to the market is he has the product. He owns it. That equates to being long. Now let's take somebody else. Let's take the end user. And it could be, for sake of simplification, we're going to lump all the end users together. But it could be a mill who's going to crush the beans, and then they're going to sell off the oil and the bean mill. Same thing. It doesn't matter. We're just going to call him an end user. Um, could be an ink factory who says we want soybeans because we're taking that and we're making ink from the beans. So we want to buy the beans. We're going to do our own crush and so forth. If that's the case, it doesn't matter. We're just going to lump all of those guys together. That is the end. That is the end user. Now, what happens when that end user goes out and says, "I agree to buy from you, farmer, and I'm willing to agree to pay you $31 a bushel"? See, in a sense, he's committed to a transaction where he has to pay for it. But what happens if price changes? Let's say that this guy comes in, he tells the farmer, I will come in here and I will give you 31 a bushel, $13.31 a bushel. And let's say that next week beans drop, the crop is bigger than they expected, and now beans are trading at $10 a bushel. What just happened to that end user? See, he's no longer competitive, right? And this is kind of the basis that the futures market first existed for. But here's the situation. He is now not competitive in terms of price because he paid $3 a bushel too much. Now you think about the farmer, he's happy because he was long and he sold it at $13.31 and then subsequently price fell. He's happy. But for the producer, he's pooched. So what ends up happening is you have three categories of participants here who feel that they absolutely have to come into this market and they have to hedge their exposure. One of those would be the farmer. Now let's say the farmer says, I'll sell my beans for $7.75 a bushel, and he knows that his cost of production is $7. He realizes that he can sell that contract to somebody and he can make some money at it. But the farmers anymore have gotten more and more sophisticated with what they're doing, and so they're trying more and more to time the market. So since he's long, he knows his cost is $7. He's going to go out there and he's going to try to hedge his risk, because what happens if he does sell it at $7.75 and then subsequent to that price rallies up to $14 and everybody else around him is getting $14 for his crop, but he only got $7.75? See, again, he cut himself short. So he looks at that and he will try to time those markets and say, price is up very nice right now. It's up at 13. I'm not ready to sell my crop for another 2 months, but I'm going to go ahead and I'm going to step into the futures market and I'm going to put a position on to hedge the position that's standing in my field and that's going to be brought into my bins here in another 2 months. So he has to get involved in that market to protect himself. Second category of people that has to get involved is going to be, your silos, your storage facilities. And they're going to be the middleman frequently between the farmer and the end user. And that middleman, he may be long or short. He may commit to a mill to provide him with 100,000 tons, but he may only have 12 tons in stock by the end of the season. He may have 12,000 tons sitting there, and he's committed to sell 100,000. So he's created a short position for himself. He's sold more than he has. Now he's exposed to risk, because if he doesn't get it in from farmers on a timely basis, he's going to have to go to the market and buy that to give to his end user. So he's going to look at his net position in real terms in a real product, and he's going to step back into this same market and he's going to put a hedge on. If he sat there and ended up net short early in the year before the harvest is brought in, he's going to come in and buy futures contracts to protect himself price-wise. And you're going to see the end user do the same thing. They don't want to overpay, so when they commit to buying at a certain price, they don't want to overpay, so they're going to use that futures contract to protect themselves from fluctuations. So here's the market now that we're dealing with, which is, as you can see now, it's considerably different than the way the S&P is being used. So why would somebody be willing to come in here and do something so unusual as to put out 414 contracts at one price when nobody's there. At no price is there anybody there. And what you will find on these type of markets is that they will come in and do that because they need to get out of the hedge. So somebody needs to take that hedge off, or somebody needs to put that hedge on. Now, frequently these guys are doing business with each other, which is kind of ironic. But you take the farmer who's long in the field and he puts a short position to protect that. When he sells his crop, he has to take his short position off now to unwind that hedge. He was dealing with the silo, and the silo was short. He put a long contract on to protect his position. Now the farmer brings it in. He's not short anymore, so he has to take off his long position. So these guys absolutely need each other, and they have to do business with each other, and they need to do this efficiently and quickly. And what you'll find as a pattern of behavior in this market is that when the commercials become active in here, they will put the size out. And if there is a seller in the market who's trying to unwind a hedge or initiate a hedge, the price will very quickly move into that level. And when you watch it on your time and sales, you will see every one of those 414 print off, I would say 90 times out of 100. They will move it in, it will print off, everything goes through just like you expected. Now, where this becomes interesting is that we can see down 10 levels in our level 2, and look what happens another cent away. You see the same thing? Level above it has 4 contracts, level below it has 5. Here's 83 at 1329. Very likely it's the same firm. And you will see this happen in this market where this large size comes out here on the dome, and you will see it staggered in 1 cent increments. You'll see, the offer here at halves, you'll see the offer here at halves, you'll see the offer here at halves, and you'll see the offer here at halves. And the bid, if there's a large buyer there acting, this large seller is trying to get him to move into him. And if there's a large buyer there, you will see him work up through every one of those levels. And when you see the big numbers disappear and they're not out there anymore, when you're looking away 8, 10 ticks and they're not out there anymore, the deal's done. The guy that needed his hedge has his hedge. The guy that was trying to sell got his sales made. They're done and finished, and then price will drift back. So you can play this a couple ways, but the point of this discussion, when we were talking about the question initially, what do we see on the dome? If we see this big stuff or we see weird stuff on the dome, we have to understand the market we're trading. So we come into something like corn or beans or crude or something where it's real, it's very possible that we're going to see participants hedging back and forth with each other, and they're going to put these orders out there not to try to spoof people. This guy's not putting this here hoping that he can fool people in the same fashion that you would see on the S&P. He's putting that out there because he's hoping he just did a large transaction, and now he's got to change his hedge, and he's hoping that the person he did that transaction with is also going to be changing their hedge, since both of them have to change it. And he says, hey, I'm here. If you want big volume, I'm here. Come get me. Sometimes you'll see them come out on both sides. Neither side wants to give up the point. So they'll come out on both sides. They'll both be sitting there. One big offer, one big bid. Neither one of them really wants to move into the other. Eventually somebody will. Now, I don't know if you guys have any questions about this, throw it out here. I'll pause here for a second. And while you guys, if you have any questions that you're putting out, let me mention why I'm explaining this or how I would trade this. To me, it is a very beautiful thing to see, because one, if you see it happening, it tells you immediately, is there a large seller in the market? If there is a large seller in the market, he will move it to that level. And if you see that they're still down here another cent, you've got a short, and as long as you see them keep filling out every cent, you can see them keep putting a big bid out there, you've got a short until you see that large seller quit working. And when that large seller quits moving it down, and the thing stalls, it's time to cover your short. You could not see that on the time and sales. You can confirm it on the time and sales if you wanted to wait until it got there and you could see that guy get filled. If that's the case, then what does that tell us about using the dome just in general? We're talking about using it in general where some are trading the 6E, some are trading the YM, some are trading the CL, some are trading the S&P. See, really we have to understand the way that that market is moving. Again, I would reinforce the point that we need to be familiar with a market and trade that market. It's going to give us the best chances of success. So if you see, Karen, on the crude, if you see this type of behavior, then watch the reaction. What is it? If somebody comes out there and puts big size, does the seller move into them, or does it just hang there and nothing ever happens? Is it somebody that just says, hey, I don't care, anybody out there can see me? When you see that on the S&P, it's more likely on the S&P that it's somebody that's trying to manipulate you the wrong direction. You know, with you get into the YM, you get into the NQ, you don't see it as often. You'll see it more on the NQ than the YM, but the reason you don't see it as often when it comes to the spoofing is that, and by spoofing what I'm referring to would be a guy that puts a big order out here, and then he pulls it right as price comes into him. He does not intend that order to be executed against. He's trying to trick you into the wrong thing. So you think about the trouble coming into the YM and spoofing there. If you put 500-600 lots out there that you didn't want filled, you may only have 30 or 40 in front of you in a total of 3 levels. And if you only have 30 in front of you, you don't have enough time to pull the order if somebody comes blasting into that. So you don't see the spoofing on the dome typically in the markets where you've got a thinner dome. When you've just got 20, 30, 50 contracts a level, they don't play near as many games on the dome. Now on the NQ, I commented on it in the past that I didn't understand the behavior, and subsequent to that, you know, became aware of that as an HFT, where you would see somebody come out and put in 1,500 on the offer, and then it would instantly disappear. I mean, just as fast as you saw it say 15, it was gone. 15, it was gone. And it was, you know, it's HFTs putting fill or kill orders out there trying to trigger a bot. So you have to kind of become familiar with what your market is doing, whatever you decide to trade. If you like this behavior, well, you get to sleep in an extra hour, or if you're Pete, you got to stay up an hour later because it opens later. But you find behavior that makes sense in the market, and you're able to see what those large traders are doing. It can be very easy to work with that. You'll learn a couple things. One, is there a large seller in the market? Yes or no? If there's not, why would we be shorting then? Nobody's interested in it, and if this guy still needs to buy, eventually he's going to have to pay up. There's no large seller there. Is there a large seller there? Well, you just ride with him as long as he keeps on selling. As long as this guy keeps offering out. I think Ken, I know you were there, and Brian, you might have been there. I can't remember. But we watched this at one point. No, actually, I think it was Ken and Bill. We watched this at one point where somebody was coming out and they were adding a couple hundred every cent, and this went on for the entire morning. I mean, every cent, every time they moved it down, they're still there. They move it down, they're still there. They move it down, they're still there. And what's kind of interesting, if you're into the beans, you can get the CME Group newsletter for free, and they will announce large contracts. You know, somebody in China bought 100,000 tons. Somebody in India bought 100,000 tons. And the next day, you will see that behavior in this market. You will see them unwinding their hedges. So it kind of gives you a heads up. You see the big transactions announced, kind of gives you a heads up that they're going to be in there taking their hedges off. So, moral of the story, you know, you get familiar with the type of behavior. If you're doing the S&P, you suspect that it's going to be manipulation. You get on the YM, you suspect that it's real, and somebody really is going to let that get filled. You know, this is where I would say person like this, even though they would be in the column with the other passive sellers, or excuse me, the other passive buyers, they're actually fairly aggressive. No, I'm still recording. I've been doing okay up to about 40 minutes. Appreciate that, Gerardo. I was going to just wind this down and stop it here, but once I get the first one done, it seems like I'm okay. Up to about 40-45 minutes have gone through no problem. But I would say that these guys, they are on the aggressive side, even though they're not aggressive enough to come buy at the market. They are aggressive because they're willing to put the whole shenanigans out there, and they say, "Come get me. You can have it." So I will stop there. If you guys have any other questions about it, throw it out. Let me. Well, when I turn this off, we'll see where it went and what happened with it. Actually, it's moved away where we can't see the price and what happened anyways. So I will stop this. I'll be back in 2 minutes. Okay, so back here, I do have one question. Tuba Tom, you say a trade at 13.30 and a quarter would be a good buy. Under the scenario we were talking about, I would say on a normal circumstance that would be suicide. Not a good buy. The fact that he was out there in real, if a large seller is there and he has an offer out there, and follow me on this, if he has an offer out there at 13.30 and a quarter and he's got 29 and a quarter and he's at 28 and a quarter, and a seller comes in and sees him there and needs to get some hedge adjusted himself, he will take it down through every one of those levels. So if you see him thick out there every cent or every 3 ticks, usually you see it at a cent. It's kind of funny. It's just as dumb as me trying to get $1 even on crude instead of 99 cents. But you usually see that. Tom, he does have to buy. But here's the problem. You're dealing with a market where he's going to throw that out there because he knows someone has to undo their hedge and someone has to sell. And he doesn't want to pay up. So if you see him out there and a seller starts moving into him, that seller will hit him there, and that seller will hit him at 29 quarter, and that seller will hit him at 28 quarter, and it will keep going until he's done. Remember, he's not buying at the market. He's just saying, here it is, guys, come and get it, and he's going to try to outweight the other guy who he knows has to unwind and sell. If he doesn't come in, no seller appears, eventually he will come back in and he'll start buying it up, and this very well could be what happened. I would say based on where it sits right now, look at our dome, look at our level 2, I'm sorry. What's happening back down here at 31? See, he hasn't bought up. Exactly, Brian. The seller will move down through him over and over and over until that big buyer's done. I'm sorry, the big seller's done. They're going to come down into him and hit him and hit him and hit him and hit him. Where you usually see that disappear in this market is when one side disappears and you look down another cent and another 2 cents, and you look down your 10 ticks and the big bid's not there anymore. It's all done. Gonna drift back where it was. If you want to call it fair value, we'll call it fair value, but it's going to drift back. You look at this where we've frozen this, and it's not visible on our dome. But look what's happening here is you've got the big seller out there, and the big seller's trying to hold out for 35. The big buyer's trying to hold out for 31. And you've got 2 guys that are stubborn about taking their hedge off. But Tom, here's the thing you've got to realize. In this market, seeing this and saying that's a real buyer, that does not mean in beans that you step in front of him and buy. You'll usually get wiped out doing that. What you realize is that he's real, and when the opposite side comes in to take off their hedge, they need big size, and they're going to go down through him and take him out all the way down. So if that's the case, you don't play it the same way. What happens, though, in something like the YM if there's a big buyer out there? See, in the YM, you may say, hey, I'll lean on that guy. He's real. He's out there. He's willing to step in and do it. I'll lean on that. And they'll take a run at him. They'll try to get through him. They'll try to see if he's real. But if he's real, we may decide to lean on him a little bit. Right, Gerardo? We could view him as support and say, hey, I'm willing to step in here a tick in front of him, put a stop a tick behind him, and realize that 90% of the time those big numbers are real. If they are a ping order from an HFT, it's just going to flash and disappear and it's gone. Flash and it's gone. Flash and it's gone. But if it puts it out there and it just sits there, and especially if we're able to confirm that on the time and sales, it moves down in, starts printing against him a little bit, and he stays there, and he moves up a tick, the price moves back up a tick, we could say, hey, I'll step in here and lean on this guy to the extent that I can, if it fits my chart patterns and everything else. But again, you have to know the tendencies of the market. That's going to mean studying what you're trading and understanding the way the participants there use it. So you'll see different things across any market you look at. If you want to go trade gold in the middle of the night, and gold was the one, Tom, I addressed your question earlier, and I'm not Tubatom, but Tom Labissiniere. I think I addressed your question earlier about the overnight markets. One of them that I didn't mention that I probably should have thrown out there was gold. Gold can move pretty good overnight, and you've got the mini gold, which you can trade at a smaller size. But if you go watch gold, you'll see, watch the mini gold contract, the YG. You'll see the same behavior every single night when you go in there, where someone is making a market in there to the tune of 10 lots, and they will do exactly the same thing on the dome every pickin' night. They'll go 6-4 on the offer. It'll sit there a minute. It'll go 7-3. Then it'll go 8-2, 9-1. Then it'll show 10 lot. It just constantly back and forth, back and forth, back and forth. But they've got 10 lots there. No executions going off because it's a very thin market. You can actually go play against them. I've messed around with them before. Sucker him up into trades and then smack him the other way. It was kind of fun messing around with it. But yeah, Brian, they're screaming, aren't they? I really wished it would have pushed back. I took a couple more trades in the silver, and I kept wishing it would pull back some more to buy again and let it take another run, and it didn't get me the pullback I wanted. So yeah, I figured you were probably watching that. So anyways, we'll quit here with this. You can see the price. Obviously, at some point it's moved up. Is the guy still down there at 31? We don't know. They definitely went up and took out the guy that was offering out. So he may have given up on it and said, "Boy, the seller ain't going to come hit me. I guess I'm going to go hit him then." You'll see that as you sit there and watch. If you're watching that live, you'll see it happen. You'll find a way to take advantage of it. But anyhow, so that gives us a bit of information about the dome and tracking that. If you want to see a lot of manipulation, I would say some of the most manipulated markets. Let me just, I'm going to put a couple things out here. Remember we talked about those overnight markets. With the Eurostoxx 50, what's kind of interesting, there used to be a fairly simple pattern, and it was it was usually taking place in the German treasuries, and these markets are kind of related in the same way the S&P is to our treasuries over here. But the Eurostoxx 50, if you look at that as far as the treasuries go, you'll see that manipulation on the dome. If you ever want to go in there and look at it, it's very visible. It happens all the time. Your FGBM, FGBL, and then on your Schatz, it used to be all in the Schatz, and then it started varying because Eurex basically outed the trader that was doing it and tried to ban him or tried to outlaw him from doing what he was doing. But he was basically a guy that was coming in there He was spoofing, um, where he would come in huge size and then he would flip, and he ended up with the nickname of the Flipper. His name, if you ever want to do a little interesting reading on it, there's been a few interviews and articles about him, but his name is Paul Rotter. By most accounts, he is considered the largest known individual trader in the world, at least that's been outed for what he's doing. But just as a private individual, trading 300,000 round turns a day, very, very, very large trader in these markets. And that's you'd be looking at that at the London Open or an hour after the London Open. That's where he's active in there, and you'll find him in there spoofing and flipping from one side to the other, and moving it for a few ticks. And he'll go in and try to manipulate the Euro Stoxx 50 at times to get the bonds to react, and he had to start mixing it up. It used to be in the Schatz all the time, and it changed. But it can be instructive looking at the way they will use something like this. If you figure out how they're using it, all you have to do is watch for the patterns to appear again where they're doing it, and you just take the trade with them. So, moral of the story: get to know your market there as you're dealing with that. Let's go to a little bit of management, and I'm going to go through a couple of things here with management. I don't want to insult anyone's intelligence when it comes to management. I know that you guys have probably put a lot of hard work in this, and I'm going to just go through something. It's actually a slide it's coming up on a couple years old, but I think it's still relevant, and the lessons that are there are still very relevant for management. And there's a number of different ways that you could manage trades, and I'm going to go a little bit more in depth about what I had to do as a one-lot trader when I opened up the smaller account versus what I do scaling. If you guys have any management questions, throw them out there as we go, and I will work it in on the fly where I feel it's relevant. So just feel free to throw stuff in there. Here's the setup for what we're looking at right here. Had a trader contact me, as a gentleman I was working with, and he had sent me a screenshot of his chart, and I used to have that, and for some reason I can't find it on my computer. I've gone through 3 computers since December of 2008. But this was trading back on October 2nd of 2008. And he sent me a chart, and he says, I got into this trade on the S&P, and he went in with a sell stop. So he used a stop entry. And what he did with that is he came in at this low. He was watching these swing lows. He came in at this swing low, and he put a sell stop a tick below it. So he gets in a trade, and the trade is back and forth going sideways. And as you sit there and go sideways, obviously you start getting uncomfortable. It's not moving. You got in with a sell stop, and who uses a sell stop? A momentum trader typically. And guess what? He got in and there was no momentum. It died on him. So he gets in the trade, goes sideways for however many minutes it was. I believe this is a 200 tick chart, but it looks like, looking at the time scale, from the time that he got in at around 7:21 on this chart, he had gotten a little bit positive over the course of 8-9 minutes, but not enough to do anything. And then price moved back up against him considerably, and he felt he's going to get stopped out. Now, most of you have gone through this. In fact, I would say if you've placed a live trade, you've gone through this. Sorry, give me 1 second here. If you've entered a live trade, you've gone through that type of scenario. Yeah, Karen says this is the story of my life, and she's laughing about it. She can laugh about it, but you get into a trade and you're late and you saw it right, but your timing wasn't real good, and it goes against you. And what is the tendency at that point for most traders? I mean, you guys can throw it out there if you want. I mean, you be honest about it. Get out. Exactly, Karen. Bail, Brian. See, we see this happen, and in this case, from his entry here, uh, from what I recollect of this trade, and these charts were already drawn up, so that's why I'm using them. But from what I recollect here, he had an entry that was a tick below this low, and so he had almost 2 points of heat. And you think about that, 2 points of heat on an S&P contract. And price comes back his way, and he was so shook up, he got out of the thing with 2 ticks. Now, I know no one here's ever done that. And I'm the only one. I know I've done it. I'll admit that. Nobody else, I would say nobody else would ever do that. You get so shook up by that, and 15, 20 minutes have gone by. In this case, he had an entry over here somewhere in the vicinity of 7:11, and it finally came back positive again somewhere around 7:32. So he's had 20 minutes of sitting there messing his britches, and he finally gets a little positive, and he bails with 2 ticks. So he sent me a chart, and he had this 200 tick chart, and he had circled on this chart a couple of areas where he said I should have stopped out here or here. And what he was looking at was the swing highs and lows, just trailing it down over those swing highs, and said that would be fine. And he felt if I would have just done this, instead of making $25, I could have made a couple points on this and had a decent little trade here. So here's what I pointed out to him, and I'm going to go back through this on the slide, was something that we were talking about earlier, which was watching these swing highs and lows and looking for the time where we've had a downtrend. According to our definition, a downtrend would be lower highs and lower lows, and a trend change would mean that we go from lower highs, lower lows, we go to higher highs and higher lows. And so coming through the overnight session, as I pointed out to him, it had been a solid downtrend. And in the pre-market, that rotated, and the first point that it rotated would have been here at 2, where it finally broke above a prior high. And from that point forward, we've got now we have a higher low, which we didn't know for sure at the time. We have a higher high, higher low. We keep moving up, higher highs, higher lows, higher high. This was actually equal on the chart. This one got another higher high, higher low, higher high. And it was finally at the point where he took his entry that we broke the prior low. Now, he was watching that as his entry method, and because he liked momentum stuff, he didn't want to wait for retracement. And he says, I've just got to go in when it breaks. And I had always told him, if you do that, just remember, you're going to have a bigger stop and a smaller target. That's not conducive to good trading. We don't want a big stop and a small target. We want a small stop and a big target. So he kind of understood what I was referring to in watching those swing highs and swing lows. And his goal in trailing this out was that he was going to come in and he was going to trail it here first over this high, and then when it moved down, he would trail it over this high. When it moved to a new low, he would keep trailing this on the 200 tick charts. So that's kind of the basis of where he was at and what he did with it. And one of the things that I encouraged him, the same way that we talked about it, I believe, yesterday, looking at that YM chart, is let it retrace up into that 50 to 60% zone. Take your entry there. Yes, you will miss a few trades. But you have to say, if you would have got into this trade right here, you had no heat, never went against you more than a tick or two. Yeah, Karen, the 618 retracement is the top line here on this little fib where I'm circled. So it got just a tick through the 618 retracement, perfect retracement. Sellers immediately jump it, take it down. You get an entry anywhere in these first couple candles, even if you're slow, and immediately you're profitable. You're not sitting there sweating. You're not sitting there nervous. When it retraces, your retracement doesn't come back to the fib zone where you went short. So you never felt the heat. You never had to bail out. And so one component of good trade management is making sure that our entry is in a good place. It's something that I tend to look at almost subconsciously. If I enter here, where is any potential retracement going to come? Is there a potential retracement that's going to come back and swap me right here? And I'm always paying attention to that subconsciously. I do think that is the first component of good trade management. And so I've always told people, if you step in on the basis of the tape and you take an earlier entry up here, instead of waiting for it to roll, you in a sense, it might feel like it's riskier because you don't have the full confirmation of a chart pattern, or you don't have an indicator rolling over. But bottom line, it is probably safer because that's where you get small stop, big target, and you're not feeling heat the second you get in the trade. Gerardo, with your comment, you says you do not see where. Do you see the red circle here on the chart? That's where we're talking about the little fib retracement. That's where I'm talking about. Sorry about that. That I drew that on there, and if you just looked up and saw it, it looks like it's part of my drawing. So from earlier. But anyhow, I'm going to get rid of that and just keep that in mind. Good trade management, first component is having a good entry. And we're trying to help you guys appreciate a way to time it where not only do you see the direction correctly, but the timing is matched up with the change, with the direction. So next slide here, bear in mind this pattern. I left the blue circle here, which was his entry, was in this first push. And we're going to go to the next slide, which shows a longer time frame what happened. Now I apologize, it's going to be a little bit small, so I'm going to re-highlight this. He showed me where his exits on the trade should have been if he was trailing out on his 200 tick entry chart. And I'm going to just re-highlight that. He said he would have stopped out here. Let me get rid of that. Change that to an ellipse. He said he would have stopped out right here in this. I still don't. Does that show up any good? Let me change it to blue. Maybe that'll show up better. He said he should have stopped out here, or he should have stopped out here. Now, on each of these occasions, what he was looking at in terms of a stop is he was just coming in when it rallied back up and it pushed to a new low. He was going to put his stop over there. Rallies up, push to a new low, move the stop down. He was going to trail it down, but he was going to stay on his 200 tick entry chart. So I switched this. This is actually a 1 minute chart. And so when we look at what he did here, here was his entry and here was his exit. 2 ticks. And this was around 11:54, and you look at that first thrust down, took it down 10 points. And on a 1 minute candle, not a single rally won. Straight down 10 points. Now he realized that after he got out, because he realized 10 points was where he got the first retracement that came back up over a prior swing high on his 200 tick. That would have taken him out right here. Second retracement on that would have taken him out right here. He would have had about an 8-point profit from where he got in if he would have just followed his rules. One of the things that I've always encouraged my students to do is it is going to be very difficult to do this type of management, but you have to start drawing the charts. Make your decision. You do what you do. Bail out. you know it. Nobody else is going to know it. Print the chart out at the end of the day, or take a screenshot at it and mark it up, and look at how much money you left on the table by bailing out. If you start doing that trade after trade after trade, it's not that you want to reinforce behavior that says, man, I'm a loser. I really messed this up. What we want to reinforce is that you're picking things correctly and it's running correctly. And if you change your behavior, you're going to be making a boatload of money. And it sometimes it requires that. I'll tell you guys the truth. I fought the same thing the first couple of years I traded. And when I moved out here to Oregon, I found a journal going back to my trades in 97, 98, 99. And man, I was cussing myself. Just, you bunghole, look what you did. Look at this. You left $1,000 in this trade on the table. You left $500 in this trade. The first thrust, I left $500 on the table. Trade after trade after trade after trade after trade. And the last entries in that journal were coming back up into 99, late 99 and early 2000. And I finally had whooped it. But there was literally hundreds of trades there. And my demon, my problem with those trades was bailing out too early. Now, any of you guys that have traded with me in the room, I'm sitting there going, well, stink. It's only up, it's only up 96 cents on crude. I'm going to see if I can get $2. That's what it took for me, was jotting this down, doing the math, seeing how much I was actually leaving on the table. And eventually the logic overcame the emotion and was able to do it. What I subsequently went on to point out to him, and he had drawn a third area down here that he felt would have been a good place to get out, is I mentioned to him, look at these little pivots here on a 1 minute chart. You've got this pivot here, you've got this, and by pivot I'm just referring to swing highs, swing high here, swing high here. And I pointed out to him, if he would have just traded this out on the basis of a 1 minute chart once he was in it, this would have added $6 to his trade. Now when I say this would have added $6 to his trade, this would have added $6 to where he would have gotten shaken out over here on this first push down. So one strategy that I have encouraged people to think about is, as you see yourself picking good prices and good entries, if you're watching a tick chart for that entry and the tape, switch to a minute candle or a 2 minute candle or a 5 minute candle. Because when you're right, if you guys like reversals, which most of you like reversals, if you're right and you pick off a reversal, you want to be able to get your full money's worth out of that. I like to pick off a reversal and make up for 10 or 12 losing trades. It's free money. That's gravy that you look at month by month. It's a free car, it's a free vacation, it's a free house at some point. If we can just get that management correct and pick up those nice moves and still be able to take advantage of it. I went ahead, I'm going to switch this here, and I'm going to go one more chart. And on this final chart, this here is a 1 minute chart. So we went from a 200 tick to a 1 minute. And doing that over the pivots from where he thought he should have gotten out, this added $6 to the trade. If we go to a 2 minute chart, and I still left everything circled here on the 2 minute chart, this is where he said he would have stopped. Or alternatively, worst case, this is where he would have stopped on a tick chart. Look at how insignificant that rally is on a 2 minute chart. On a 200 tick, it was significant enough to chicken him out of a good trade if he would have still been in it. On a 2 minute chart, it was nothing. I mean, they rallied it up 1.5 points and immediately sold off from 44 down to 36. They rally from 36 back to 42 and immediately sell off to new lows. And so if he would have gone to a 2 minute chart on this, This could have taken him out clear down here $8 below where he thought the optimum exit was on a 200 tick. So can be a strategy that's worth looking at. And again, you've got to take this back to your instrument and your style of trading. If you're playing breakouts, you're probably not going for the move from the high of day to the low of day. If you're trading reversals, you're going to want to look at that bigger picture once you're in the trade and don't get jiggled out by noise. Kind of goes back to the way I answered Edith's question yesterday when she was asking about using the tape. And hoping that tape would keep her in a trade longer. And I look at it and say, you're better off, instead of going shorter term and more noise, go longer term. If you're picking reversals up, I would rather get stopped 5 times in a row than pick up a reversal 1 or 2 ticks off the high or 3 ticks off the high and then not be in that reversal when it goes through the low of day. 2 hours later. I would way rather be stopped. So, an additional factor that I think is good, Andrew, with your question here, I see you say you have to leave. I will put that up to the guys in the room before we're done here today, and just see what everybody thinks, and we'll try to get a consensus on it, and then I'll shoot you an email personally on it. It'll be at the end of the video as well. So, no problem. Have a good day. We'll see you tomorrow. Anyhow, one thing that you notice I have on this chart is just the volume, and it's Ninja's volume up down, which if it was a red candle, it colors the volume bar red. If it was a green candle, it colors the candle green. It goes back to something we were talking about last week. For guys that were using pit audio, if you're using the raw pit feed, I have talked about this with several locals who confirm that when the pit explodes and there's this intensity and the screaming and the yelling, if you were in a position, that was where you took your position off, or at worst, that was where you tightened up. And they said, that explosion happens at the beginning of a move and it happens at the end of a move. Well, we see that same principle carried through onto a candlestick chart if we put our volume on there. If you're doing this for the sake of management, I would say best thing to do, stop watching the tape, put up a 1 minute or a 2 minute chart and look for the volume. And what you will find, what I've referred to it for years as, and maybe everybody uses different terminology now, but I have always referred to that as climactic volume. You would have to say that normally we would expect our big volume bars right at the open. That's where there's a big rush of trades, and then over the course of the day the volume dries up, and you will see that most days. But you will find, as you go back and look at charts, very frequently you will have big volume spikes. And those big volume spikes, when they come in like down here, and they go higher than any volume all day long, that is usually a good indication that you've reached the end of the move. This would equate to the explosion of volume in the pit. This would equate to the explosion, the acceleration on the time and sales. That is the final death throes of the move. And so when you see that climactic volume, that can be a good place. If you've got one lot left, kill it. You don't have to let it retrace up. You see that and you get this big thrust and this big push. You've got some bottoming tails coming in here. You've got volume has picked up. That's the point where you're probably saying, good enough, kill the trade. Did that happen at these points? And you have to say yes. Look at the volume spike here. Again, that was a point where it pushed down, and then it had a retracement that was big enough to shake a lot of people out. I mean, you had a 6-point retracement. Big volume spike. Retraces and subsequently went lower. This ultimately ended up going lower. It was a bloody day. Sold off all day. But I have to say this. If you can't do this on a regular basis, day by day, even though we don't always get the 20, 30 point sell-off, if you can't approach your trades this way, you will never, ever be in it when we actually do get the 30-point sell-off. So, you do this a lot of times, you're not necessarily going to get the 20-point trade. You're not getting in at 54 and getting out at 24 on a volume spike, because it doesn't happen every day. But if you're able to do it, when it happens, you will be there. I've got an archive of trades up on soybeans for guys that had bought the soybean video. And those archive trades, you go through there and it's 20, 30 cent trades, very common, which would equate to 20 and 30 point moves on the S&P. 50 bucks a cent on beans, and you're getting 20, 30 cent moves. $1,500 on your little one lot runner. The reason for that is having that type of mentality and saying, no, it's broken down here. It's rejected this high. I've got a premium entry. I'm going to let this thing work for me. My employee is out there digging the ditch like mad. I'm going to let him keep digging as long as he wants. I'm not going to ring the lunch bell. Let him dig. And as much as I like Ken's croupier stick sitting here, I still don't reach out there and use it. I still see more potential in the trades, and I'm still going to try to be there to let those trades reach that full potential. One of the things that I want to mention to you guys as you try to do this, and then I'm going to reset the tape, it is one of the big advantages for you guys with smaller accounts to looking at the 6E Euro US dollar combo trade, because it will allow you to scale out and trade like a professional trades. The majority of professionals, when you look at them, they do not go all in, all out. They are looking at multiple price levels. They may scale into it, they may scale out of it. Very rarely will they just put a big gigantic position on at one price at the market and then take it off at one price at the market. So I'm going to stop and reset the recording. Any questions, throw them out there, and then as soon as I start the recorder back up, we'll address the questions. Okay, so all finished with that. I do have a couple questions here, so we'll address that real quick. Brian, are you going to be taken off right away, or? Okay, as soon as you leave, I'm going to give them the true holy grail to trading, and then that's not going to be in the recording. So, no, I'm just kidding. We'll see you tomorrow. Have a good afternoon. So, yeah. Let's take a look at a couple of the comments and questions here related to this. First of all, Tuba Tom, you ask or comment on the volume spike before, and I'm assuming, Tom, by your comments here, you're talking about this volume spike down here. Okay. You're saying with this volume spike before, did or would it get you out, and how do you not get taken out there? A couple things that I would take into account in a scenario like that. One, how many lots do you have left? If you still have 2 or 3 left, take one of them off. I try not to, it's not that I don't do it, but I try not to take off all of the size at one spot at the end. And the situations where I do is when it's been in the trade for an hour, hour and a half, and I'm tired of sitting there and I want to go do something different. And at that point, I may just take it all off there. I honestly, guys, I would tell you the truth. I probably take off more trades because I'm tired of being in the trade. I'm tired of watching the trade, and I just want to go do something else at some point. I will use I'll put a target out there and a stop out there occasionally. If it's a market that I trust that it's not going to blow through my stop, I will put a target and a stop out there and set my dome to close at time, and it'll either hit the target, the stop, or it will close it out 5 minutes before the market closes for the afternoon. So, Tom, to answer your question, if you have 2 or 3 lots left and you see the volume picking up and you see the acceleration, it is a good point to come in and take off 1 or 2 of those lots that you have left. Keep something else, still trail it down, but take something off there. If you don't have anything left, you don't know that there's going to be another volume spike later. So you're going to just act on what you see. And you look at it at that point and say, I've sold off from 54 all the way down to 36. I'm sitting almost 20 points and I'm getting a volume spike. Would I take it off? Heck yeah, I would take something off. If I had one left, that one lot's done. So you're going to have to decide that based on what you have left. How far have you gone? What are the realistic probabilities? You know, in a sense, it's like your card counter at a casino. You know, where he can excel is he gets down to the end of the shoe. If he's able to count, he gets down to the end of the shoe, and a lot of what was going on there was just piddly dink stuff. But when he gets down to the end of the shoe and he senses his advantage, he's going to take advantage. That's his edge. So if that's the case, you know, we get to that same point. We're down to the end of the shoe. We look at what we've accomplished. We look at what our odds are. What's the odds of it on a 20-point down move that was already down 20 points overnight? What are the odds of getting another 20 points? And you have to say you would calculate that out as pretty slim. And guess what? It did it. But bottom line, you're making a decision with what you know at the time. So, you know, take that into account. Depends on your position. Now, you also say on the red or down volume, it must not be selling going on. It absolutely on these moves will be selling going on. Look at this red candle, and this is the spike here. The green candle would be this first green volume here. Where did they close that candle? I don't know how well this comes through, but when you look at the chart, they closed it dead low. I mean, they closed it one tick off the low. That was selling coming in. So, you know, when you look at that, it is common to see a bigger candle, you know, in terms of its range from high to low, and that larger candle will be accompanied with a significant increase in volume. Now, if you were watching that on a 5-minute candle, you will see the acceleration of sellers first, and then the sellers will start drying up, and then you will see that frequently come back in at the end of the candle with buyers. That's more typical of this second candle. Sold down, pushed down, acceleration in volume, acceleration in selling, and then the buyers grab it and start trying to push back. So that can go both ways, but frequently the volume spike in a down move, it will frequently come on a larger than average red candle, and in an up move it's going to come on a larger than average green candle. It's that capitulation, that final, everybody's throwing everything they had at it and it can't go anymore and there's nobody left to buy it, and that's where it rolls. So again, you ask on or make a comment to Tom. You say you love the volume spikes, but you would like to be able to read them better. You know, you have I think just an understanding there that large volume in and of itself may not mean a whole lot, because large volume can at times occur in a base where it's going sideways. I've seen little sideways moves where price never moved more than a point, and yet 300,000 lots of the S&P traded off in the space of 10 minutes, and it never moved more than a point. It's just going sideways, and two extremely large firms or traders going after it at that level. But the thing that you always have to put together with the volume, if you're trying to learn to use the volume better, you have to look at where it is and where it came from when that volume is picking up. If that volume is picking up on a breakout, now you're looking at your tape saying, is that volume coming in sellers or is that buyers? You know, it gives you a trade one way or the other. You look at it at a point like here, they're trying to break it up higher, and you see this volume right up here on this little doji. Again, you know, what does that tell you at that point? You've had a massive down move. You've had a fairly shallow retracement. in the big scheme of things probably didn't even get up to a 25% retracement, and now you're getting a volume spike. And what was it? You have to say it probably started out buyers and turned to sellers on the tape. Look at the footprint that was left on the chart. It pushed up, it opened down here and closed down here. It pushed up a point, but they knocked it back. You have to say it started out buyers, ended up sellers. And it was on increasing volume. What does that tell you for a trade? Can you price action trade into that on that basis? Can you get into that on the basis of the tape and say, stink, we're pushing up on big volume and the sellers are jumping it and clobbering it and pushing it back, I'm going short. It's an early entry. You're going to have 20 minutes of sideways before you get your payday. But your clues are all there in the course of that 2-minute candle. A lot of time to sit there and think about it and analyze it. Can you take that same thing on the basis of the chart pattern? Can you say as soon as we break a prior low, prior candle's low, I'm going to go short? Traders have been trading that on 5-minute candles for 20 years, and 20 years from now they'll still be doing it. Put your stop over the high. So, when you look at those spikes, you always want to take that spike and put it in its context with the move itself. Big volume on a sideways market doesn't really give me a trade of any sort. It just says, hey, it's going sideways, and a lot of guys pushing back and forth at this level. At some point it's going to break, but guess what? I'm not a breakout trader. I'm not going to sit here and watch it another hour to try to pick up a trade. I'm going to go do something for the day and be done. Tuba Tom, you also say, can you tell a volume spike reversal versus a retracement like the chart shows? You don't know. A reversal and a retracement look exactly the same thing. It just depends on how far it carries 20 minutes later. So if it's a retracement, coming down over the swings will keep you in very frequently until the trend changes. So if you like that thought better, that's fine. But I look at this here at 34, that was a 10-point retracement that would have stopped you out over this swing high from 32 down to 22. So when you see that type of a breakaway move in big volume, and the volume is exceeding the volume of the high, I would be more inclined to take it off there than I would coming back over the high. That's where I would take Ken's saying to heart and say, get the money, keep the money, GTM. So, Karen, your comment, you said you've also heard that 10, 20, and 30-point moves on the S&P can be significant. Are you referring to just the round numbers? Like the handle itself having some psychological significance? Or I have not heard too many people commenting about it. I don't see a answer back from you out there to my question, but I don't see necessarily people talking about it. But by the same token, what would you do? Okay, so you're saying like moves from the high of the day, 10, 20, 30-point moves. I do think the psychological value is there. I'm impacted by it. Ken and Brian were sitting with me on a crude trade a while back, and it comes up to $1, and $1 sounds really nice. For some reason, $1 on crude sounds a lot better than 99 cents. It actually, $1 sounds better than $1.01, $1.02. To say I bagged a $1 on crude, that kind of a trade. I look at that, and psychologically that's comforting. What did I do? I said, no, I'm going for $1.50. I moved my order, and it was a kind of probably an idiot thing to do, but I moved my order where it was sitting based on the chart from $1.47 to $1.50, because $1.50 sounded better than $1.47, and I would have got filled at the $1.47, and I didn't get filled at the $1.50. So, I ended up getting like $1.32 on the trade as it trail stopped me out over 3 ticks. But why? I'm an experienced trader. No reason in the world that $1.50 is any better than $1.47. It's $30 difference. You're talking $1,470 profit versus $1,500 profit on a 1-lot trade. why would you do that when the chart said do it here? Because the round number sounds better. So when you start thinking about, guys, you get a trader, first time he's ever gotten a good move, and he let that thing run, and he sees the round number, he sees 10 points. What's he going to do? I mean, if I do it after 15 years, average trader, exactly, he's going to close the trade. 10 points. Same thing happens. He's coming up on 20 points. First time he ever bagged $1,000 on a one lot S&P. What's he going to do? Kill it. So I do think there's a significance to numbers sometimes just because of the way we perceive them. We tend to view that as mentally a lot more satisfying. So you see the same thing in Forex. You ask any Forex trader, and they're going to tell you it's the 1 cent handles. They're going for the big numbers, and then it's even better if it's 140. 1.4000 is psychologically a lot better than 1.3900. The handle, the 1 cent handle, the 39 will be a big number, but the 40 is bigger. The 50 is even bigger. When pound got to $2, I couldn't believe the way people were tripping over themselves to short the pound at $2 because that round number had to be resistance, and it just punched right through it and ate them up. But the general consensus was sell it. It's at $2. It's like, let it prove it. It's still got room. It's still got momentum. It's going to go further than you think it's going to go. Let it prove it, and then short it. Let's see, Gerardo, you ask, or you say, where would you have taken every contract out? That, in a complete hypothetical sense, what I would normally look at in a trade, and it comes down to, it's the same answer that I gave to Batam a minute ago, comes down to how much size I have left. If I'm getting down and I've only got 2 contracts left, I'm going to be kind of cautious. I'm going to look over there and say, I want to see something significant to take that off. So would I take something off on that volume spike? Absolutely. If I still had something left, I'd keep trailing that down over the pivots. I see another volume spike. Would I take something else off? Absolutely. If I've been sitting there for 2.5 hours in that trade and I see that volume spike and I had 20 lots left, I'd still take the whole thing off. I have to admit, I will get there at some point. I will just go crazy watching it, and it's like, I'm tired of this. I don't care that it's going my way. I'm sick of it. I'm sick of watching it, and I'm ready to go do something else, and I'm done. So I do feel, for a guy that's scaling, you have to look at how much you can scale. If you've got 5 lots, you're going to approach it differently than a guy that's doing 2. Differently than a guy that's doing 25. So, just a little bit of information on that. Yeah, Karen, you've got a comment here. He says, notice how you have the volume spikes where it reverses back to the downside on every pullback. And you see that volume kind of accelerate, and you get the little spike and it reverses. And that tends to happen. As a move gets towards the end of the move, you tend to see that acceleration. It goes back to the same thing that we were talking about, remember, on the second day of this, at identifying reversals. You see the 1 lot orders speed up, and then you see that there's not a lot of large orders in there, and then the prints start to slow back down. There's like a stall point. You ever been up on a ladder and you have somebody throw something up to you? And if they throw it too hard, it comes into you and it's hard to catch. If they throw it just right, it's like it hangs there and you just pick it up. It just hangs there. And the momentum has stopped. It's not moving up, it's not falling. And it's so easy to catch. It feels so cool. Well, that's what I'm referring to on the tape. Is you see that accelerate, and then it's like it just stalls and hangs there. And everybody's kind of staring at each other going, stink, what now? And then it accelerates to the downside. So, Tuba Tom, tired of making money, must be nice. I get very tired of watching trades. I think trading, for the most part, has turned into something very boring. You can still get a little rush out of it, but it's one of the reasons I like talking with other people. Trading has become quite monotonous over the years. when you get a trade and it's working for you, I would rather walk out of the room and go make a sandwich and come back and check on it. And, I don't like to sit there and watch it. My strategy, I'm going to go through, just before we'll allow a final shot of questions, I'm going to detail, I talked about it briefly yesterday, but one of the things that I had to do, and you guys get your questions out, any questions as I talk, and then we'll address the questions and call her good for today. Normally the way that I would trade is I would take off a chunk of a position when that position was up at somewhere around a 1-to-1. And when I get that around a 1-to-1, that's where I'm going to start taking stuff off. And I'm going to show you an example of that. And bear with me for just a minute. I've got to find the chart. Because I'm not able to trade this week, I have a swing trade that I initiated here. And I'm giving this a 10-point initial stop. And just for the, I'm actually going to pause this just so you guys can understand what I'm talking about here. And I'll fix this when I edit this just with like a little black call out. But I don't want to put my full account number out here in a recording. This isn't play money. This is not this is not a sim account. I'm allowing this 10 points against me on this trade. And you'll notice that I've got my first target out of a 20 lot. I'm only taking off 2 of them at 10 points. And I would take off another 2 of them at 20 points. And if it continues to move, I will continue to move down. But what this would do, if I hit these 3 targets, is it's still going to leave me with 6. And that's going to be 30 points away from my entry. So when I look at things, part of it says it's got to be the perspective on the trade, on what I'm doing. And yes, I'm risking a very significant amount of money on this, but I've also made a very significant amount of money this year and in trading, and it is something that I know I'm not having a lot of trades this month because I'm working here, and I had such a big month last month that I'm like, you know what, I don't mind putting a swing trade on here and letting something really move. If it stops me out, it stops me out, and I'll go ouch. I don't really want to think about how much it is, because I could go buy a new truck or I could do this. So you know how that kind of stuff goes. But this would be a normal strategy for me when I'm scaling out of a sizable position. At a 1-to-1, I will take off a little bit of it. If I get down towards a 2-to-1 or towards a logical place on the chart, I'll take off some more of it. This 10 lot that's out here, this is, as it's coming back into this resistance area here, I want to be taking off something coming into that resistance here. And at that point, I will have something on the chart. If we get down there, I will have something to scale down, or to not scale, to trail down over as we go. If that makes any sense, when I trade this way, and I went back for the sake of illustration and took a little small account, tried to come in there with that little small account and make money on it, it required a completely different mentality, where I had to look at it and say, look, if we come into this low, I have to take the profit. I don't care whether it's a 1-to-1, 2-to-1, 3-to-1, 5-to-1. We come into that low, and I've just got one lot, and that's a chance where it's likely to bounce. I have to take the profit. And that was the biggest change that I had to make in my trading. You know, you start looking at that as a 2-lot trader. I would say be cautious. We talked about this a little bit yesterday, but be cautious coming in as a 2-lot trader saying, I'm going to take the first one off at 3 ticks, and then the last one I hope I can run for 20 points. For the risk you take, you don't get a whole lot out of that first one in those kind of situations. So, you know, I would say, to me, as I looked at the at the strategy or what I had to do, I had to come very much back to support and resistance. And if I saw the volume spike, I saw indications that it was starting to end, it wasn't going to keep moving that direction, then I just took it off. In a sense, it was discretionary, but I had to make that decision based on what was there, because too many times I was up 250, 300. I hadn't moved my stop to break even yet. It would come back and stop me out for scratch. As you guys start doing this, if you're able to scale safely with your account size, you're gonna want a strategy that allows you to get at least a 1-to-1 out of your first lot. If you can't do that safely because of your account size, I would say get a little, even get a $50 account over there at Awanda and start practicing that, because you will need that skill eventually as you succeed. That this is where the big money is. If you get something like this, you put a position on, you don't really watch it that much, you check it once in a while. If the trade works out, very possible this trade will be $30,000-$40,000 trade. That's a year's worth of income for some people out of a trade. So if you can do that, if you can gain that ability, it will over time build a tremendous amount of wealth from things. Tuba Tom, you say, what did you see in the 1224 area to tell you that the ES could retrace back to the lows? Combination of factors, and I very well could be wrong, but we've got an extended breakout without a real pullback, and I keep looking at how many bullets the Fed has left to fire this week. Could I say it's gut instinct or hunch, or I could just as easy say that. It's just my general overall feel looking at market conditions. This is too long of a time frame. You don't do tick. You don't do a tick charts or tape reading for swing trades. It's just a general overall feel. Now, it wasn't even the overall. Karen, when you asked if it was the double top that took out the prior high, I actually was in the position before it went up. I was in the position out of this consolidation, and it rallied up and came back through me again. So I was down a couple grand this morning when I logged on. So it's just it's up and down and up and down, and but I hope it helps you to appreciate the mentality that's there, depending on what you have and the size that you have, of trying to have some kind of a logical way to put it together. And this is just the way I approach it. At some point, if we break down out of this, if I feel that I'm free and clear on a retracement, let's just draw a possible scenario, and I'll tell you guys kind of what I will do with it. If we break down and hit this, I will be looking at a fib retracement. And if I look at that and say that should keep me clear and give me a little margin, I will get a stop to break even. If I sense conditions are changing as I look at it, I may adjust things. I may move a stop to break even more quickly, or I may wait. I may not move it to break even until we're clear down here into the 99 if we get down there. But I would normally tend to look at that and say, I would say until we had a retracement and a subsequent new low, I'm usually not inclined to start moving my stop in. On an intraday trade, yeah, I will move it in. I get the first target, I will usually move it in, as long as I think I can stay free and clear. That's going to be a key thing to me, is I want to be able to stay free and clear on the retracement. And if I get the break of a swing over here, that to me says, okay, that's a realistic chance. Now, a subsequent retracement shouldn't come back over that, or else it is going higher. So, anyways, I will stop with that. If anybody has questions about money management, there's a number of things you can look at. Go to a slightly longer time frame. Put volume on there. Look for the volume spikes. Look at logical support and resistance places. Use that little fib tool where you draw that out and look at it and say, is that a logical target? If I'm trying to get a 1-to-1, what does it look like visually? And then does that fit the existing pattern? If I come into the 99 quarters, I very well may take a couple more off there. I don't know. We'll just see how it unfolds and whether it's had any retracement or what it's doing. If it just tanks through there without a retracement, I probably will take off a couple more, because that means I'm going to get a retracement that may run clear back up here. It just, it's an area that I look at. But as you start looking at those things, there's a couple things that I would encourage each of you to do that nobody wants to do. Take out a piece of paper and print that chart and write on it by hand and put it in a journal. It definitely seems to have more impact than just doing a screenshot and drawing on it. For some reason, when we write something out with a pencil, it tends to stick in our head. And then start doing that math. I had a list there of trades, and I just kept a running tally of how much money I left on the table. And I left 5 times on the table what I made those first couple years. And it was eventually that logical way of approaching it, writing it down, going through it, that was effective. A couple final things I'm going to do. I'm going to shoot everyone that attended. I'm going to shoot everyone a video on coping with fear and emotions. And we've taken a little longer going through some of the things from you guys, and I wanted to give attention to your guys' questions and concerns and trades. And so I had a video that already addresses the emotions and the fear and so forth, and I'm going to send that out as opposed to taking one of our days here. And if anybody's got a problem with that, let me know. But the video probably will explain it more fluently and with less pauses and interruptions. And hopefully it's something that you can apply there. So I'll just send that out free of charge. You'll get an email which will allow you to download it. That way we can eliminate one of the remaining things I was going to cover and actually give you more information on it than you would have gotten if I would have covered it. I had a question here. See where it went. Andrew had asked before he left if we could take 2 days off of this week and then do it another time where we can do the live tape reading sessions. I am not overly, I hate to say this, but I'm not really excited about doing that. And there's still a couple things that we need to go through, but the problem I have with doing the live sessions, at least at this point, is what comes through to you from the terms of audio and video are going to be greatly delayed, and it's not what I say is likely not even going to make sense. And so if I was to do it, I would almost have to go into the mode that I couldn't broadcast anything to you guys, and all I would have would be voice. That would be about the only way that we could keep up or have speed there. And I don't mind talking about that, but rather than canceling part of this, I think I'm going to stick with the original plan. And then I wouldn't mind just doing like a trading session. See, some of the guys have planned their time and their schedule around 12 p.m. Eastern. And then if we go change the time on them now, they may not be able to get the time off of work, may not be able to be here. So rather than cancel part of this, I think we'll just stick with the original plan. And I don't mind just inviting everybody in, go through some live commentary, but it's going to be more, you've got your own time and sales and your own dome. I can put a chart up. I can put a dome up. They don't consume too much bandwidth, but the time and sales gets me in trouble. So then we can have just some voice commentary on it. And there will still be the trades. You guys look at the video that I put out today. It's going to have a trade in there that's going to be a lot more beneficial because it's going to address several of the things that we've been talking about here. And that will help you out. that was taped off of this machine, so the recording is good. We don't have the time and sales freezing up the platform. Everything's running smooth. It's on version 7. So any additional questions, give me a yes. Otherwise, we'll call her good. And I will have the video up earlier today. I had a couple things. I had a lot of emails yesterday, and then I had to get some leaves out of here. We had a big rainstorm coming, and I've got a lot of big leaf maple and oak trees around me, and I had a foot of leaves in the yard that I wanted to get off of there before before the rain came in. So, Tom, go ahead and put your question out. We'll address that. And Tom, about the only place you asked, do I watch or use the level 2? About the only place that I watch that would be on soybeans, and it's just for the reasons that I showed you today. When you can see further down into that on a market where they're using it that way, they know the other guys can see them, and they're putting it out there ready to go. Yeah, Casey, that's better than a foot of snow. I actually felt like I was shoveling snow because it just kept swirling around in the wind and making a mess, and it reminded me of that big snowstorm I had in Colorado a couple years ago where I had 7 feet in the driveway, and you just finally just look at it and go, forget it, there's no point. So it was definitely the most leaves I've ever seen. I haven't had that many trees around before, and for some reason, even though I'm up here in the Doug fir and the cedar and the area right around the house has got a lot of oak and maple, big leaf maple. So huge mess. Yeah, I wish I could brush it in the street. The problem, I got about half an acre covered a foot deep, and if I pushed it into the street, you wouldn't see the street anymore. So, well, guys, I'm going to quit there. Like I say, I will get this up earlier today. It should be to you within about 4 or 5 hours, depending on how fast it uploads. And we'll be back at it tomorrow at 12 Eastern. You bet, Pete. I got your email there. I just glanced at it. That looks good too. Yeah, Gerardo, that's what I was saying. There will be about a half-hour trade on the end of this video. It'll be about half an hour of. It's going through pointing out some of the key things. It was some material that I actually went through with a couple of guys, and we were talking about that RSI fade, which I guess we were going to touch on today but didn't get to. So the RSI is on there, and I'll explain quickly the reason that was on there and what I was doing with it. But there's going to be I think the trade was like 28 minutes, and it goes through some of those concepts of seeing the changes in the momentum, seeing the one lot guys disappear. And then there was one on yesterday's video as well. So if you didn't watch that yet, take a look at that. Appreciate all the comments, guys. I will see you guys tomorrow afternoon. I guess tomorrow morning for me, tomorrow afternoon for some of you, depending on where you're at. And we'll talk then. I'm kind of watching this right up here, and as we came up in, you'll notice that we had a lot of sellers had jumped this at 17s, and there were some buyers there, but we had some big size has sold this at 17s, and I'm kind of watching this to see. It kind of looks like we're hesitating here, and when I look at the RSI, the levels that are there, and let me just expand this over for just a second. This has gotten up to the level where we were earlier this morning that stopped the advance, and I've kind of been watching that. I didn't have the line drawn on there, but I'm watching the price action right here, and we got through the 17s, but I'm trying to see if we still have some sell interest here. And I think what I'm going to do, I'm sitting pretty good for the day, but I don't want to completely blow that cushion. I'm being a little more cautious with it because I don't want to take half of that and give it back. But I'm looking at this, and I want to see if we're still getting the sell interest. We've had a couple hits up here again, and we had sellers really jump 17s, and I want to see if they're still there. still willing to knock this back. And so I'm going to just kind of watch here, see if I can pick up an entry, and uh, probably right in this area, see if we can get a short on right here. So we still have some interest. We got 17s were hit, 17 quarters are still being sold, and I think I'm going to go ahead and just put an order out here at 17. So I got filled on that tin lot there, and the stop. Really, if it goes off over the 18, I'm probably not going to be interested in it. I'll go ahead and just give it. Nah, I'm just going to leave it there. I know it puts me right at the high, but 5-6 ticks over the high is still in jeopardy, and at this point, I don't want to be putting a 20 tick stop on this just to try to hold it. When I look at the price action that's here, we have overall, we're still down, but we have been trending up. But we kind of got to the upside of this, and when I look at this from a complete chart perspective, we could do this a couple ways. But we look at this at the upsides, and we're right back up to those extremes. And so I'm getting a short right up here. My stop, and I guess my stop is actually at 12 ticks. The stop should be well out of range. If it goes on through this, then this uptrend channel is going to get violated. Now, what I'm going to look at to the downside, I'm going to go ahead and take an order, put it out here. And I think what I'm going to do is I'm going to put part of this out here at 15. And if that steps back across, that ought to be right about our trend line there. And then I'll just kind of keep an eye on that as we get over to it and see what it does. I think I'm going to go ahead and just put another 2 lot right here, right above this trend line. And that way, because we're in a fairly narrow channel and these little swings, they've been going around 5 points. But if we come down into here, I will take off the bulk of the position. And then I've got that'll leave me 3 lots down here at 950. And I'll just kind of manage that as I go and see if I can pick that up. But again, the reasoning on that, we did hit an overbought level. The trend line, I was kind of watching the lower part and the upper parallel to that. We had come right up into that, and I probably could have got a couple points improvement if I wanted to, but it's still relatively high in that channel. This gets us a target down in here by the 618. And then right into this trend line, and from there, if we get a breakdown, that might look real nice. When I look at this overall, we are kind of up for the day. But if we get down here and somehow it broke, this thing, lot of room that it could move to the downside if it gets down below that 11. We had some buyers jump back in this, and some pretty good size bought it up through 17s and 18s, and then coming into 1750s again, we have somebody stepping in. We got some sellers coming right back into it, and you can see that along with these big lots, there's a slew of 1s and 2s and 3s. So you don't want to see it get almost down to your target and then come back against you and stop you out. But bottom line, I'm going to just leave that where it sits for right now. I am encouraged, even though it's not a lot of sellers yet, I am encouraged that even with all of this buying, some big size was willing to step right back in and sell 17s again. We saw that 159 lot, I believe it was, and a bunch of size that was sold right here in 17s the first time. We saw it sold again when I came in, and now for the third time we're seeing some sellers nibbling at it a little bit. And I kind of, obviously I'd like to see more size jump on it than that, but you have to say, for all of this size that just bought, from 16s all the way up through 18s, they just ran it right back into a wall, and sellers immediately pushing it back down. So that's kind of promising. If this just kept on going and was poking 20s or 21s, it's a completely different scenario. We do have some divergence here now, and I'm not looking for things to support this because I am in the trade. But you have to say we've got that divergence on our price and our indicator, and we're still seeing sellers coming back into this from 1750s, chased it down to 16s. They're still selling it. So, it does bode well for the trade, even though we're fighting the overall day and we're fighting the trend of the moment. Um, we ran into an area where it seemed to get really jumped and hit, and now we're starting to see that come back at it. There's no more buying right now. Here's a 229 lot. Somebody took some big size on the buy side. We'll see if they get anything for it. Realistically, it looks like they hit 50s and they can't even hold 50s. Over here, looking at that on our dome. To take that kind of size at a level and then not be able to hold it, you want to see them get some results if they're gonna do something with it. And now we got this situation where nobody's stepping in here. And this is what I've talked about with horses. You watch these first orders that come in, and you see it come in small, and then it firms up a little bit, but nobody's really hitting it. Okay, now they're canceled or taken out with this string of prints. So now we've got the offer has come down into that same space, and you watch and see, does somebody hit them? No, they actually took it down and hit 16s. And so you're kind of seeing that when the 16 quarters came back offer, the buyers did not hit it and push it back up. We watch it again here with size. Do the sellers keep putting it to the 16s, or do the buyers come back after the quarters? Right now the sellers are still trying to take it to the 16s. They didn't hold the level, but again, it wasn't big size coming through. It was just 1s and 2s and 3s, but they're coming right back after the 16s. Kind of we're in a trade, and I'm not going to change what I'm doing based on things in the trade now. We get these big prints hit 16 halves, 16 3/4. Can they hold 3/4 or not? Anyways, like I was saying, I'm not going to change this based on what I'm seeing right here, but it's just to comment on the tape or the dome, either one at this point, just for educational purposes. We had some sellers came in at 1750. Didn't take a whole lot of selling to knock it down 1.5. Now we see a whole lot of buying, and all they got out of it is 1 tick. Same thing down through here with all of this buying. They finally pushed it up to 18s, and immediately we're right back down trading 16s again. So you can kind of see this balance, even though it's red, green, and right now it's more green. For all the buy orders that are going at this, they're not getting much out of it. We've got some size coming in here now on the 17s. We want to see, do they hit them if they start printing 17s, which we just had 1 lot print there. Do these guys pull? If there's a sizable buyer, they'll try to hit that 407 and take it out. But if nobody hits them and they won't pull that order, you're going to have to say things right now are looking like it could be pretty toppy. Kind of watching these levels up in here, because if you get a bunch of cancellations, like if you get 30-40 lots of level cancel, like they pull their orders, you're probably going to see this thing pop right through my stop. But if they don't start canceling, right now the sellers, even though they're not putting a lot of effort into it, they seem to be holding it here relatively easy. All the buying that's gone off has not got through them, which says there's some size here which is absorbing those orders. They got 17s for just a moment was the offer, and not a single print at 17s. So even though they cleared the 16 3/4, they can't hold it. When they come into that type of scenario and they can't clear out a very light offer and hold it, it says that the buyers are kind of weak, even though we've been running up. They just don't have strength right here. And I'm just, what I'm watching now, I want to see as we start to push, does anything change? Does the momentum change? Does something shift there? If we get another big flurry of buyers, the thing I'm going to be watching is where do they get with it. If they can only get 2-3 ticks out of this, with a bunch of big buy orders, then I think we've got a good trade on here. If they just push it back, knock it right back, and get through 18s, I'm going to get stopped out if it goes through 18. I almost think on that basis it's worth just bringing the stop down to 1850, because realistically, if we get through 18s, which capped us here, I think it's going to get me just as well at 1950. So I'm going to just save myself a point there. It's kind of the risk on it trim $200 off the net risk of the trade at this point, because what I'm seeing, the sellers are absorbing it pretty decent, but I don't want the buyers to take another run and really get out of control with it. The sellers need to get a little more aggressive. They're absorbing everything, but they need to get more aggressive if they're going to take this down lower. Okay, so we really got hit there. A big flurry came through on the sell side and got our 5 lot. That move also got the stop to break even. And I'm going to go ahead and just leave that 2 lot there. It is right where we're coming into this uptrend channel, and I'll see if we get a bounce there. And I'll just leave my, I've got half the position taken off. I'll leave the stop at 17. I'm going to leave this here at 1450. And then the 0950. I'll just drag this out for a moment. And as far as targets go, I'll probably keep this in mind if we get down there. Now that's still got me right between the 50 and 60% retracement. Okay, so I just got hit on the 2 lot, so that leaves me with 3. I think I'll just leave that order where it sits for right now, and I'll deal with it when we get down there. Sometimes I move it away, but we have been in an uptrend. It's gone sideways. If we get down there, you don't want to get 7-8 point move and then have it come all the way back and stop you out. So I'll see if I can trail it down over something if we break this. But for right now, I've taken off 7 lots at 10 and 12 ticks. If we do bounce back through, I would just about still have to leave my stop up here at the high to try to protect that trade if we stay in this channel. So I took a little more size off than usual fairly early, kind of on that basis, is that I know I'm fighting an uptrend channel on an up day. And, if it cracks here, I guess we've got to get through 13s first of all. And if we get through 13s, then a retracement back up here would be, that stop should be fine. Just put this back over here. The interesting thing with this move down, there still have not been any real big sellers to speak of. When you compare that to the buy side, it's definitely the big sellers are not here. Right now, we had a few down through 1650, 1475s, but bottom line, it did not. It was mostly 1s and 2s. That flurry went through so fast, I really didn't get to see it. And I may stop and just put this through frame by frame and actually kind of see what went off in that big flurry that took out the 5 lot. Because this just went completely blurred and it looked like it went down a couple screens worth. But that being said, there was not a lot of big size in it. Could have been a bot there because it printed exceptionally fast. It very well could have been a bot or a sweep order where they told it to just sweep 4 or 5 levels because it came through so quickly, on this push here, and yet it did it without any big individual orders. We do have some buyers. Here's a couple nibbles at the 15s. It very well may bounce it off of here. We've come back down to the level that it's bounced from. And a lot of times I think a guy could make an argument to say, hey, it's at this level. The RSI is kind of confirming that we could see a bounce in here. I could see a guy saying, you know what, I'm going to just take it off right here, reverse to a long, see if I can get a long trade out of it, or saying, if it does break, I'll short the next retracement. I could see either philosophy. I tend to, once I'm in a trade, I tend to try to get it down to some kind of a logical conclusion, but I usually like to get runners. And I've taken off 7 lots already right at this price. So rather than take off the rest of the position, I'm going to see if I can pick something up, and I'll just sit on this for now. So we kind of saw that push coming back up pretty close to our stop here. There's definitely been buyers all the way up from where we saw that 48 and 56 lots. Down here, they've pushed it back up 2.5 points. So if a guy would have taken that as confirmation and said, hey, we're at a trend line, we're at an RSI extreme, and we just had 2 big prints come in, you would have just got your break even and your first targets right there. It still would have been relatively easy for a guy to come in, because if you look at this at these prints at 15, the next prints were down at 1450, so you could have still gotten filled very easily at 1450, 1475. There was no rush to that. Very easily gotten your 10 or 12 ticks first target, and got a stop to break even if a person would have played that. I see the trade, like I mentioned earlier, a guy can look at it several different ways. I look at it and say, I like this breakdown. It just broke this swing. It broke down clear to the bottom of the channel. And if somehow we can hold on to this right here, we're right around a 60% retracement. If we can hold on to this and get a rollover here, it'll be a nice trade. If not, it's still a profitable trade. And, got 7 lots at 2.5 points or 3 points, depending on which portion of the trade it was. It's kind of interesting what's going on here. If you look at your large tape, nothing has changed really. We still have not had much of any size at all selling. The group of sell orders here at 1056, well, that was back up here, at 16 and 1575. And since then, we've had no selling, and it's all the way back down. The 1s and 2s have really been running this thing today. Every time we've had all of this buying, it's just the sellers absorb it, and price just keeps on moving back. So this may turn out to get a little juicier after all. We're kind of trying to tease outside of that channel, and I think if we can break the 14s this time and get through the 13s, then we'll probably come at least down here into this 1050 and test this low. Okay, so we got some sellers that finally are stepping in right here, and you can see that these sellers are coming in and hitting it right as it's breaking this pivot. When we look at the overall, the grand scheme of things, it's not a super significant level. It's kind of been wallowing, but it really is. It's showing us a higher highs have stopped, and now we've got this lower high, and now we're just breaking this low here. So I'm going to get rid of this, which was showing our divergence, and this channel, I'd have to say we're breaking out of that channel. What I would expect to see, and I'm going to leave the lower one there for right now. What I would expect to see, if we can get down in here to the 38 or something of that sort, if we get a bounce back up to this level, I would want that level to hold it. However, that's so close to my stop, I still don't have a whole lot of place to move my stop. I mean, if I brought the stop down in here, I put it at jeopardy right away because it's just 3-4 ticks. It's really not moving a whole lot right now. If I put it here at 1650, it really doesn't do me any good. I don't have that much of the position open. So I'm just going to leave the stop at entry at this point. We'll see if we can break down through this. We'll just jot these levels down. We'll mark this here. I tend to remember these things in my head. And, we've got the 0775 here, give or take, which is where our 618 is. If we can draw this thing, can never get a straight line out of these. Okay, just like we talked about, even though we didn't move a whole lot lower, we got that little retest right back up to the downtrend line. Was about just a little less than half of the move down that it retested. Now we're coming back into new lows. I really want to see it get through the 13s. We're finally attracting some sellers down here, which is kind of interesting that we haven't attracted much for big size on the sellers all the way, but the big sellers have been there in the ones and twos and in absorbing all these market buy orders, and we're not seeing the sellers cancel orders and back up. Anytime we're rallying, these guys are staying put. They're not pulling orders and allowing it to explode upwards. So I think for as slow as the market seems right now, we actually have there's a pretty good battle going on where the sellers are not willing to roll over. They're not willing to come in aggressively and sell it, but they're not willing to roll over and just let the bulls have it either. At this point, I'm just gonna go ahead and move my stop down. I'll just put it up here above this at 15. I'll lock in a couple. If we do get a retest, lock in a couple points on those last three. Well, we're pushing it down here. We got some buyers finally attracted down in the 11s. They're pushing it up a little bit. It probably would not be a horrible move just to take it off right here. I'm kind of mixed emotions. For as big as the move looks on the chart, realistically, we're only 5 points away on the NQ, which is not that big of a move. I mean, we're only talking $100 a lot, and look at this chart. I mean, I could definitely see it bouncing out of here. I think what I'm going to do, I'm going to go ahead and just move the stop down a little more. I'll move it down to 14, lock in 3 points. I don't want to completely choke this off, but I'll see if we can get through that low. Okay, so I've got, I hit the target there, and I was not paying that much attention. I had a phone call come in, and I had to take the phone call, and I didn't move it away. Sellers have definitely clobbered this thing. You know, they really finally came in at 12s, pounded it down to 10s, took it from 10s, punched it down to 8s. You know, we're down to that 618, and it very well may bounce there. I wish I would have seen that. You know, I had one eye on it, and then I was talking on the phone, wasn't paying as much attention as I should have, because I think I would have probably moved my stop and, moved my target down and see if we could get a little more out of it. But that's the way it goes. It's closed. I think what I'll do, let me just stretch this back over. I guess in that that trade was just right at right around $700, all said and done. I'm going to go ahead and pull this back over, and I think what I'm going to do is just switch this to a I think I'll just switch this to a 5-minute chart real quick, and we'll look at it again on the basis of a 5-minute and see if it's anything we would have taken. That being said, one thing that I will point out, and let me just turn on my chart markers. We had the, I'll turn on my screen draw here, which kind of freezes stuff up, but we had the short entry up here, and I want to reinforce kind of what happened here. I didn't take that first push, even though size jumped it. I actually let it pull back a few ticks. I let it come back up into it again, and the sellers were still there, and that was when I went ahead. And just offered it out and let them hit me. Kind of, you know, I wasn't super aggressive on the entry. Started off positive, took a couple ticks of heat, you know, got about a point against me there, which was not horrible, all things considered. And then I got off 5 lots here, and then got off 2 lots here, which, as you can see, was right on that trend line. And then from the 17 entry, I got, with the remainder of the position at 950, you know, got 7.5 points on the rest of the position. You know, the overall risk, once we got in the trade and it started to move, you know, we cut it down, very minimal risk. You know, I think it was risking 6 ticks there, 7 ticks. And ended up with a very favorable risk reward on the trade. My overall initial risk, with a 12 tick stop on this is $600, and ended up with a $700 gain when everything's all said and done. But that initial $600 risk, tightened up by $200, so really only had $400 risk. Ended up with a $700 gain on the trade. Let me just get rid of this, and I will look at a 5-minute chart real quick. This is kind of what we're looking at here on a 5-minute chart, and I'm going to just put my screen draw on again. These trades over here, this was my earlier trades this morning with the, I guess when we were in the room, but this is where we're looking at right here was the short. You have to say, it's fairly bullish looking chart. We tested the downside, fired straight up to highs a day, pulled back, based, started working higher, and I was shorting this right as it broke out. And I really do like those kind of failures. I do get stopped out from time to time like anybody, but bottom line, that's trading. But I like that when I can confirm it on the tape. This trade, who knows where it will go at the end of the day. We may sell clear back down to the lows. It may come here and bounce up and retest. We really don't know. But I have to say, got a very, very nice move out of it that at the time seemed very unlikely. The thing that we had going on was a definite uptrend, and that uptrend, our entry up here kept us safe, even though that was all we could realistically expect at the time. When it subsequently broke down, that move kept us safe and was able to capitalize on it. So I would call that a winning trade any day of the week, and again, on a 5-minute chart, it's not something that I would probably be looking at an entry right there, but definitely an effective method to be watching it with this. Hopefully this helps. If you have any questions, contact me here, and I will be happy to try to answer those for you. Well, good morning, everyone. Hopefully we have sound here this morning. Had a little bit of difficulty with my mic. If you could give me a quick yes if you've got sound. Everything sound okay, sound clear enough. And I noticed the one day on the recording there was a little bit of background noise, and I had on a pullover jacket, and that had a zipper up where the cord from the headset was rubbing on it. So I promise it wasn't me with gas. I'm not wearing the jacket anymore, obviously, but apparently the zipper was rough enough that it kept making a little repetitive noise as the cord rubbed on it when I moved. So looks like everybody's got sound here. Well, coming up here, day 8, and we'll see what we can do today. Try to start wrapping things back up. I got couple questions that I'm going to address out of the gate here, and again, we've got a few people that are not in yet, so I'll just address a couple quick questions, and we'll let everybody else filter in, and then we'll get going on our main topic. One question, well, I guess I got another question just came in. Jim asked what I did on the S&P trade, if I was still in that. I'll just put a chart up real quick if I can find it here. Give me 1 second. Trying to get everything turned on and functioning, and the trade, I am still in the trade on the S&P. I did get my target down here at 9.25, which was 10 points. I do have a stop here now at 19.25. That broke down far enough that at this point I'm not going to give up money on it if it comes back. The trade just missed my 20-point target. I think it got down 17.75 points. And I don't really like what it's doing, but that's the way trading goes sometimes. With a nice breakdown like that pre-market, I would rather have seen it keep on going and get a little more momentum out of it. But that's where that one sits. Let's see, Andrew, your question, you say over the next 2 days, did you receive any consent from other folks? Are you talking about like anybody else that wants to share their trades or has specific questions on their trades? Oh, I understand, Andrew. Sorry. As far as scheduling the next 2 days, for some real-time tape reading. I thought about that and I addressed that at the end of the video yesterday, and I guess I forgot I was going to email you directly, and I did not get that done by the time I finished answering emails and editing yesterday. Um, no, I'm not going to do that, and there's a couple reasons why I'm not going to do that. We have several guys here who changed work schedules and kind of reordered their life to be able to come in. And I don't want to just say, hey, we're gonna just change it midstream now, and you've already got the time off work, and now you can't be here. And so I don't want to be unfair to them. I don't have a problem putting a day or two out there and saying, hey, if anybody wants to show up and can show up at a different time, let's trade together for a day. That's not a problem, Andrew. I definitely don't mind doing that. But as far as changing the time around on them, because they've already made the commitment, I don't want to change that around. They were fine for taking one day, trying to get together for follow-up questions or something so that they can play with things for a couple weeks and then come back. But as far as just scrapping a couple days of the presentation and then trying to do it at a different time for them makes that kind of difficult. So I would rather just say if anybody can make it and wants to show up, we could take a day, just show up at 9:30 Eastern instead of 12 Eastern and do that. So as far as real-time tape reading, I don't mind putting it up when we're done. If anybody can stick around, they can stick around. But I'm not going to put this into the video or into the recording if we do that. We're already getting up there over 5 or 6 gig. Some of the sessions, when I go to AVI on this, it'll probably end up being around 10 gig. And the problem with coming in trying to do that right now, Andrew, as you're aware, the market's already slowed down. Tape is not like it's going to be at the open. Ken is telling me there's a second rule that he didn't tell me about with the GTM, with the get the money trade. Second rule: when you see 10 grand on the table, take it. After that rally back up, that's what I kind of felt like. But I kind of thought it had to go try 12s again, and I didn't want to see it fire up in one straight shot. But that's kind of the way it goes. Gary, your comment, you says you didn't receive an invitation for yesterday's seminar. Is that for the recording, or let me know there? If that was for the recording of that, I'm not sure. As far as the other emails that go out each day that remind us of the webinar, that's something that is sent out automatically by GoToWebinar. I don't send those out. GoToWebinar automatically sends those out each day to everybody that's registered. So I don't know what happened there. I know I received one yesterday, but the same link will work every day. The link that you have will work. Yeah, I have no idea, Gary. I actually wish it wouldn't send it to me, because I know about it and it's reminding me over the weekend that I've got meetings and so forth, but I actually do not send those emails out. I have no idea if anybody has been receiving them. I know I receive 2 every day, one reminding me that I'm supposed to start it and one reminding me that I'm supposed to attend. Appreciate that, Ken. Thanks. Hopefully it ain't over. I would like to see it kicked back here at 12 and take another push down. I hate getting that close to a second target and then having it come back all the way through where my first target was, but that's the way trading goes. The other question, and this is the one I wanted to just address, this question was regarding what we were talking about on the soybeans yesterday. The size that's down there, the question that I was asked via email, is they still don't understand if that size is real, why they shouldn't go buy there. And I'm not going to spend a lot of time on this, but let me put up a time and sales. I'm sorry, not a time and sales, a DOM, and let's get a level 2 over here real quick. It's not visible all the time, but we've got another large commercial is in here working right now. You can see them at 22 3/4. Here's just as simple as I can put this, and as simple as I can make this. When somebody comes out here in this market and they put that size there, they are trying to flag in sellers. They're not trying to prop the market up. They're not trying to hold it here. They're not trying to get people to step in front of them so they can short through it. Pure and simple, they are trying to flag in a seller and say, here I am, come and get me. And so if we see this at 2 or 3 levels, if they get down here, like you can see this right now, they're getting down here and this guy's not pulling. I've got my time and sales open here. I could drag that over here, I suppose, into the window. But if you were looking at the time and sales as it comes down in and starts printing him, 2275s, you see the 2275s printing, 10 lot, 11 lot, some ones, 16, 19. He's not pulling. He's just sitting there for real. He wanted to be filled there. So if that's the case, he is trying to flag in a seller. And if we saw him down here 2 or 3 levels lower, he's going to keep trying to flag in that seller lower and lower and lower. I have wondered about it to some degree if they have communication that says, look, I'll do this deal with you for 100,000 tons, but I'm going to be taken off my hedge. You've got to come get me. Because when you watch it, very frequently that market will come down there. And if that seller is there and they were within 3 or 4 ticks of that price, they will work him down, come all the way through him, and take him out. And I think, that was too easy. So I wouldn't be surprised if somewhere as part of their deal, he says, okay, I'll do this, but you've got to get me out of my hedge here at 2250s and down to 18. I don't know. But I wouldn't be surprised. But as you could see right there, and I don't know how smooth it's coming in, as you could see when you look at the time and sales, he was printed for every bit of that size he had out there. So that's why I don't come down there and buy with him. If he's down here every cent, which he's not at this point, he just had one order out there. But if he was down there every cent, that seller's going to keep taking it down and down and down until they've got their deal done. So that is as succinct as I can make it. Normally you would say, yes, go with the size, but this is not that type of a situation. He's deliberately signaling the seller and saying, come and get me all the way down here. Okay, let's see. As far as questions, I think that catches us up for questions. Take a quick look at the disclaimer. We're going to be talking again about some hypothetical things today on charts. You guys are obviously aware of that by this point, but I put it out there every day anyways. A couple topics that I'm going to get to today. And as we get near the end of the scheduled materials, I would like you guys to be able to come in with any questions that you have that you would like to be covered tomorrow. Send me an email on that. So anything that you think you would like to see covered and wrapped up. I do have about an hour summation that I'm going to try to put all of this stuff back together. And I would have done this Friday, but if we're going to, we kind of already voted on taking one day for doing a follow-up day. So any questions that you would like to have covered, we'll cover that tomorrow, and then we can take a look at it. But for today, here's what I would like to stick to. The ability to gauge price action. I have felt that in my trading, whether I could read the tape or not, if I had to trade off of a chart, it was the same thing when I traded off a chart. It was the ability to gauge price action and where the market was going and where the momentum was. And I have struggled for as long as I've worked with people to try to teach people something that I sense or that I feel, because that stuff is not easily conveyed. Some of that came from many years of watching. So I tried to find a way to show people what got me there, how I went about doing this in my mind in a way that they could duplicate. And ironically, as I did this, it ended up being something that was very effective at helping people break away from indicators. We've got several of you guys in here that are trying to do the same thing. You're trying to get away from the indicators, trying to get a sense for where the price is really going and what's really happening in the market. So I want to spend a bit of time going through this. Some of you guys already have the video on the RSI fade, and most of you don't. So I'm going to go back through this, and the reason I want to go back through this with everyone, I do find that ironically, even though it's using an indicator, it's using an indicator differently than you would normally use it. And it has been very, very effective at helping my clients get a feel for price action and finally being able to break away from indicators. And so that's why I'm going to go through that. So bear in mind, I see the hypocrisy there in saying I'll teach you to get away from indicators by showing you how to use an indicator. But you'll start to get the point, and it will start drawing your attention to the price and the price action, and eventually you'll find you don't even need the indicator. And you guys saw that in the 2 tape trades. By the way, let me just ask, were you guys able to review those trades that were on the videos from the last 2 days? Okay, looks like several of you have. If you haven't, there's lessons there in those 2 videos that will re-emphasize those 7 points we were talking about, the things that that you see on the tape. And between those 2 videos, and Andrew, I don't know if you've been able to watch those yet, but between those 2 trades, there's about 50 minutes of sitting there analyzing it, going through what's happening on the tape. So even when I get in the position, it's still spending that time analyzing it and showing it on a moving market where you can see it. Okay, Andrew, that'll probably help, like where you're wanting to see this as opposed to just a drawing on a screen, which I understand the frustration there. As opposed to seeing a drawing on a screen, you want to see it happening on a moving time and sales, and there's about 50 minutes of that on those 2 videos, and they are indexed into the table of contents, so you'll be able just to skip right to the trades since you've been here for the sessions. So no problem. Okay, so let's Ken, you've got your question. Please review your thinking that got you in the ES trade. You know what? Let me put on. I actually was fiddling around with this. I'm going to just turn on the chart markers, and I was actually fiddling around with this and had been short into the 1179s and got up significantly at 1179s. Doing the same thing. It kept running into the 80, 81 and rolling over. And I eventually stopped out on that at scratch on the trade. I got a couple targets and stopped out at scratch. I came in and was looking at resetting that again, moving up into that level, and this was actually trading back on November 3rd. And this was kind of late night, overnight. Took a one-shot trade, got a point out of it. I was just taking a couple scalps, put some money away for the month. I try to trade every month. I don't like to take a couple weeks out and not trade. Took a second trade. This was just all in, all out. Took a second trade, got stopped out on it. Took a third trade, got a target, got stopped out. And I've kind of been nibbling at this as it moved up, because when this blew out of there, I kind of felt like it was coming to an extreme level. And as we came back up to the 25s, we had moved far enough. If you compress things down, we had moved a considerable distance up out of this base without a pullback. And so I kind of messed around with it. I hit it a few times, did a little in and out, and I kept watching it. But it was actually over in here that as it pulled back on an hourly chart, that was where I went ahead and put the current position on. My thinking at this point, a lot of my reasoning behind this trade was daily chart and 60-minute chart and a swing trade basis, that it had gone so far without any significant pullback that even a little 25% retracement made for a very, very, very lucrative trade. I mean, if you take this to a daily chart, Ken, and again, it's just part of my thinking. It's probably as much feel and gut instinct and as it is rational or scientific or anything else. But if you compress this down and look at this on a daily basis, we're finally breaking above this resistance. But if you took this and this line, I don't know, I think I drew it on there at some point and it didn't hold. If you look at the uptrend that's here, it has moved significantly away from that. But through this whole range, there had been absolutely nothing for a pullback. So you start looking at that from the standpoint of a fib move up, that even getting down to a 38% retracement, just a shallow retracement, look at the size of the target that's in there. You see the money that's on the table. I mean, there's 75 points away just to get to a 38% retracement. And so I look at that and say, will I still be in that trade if it breaks? Would I still have something left in that trade if we rotate all the way back down to 1100? The only thing that would prevent me from that would be this contract expiring. I actually thought about taking this in the March contract, but the March contract had absolutely no volume. But I honestly, that was, I weighed it back and forth when I took the trade, and I just about gave up a couple points and put it in the March contract. Because if we do get those retracements, 100 and a quarter point move, to me, it's worth taking a couple nibbles, risking 10 points here and there, seeing what happens with it. So that's kind of my thinking. I'm looking at a much larger picture, and I say, if I put this on there and we do get some kind of a breakdown, I will have locked away. If we get down to this target, I will have locked away $25,000 and still leave me with 6 lots, and I can stagger that out, take a lot off at 1150, take a lot off 11 quarter, take a lot off at 11, and just see if we get a rotation back to that trend line. So that's about as scientific as I get with it. It's not, I can't tell you that there was a candlestick pattern or a news event or anything else there. I'm just looking at levels on the chart. We broke the high by a little bit. They got through enough, if I turn the chart marker off, chart trader off. I don't know why my Ninja is not wanting to respond today. Keeps locking up on me, doing some weird stuff. Ken, I like your comment. Okay, forget rule number 2 about taking the 10 grand when you see it. That's pretty good. That's rule number 3. Ignore rule number 2 if you see more than that on the table. So, Andrew, and you're mentioning that's also a retracement on a weekly chart. I wasn't looking at a weekly, but yeah, there's probably a number of things that line up there. Yeah, rule number 1, the 1,000, that was 4 ticks, and I thought about you when it went 4 ticks positive right away, and I just said, oh well, I'll ask for Ken's forgiveness later. So, well, let me do this, guys. I've got my my Ninja is acting kind of funky this morning. So I'm going to shut down the Ninja and restart it, and concurrently with that, I'm going to go ahead and take the recording and just save that first one and get it out of the way. So give me 5 minutes. We'll get going on that and get back to our discussion. Okay, we'll give this a try. I've had some goofy stuff going on for some reason with the computer this morning. When I did a reboot on the computer, hadn't rebooted it for a couple 3 days, and when I did the reboot, it told me I was missing some DLL files. So I don't know what happened there. Have to check up on that later. So I don't know if that's what it is, but got just a clean workspace here on Ninja with one chart. So we'll see if we can get this to go. I'm going to end this. Basically, here's what we're going to be talking about: gauging price action, breaking away from the indicators. So I'm going to end this here, and then we're just going to work straight off of charts today. When I think about the markets, I look at the markets as being something that I think that most attempts to quantify it get too stuck in one position that may or may not be true. And I think there's probably aspects of truth about a number of different theories. I look at the market, and I do think that the market is probably fractal to a degree. When you have guys that come in and try to apply fractals to the market. And by fractal, what I'm referring to, if you're not familiar with that term as far as the market goes, would be that what you see on any time frame will repeat on any other time frame. You could look at a yearly chart, a daily chart, a monthly chart, a weekly chart, a 5-minute chart, a 20-minute chart, a 17-minute chart, whatever you want to do. And if you didn't know what your time axis was showing you and you didn't see what your price axis was showing you, you couldn't tell what the chart was. It would essentially look the same. And I do agree with that. And I think you guys probably would see the same thing. It doesn't matter what time frame you look at. When you're looking at candlesticks, you see the same exact thing over and over and over at any time level that you want to drill down into. So I look at guys that have a complete fractal theory and I say, yeah, there's a lot of sense to that, but I don't know that it's absolute truth when it comes to the market, and I don't think anybody could prove that it is. I look at guys that are into, the random walk theory, and there's some good arguments there, but again, you could make some good arguments that that's not the case because things do tend to repeat so often. I look at the lines that we drew earlier, as random as you could get, and it looks like you predetermined that and deliberately drew it at those places, but it's just random, and it will work that way across any market you look at. So in some ways, there is a sense of randomness to the market. I look at chart patterns, and you guys can bear this out. You'll have chart patterns that you like, and it seems like they're working great, and then all of a sudden you couldn't buy it. You can't pay it to work right, and it just quits, and then all of a sudden it starts back up again. And the market, I think, because of that, is kind of difficult to quantify. I really think that bottom line, over the years of trading, I've come up with a couple things that I really do hold to be true about the market. And I do think that in part, that is why I've been successful with it. And so I want to talk about that just for a moment, the way that I view what I would call the actual structure of the market. And you guys could argue it against me. I don't suppose a whole lot would change my mind about it, because I've made money with it for 10 years. And I look at it and say, guess what? It works. So even if I'm wrong in the explanation, it works. So I obviously am willing to admit that I've been wrong in explanations of things, just like we saw with the, what the CME tick change did. Explanation that I understood was wrong, but I still read it and I traded it and I made money with it, even though I didn't understand exactly what it was showing. I still saw the tradable pattern there. So when I look at the market, you'll find camps of people who have different viewpoints of what the market is. Some people, it's supply and distribution, and supply and demand, and others it's accumulation and distribution. And there's a lot of different ways of trying to quantify that, and you could shoot holes in any of those arguments. One thing that I have found on markets is that at any time frame, no matter where you go, long-term, short-term, swing trader, investor, scalper, you have waves of price movement that come into the market. And when I talk about waves, I am not an Elliott wave guy, and if you ever find me 3 Elliott wave technicians that can agree in the current moment, right now, and you've got to place a trade going forward, what wave are we in? You find me 3 of those guys that can agree, and maybe I'll subscribe to their theory. But they can't agree until it's all said and done and it's historical, and then they can look back and agree, okay, this was wave 4. Now we must be in 1 or A or whatever we are. So when I talk about waves, I don't think about this in the sense of Elliott wave theory. But the analogy, and some of you have heard me say this before, when I look at the market, it reminds me of walking down the beach and watching the waves come in. And we know one thing, we'll go out there and the waves will be coming in. It might be very still, but they'll still be coming in, rolling up a little bit on the shore. It could be crazy and violent. It could be anywhere in between. But we know if we go to the beach and we walk down the beach, we're going to see waves coming in. And at any given point, you could say there, in a sense, there's regularity there because it will push up onto the beach and then it rolls out and it disappears, and it pushes up and it rolls out and it disappears. But the irregularity is you just don't know. You could be 30 seconds between, you could be 2 minutes between, you could have big violent waves, little tiny waves, but there will be something there every day. And in a sense, that's the way the market is. There's always a pushing back and forth, back and forth. Sometimes it's violent, sometimes it's slow. But one thing you can be guaranteed of, there will always be some type of pushing back and forth. Well, if you go back to that thought of walking down the beach, when you're actually on the sand, any of you that have walked down the beach know it's easier to walk in the wet sand where it's packed than it is to walk out in the dry sand. Where you feel like you got 100 pounds on your shoulders trying to walk through it. You can sit there in that wet sand and you can watch the waves coming in, and you can judge the height of the wave and the speed of the wave. And you may have to go a little higher on the sand, or you stay where you're at, but you can judge very accurately where that wave is going to end up. And once in a while you get surprised, you have to jump and run real quick or you get your shoes wet. To me, that is exactly what the market is. And the reason I view it that way is that we can always get a feel for the momentum and the pressure and the speed that it's coming into us. Some people may not be in tune with that. Maybe it's difficult. I have always been relatively in tune with that. Why am I taking the ES trade where I took the ES trade? It's probably as much that as anything. There's just a sense that I feel about it, a feeling that I have about it. That this point, I can see a sticking point in my mind. I can see the change in momentum. To me, I step at that point and say, I could risk some money here. Have the potential to make a lot of money here, and let's see how it unfolds. Let's see what happens with it. Well, I don't know, if that makes any sense at all, but when I try to come down and find a reason that I've been successful with what I do, it comes down to being able to judge that speed and the momentum the same way that I could judge the speed and the momentum of the wave coming in. So I don't look at the market, and you will never ever, I could comment on it with people that comment on it. You would never find me coming in saying, well, this was wave 1, and this was 2, and this was 3, this was 4, this was 5. That means this is going to start 1, or this is going to be A. I wouldn't even remotely go there. Absolutely don't subscribe to it. But I will look at those waves, and I don't try to number them. I don't try to letter them. But it's grasping a sense of the speed of the move up and the speed of the pullback and the speed of the move up and the speed of the pullback. And that is the basis of reading tape. But before I could read tape, I was doing the same thing on charts. Sensing the move. Here's the move back. The momentum's changing. I'm changing with it. So, is that something that's easy to teach or easy to learn? And I would have to say, no, it's probably not. Either you have that sense of momentum, you have that gut feel, or you don't. So for people that don't have that, what I want to show you is a way to try to gauge that market. And again, I'm going to use the term the market structure, where you can sit down and within a few minutes of the open, you have a good idea of the market structure for that day. Or in other words, is this going to be the wild ripping up and down kind of day? Is it the slow grind higher or lower? Is it the choppy sideways kind of day? What are we getting? I feel that frequently the first 30 seconds looking at the tape, but I've got 10 years of looking at the tape that I could go back on and say, no, this is definitely slower than average. No, that's definitely more aggressive than normal. And you can make those kind of judgments. And you guys, that's something that over time, if you think about it, you will gain that same type of feel. That will come with time. But we're going to try to shortcut that a little bit. So, when I look at things in this fashion, then to me, I'm trying to figure out if I subscribe to that belief that the market is a constant pushing match between buyers and sellers. They're constantly trying to push it down, and someone else is constantly believing it's going higher. It's essentially the entire market is just a big gigantic difference of opinion. The thing that changes it though is that some people have the money to back up their opinion and some people don't. And they can make things happen. So we're just trying to gauge what they're doing. This is the group that we really want to be able to track. So if anybody's confused by that, tell me now, and I'll try to re-explain it or address it slightly differently. But if I had to draw this out, I could make it as simple as saying this right here. We've got one camp in the market who believes things are overpriced, and they're determined to see it back down. They feel that the price should be somewhere down in here. And you've got another group of people who feel the market, it's definitely not overpriced. It should be higher. And actually, let me just do that. Green. They feel that price should be higher. And in their mind, they want to see price back up here. And they're going to push back and forth. And the end result is that we see this constant wave action, this constant push and shove and push and shove. And it makes a little gain and gives it up. And it makes a little gain and gives it up. So if we look at things that way, I don't know how many people would agree with that. It's a fairly basic concept, but for some of you guys that are newer, I've heard many of you talking about accumulation and distribution. And, Karen and I have talked about it. I've talked about it with many traders over the years. I'm willing to share my viewpoint on it. Prove that it's accumulation. There seems to be a lot of buying there. Prove that that's accumulation. Because it very well, that buying that's going on there, that could actually be somebody that bought 20 points lower and they're actually distributing. They're selling it off. They're closing positions, and they could be the ones that are aggressive right now. And yet people look at it and say, well, that's accumulation. Is it? That could be distribution. That could be profit taking. We don't know. So, we do know this. There are points in time where buyers are very aggressive and then they quit, and there are points in times where sellers are very aggressive and they quit. There are other points in time when they're both operating at the same place and they're both very aggressive, and those are the areas we have to be cautious, where we have to kind of step aside. But at any point when we say it's accumulation, somebody probably is distributing. If they're accumulating something, they had to get it from somewhere. There's not a big warehouse full of ES contracts. Somebody else is distributing. So, I do think, to me, that's why I tend to use the term aggressive buyers and sellers, because we can track that. They're the guys that are willing to come in and place a market order, and we can see them place a market order. They are the ones that move the market. I think in that sense, you will come to the eventual conclusion that everything you need to know really is right here on your chart. And all you're trying to do from your time in sales is you're trying to get a right here, right now, this is what's happening and it's time to take the trade. But I look at that, whether it's delta or volume footprint or market profile, I think anything you look at really is right here in a candlestick chart. If you come in and you see a red candle, guaranteed, if you check the delta 98 times out of 100, that big red candle, there were more market sellers. The big green candle, there were more market buyers. So in that sense, it is the aggression, the willingness to go to the market, that moves the market up and down. At some points in time, that may be coupled with the fact that there's not very many people that are willing to offer to sell it. There's not very many people that are willing to initiate a new position right there. So because I look at the market that way, I would be interested in finding as many ways as possible as quantifying the same thing. Is where is it likely that that wave is going to come? Where is it likely that that wave is going to end? Where is it likely that that wave is going to go once it rolls over? We've got buyers coming into us. Where will they quit? Where will the sellers grab it? Where will the sellers get it if they push it back? Because that is what we're doing as successful traders. We're viewing this objectively and just saying, look, where's it going? Are any of you guys? Let me just ask for your vote and just give me yes votes only. Do any of you guys walk into the market and say, I think fair value, I think the S&P should be trading at $12,053. I think that's a reasonable value. Anybody here subscribe to that? Pete, no. Brian, no. Tuba Tom, no. Karen, no. See, everybody's putting in no's down the list. None of us come in and say, I think this market should be here. And yet most of those theories, that's what they're telling you. That there has to be a fair value, there has to be a fair price for this, and that somebody really believes it should be here. Well, I've never met a trader yet that says, I think the S&P should be at 1250, and I'm really offended that it's not. We're looking at it saying, what's it doing right now? Which way is it moving? Who's in control of this right now? So we're going to address it from that viewpoint, and I wanted to mention this, even though it's very basic and very simple. We do have some newer traders here with us. Some of them have never placed a live trade yet. Some of them were not overly familiar with platforms and so forth. I kind of want these guys to have a sense of this when they start their trading. Don't get distracted by the semantics. At its basic state, if you define the market and took it down to its most basic, simple state, it's a difference of opinion between people who believe it can go higher and people who believe it can go lower. And it comes down to who's the most opinionated, who's willing to step in and place a market order. The beauty that we have is we can see the market orders, and we can identify them accurately as market orders. And the only time that we're in a little bit of doubt would be if we come up and we push through this high up here, and we see the first little blast of what appears to be market orders. We have to realize that a stop order, when it's triggered by a print, could blow a market order back in to the exchange engine. So the first print coming through, if we see a flurry after that, that could be market orders that were not because somebody was opinionated, but because that was their stop. So keeping that in mind, other than that, we can effectively identify market orders, the ones that are doing this because they're aggressive in their belief. So let me get rid of the drawing that's on here, and I'm going to put just a basic indicator that's on everybody's charting platform. Doesn't matter where you chart, you'll have an RSI. Andrew, your question, do you use 100 ticks? I think I addressed that earlier. Probably the simplest way of saying what I prefer is I like to see candles that look like candles. I don't want to see all real bodies. I don't want to see, and by real bodies, what I'm referring to, I don't want to see candles that are just like 2-tick real bodies. I couldn't use range charts. It's not that I don't think they work. It's just that when I look at range bars, it drives me crazy where every candle is the same height. I just want to see candles that look like candles should look. So on the S&P, I would have to go somewhere between 350 and 500 to have that appearance. On most other instruments that are thinner, they don't trade 2 million contracts a day. I would say that's going to be somewhere between 100 ticks and 200 ticks. And 100 ticks may give me the look that I want, but 200 ticks may allow me to see the whole morning session, and 100 don't. So I may not use the 100 because of that. But for right here, for this trade setup, I would say on the YM, I would go somewhere, if you like the fib charts, do an 89 tick, somewhere between 89 and 125 ticks. If you're doing the NQ because you have about double the volume of contracts, go somewhere around a 200 tick. This works the best on the indices, better than any other market. It would be, um, your ES, your Nasdaq, your NQ contract, your YM, the mini Dow, the TF or the Russell. These are the ones that it works really well on. But this again is designed to train your mind to start seeing these surges and start gaining an idea of market structure. So as far as indicators, I'm going to just put on a basic RSI 14 period. Doesn't have to be anything special to it. When I have mine print, there are a couple changes that I make, and this is on version 7 of Ninja. So if you're using 6.5, it will be slightly different. But I will change a couple settings in here away from what the default settings are. And I'm going to leave this here for just a minute because these are the settings that I would use on it. As far as the average itself, the average of the moving average, there's two things you could do. You could plot this transparent. You can set this to a setting of 1 in terms of its length. This is done up here, the smoothing, that's the average. And if it's set to a period of 1, then it won't be visible anyways. But I don't want the average of the RSI. I just want the RSI. The RSI itself is a 14 period. The calculate on the bar close, that's going to be set to false because I want it to update tick by tick. I don't want it to update once the tick candle's closed. The tick bar is closed. I don't use any displacement on it. The price marker, you can leave it or not. It's just your preference. If you're using this on version 7, you can change your scaling a little bit. On version 6.5, it's a little more difficult, and I think for most people, we're probably better off going to 7 anyways. I mean, that is the new version, and unless you're fighting an indicator, trying to get it to convert over, not really a good reason not to use 7. So I'm not going to go thoroughly into this on 6.5. Bottom line, we want a 14 period moving average, RSI, and we want that to print on every tick. We want that to update in real time. So if I put this on here, there's one other thing that I will put on here, and I usually would have this on most of my tick charts. That is off of Ninja's forum. It's called Tick Counter 2. If you can't find it on Ninja's forum, email me. I'm happy to send it to you. But the Tick Counter 2 just shows you the remaining ticks in a candle. So I can put this wherever I want it. I can put it in the top right corner, bottom right corner, left, whatever. I can basically place that wherever I want. Won't make any big difference. Sounds good, Pete. Have a good day. It's getting late over there for you, so I will talk with you later. Thanks again for the email, by the way. I appreciate the recording, the item you sent me very much. Anyhow, we've got this tick counter, and all it's going to do is just give us kind of a heads up that a bar is getting ready to close. I usually would have that on most of my tick charts. So if I put those two items on here, what I'm going to end up with, the number up in the right corner, that just tells me there's 71 ticks left in this candle. That's going to count down to 0. When it gets down to 0, the next tick will start a new bar. The RSI, I've got a line at 70, line at 30, and I've just got my moving average back and forth between that. But here's the reason that I encourage people to look at this, and to look at this a little bit differently than perhaps they normally would. Does anybody know, let me just ask for your input because we've got a number of guys sitting in here. What does the 70 level represent if you're using RSI? Okay, that's something that, depending on how you interpret it, see, we're getting some interesting answers here. One person says that signifies strength. Another, the consistent answer down through here is that signifies an overbought level. And that is technically how the RSI is designed to be used. If it gets to 70, that says this market is overbought. In other words, to get to this point, it had to rally to the point that it is extended. It's time to revert back to the mean, if you will. But here's the problem with using RSI in that fashion, which is how it was designed to be used. If it gets to 70, and we now say, okay, it's overbought, can we short it? Does the fact that it's overbought mean anything? Stochastics, the same scenario. Your stochastics are over 80. Does that mean you can still buy it, that it's strong? Does it mean you can short it? No, you really can't tell, because bottom line, if you come up here and it hits 70, it very well may reverse on a dime, or it may keep right on going. Same thing would happen if you get down to 30. What does 30 signify? Exactly the opposite. That's oversold. Does that mean that you can come in and buy it? And you have to say, no, you can't. Karen, when we say overbought, that would be overbought on the time frame you're watching. If we put up a second time frame of the YM, and let's say that we went to a daily chart, it won't remotely have the same levels that it would have here on a tick chart. So when we say that it's overbought, this is going to be relative to the time frame you're watching. So we're watching this on a 100 tick chart, and it says the momentum that is here, the buying that has been here, has reached a level that mathematically is considered extreme. So now it should pull back. But as we know, if you've ever tried to use RSI, it doesn't work. But that's what is kind of intended to be used. So here's what I'm going to do differently with this. As we look at the RSI, we're going to come back in and just look at the first minutes of today's session. And this is one of the reasons, and let me just point this out, one of the reasons that I use a short time frame is that as an intraday trader, we're not looking necessarily for swing trades. We want to trade that we can get in, get 15, 20 ticks, and get out. Wouldn't you agree that's the goal that most of us have here? I mean, we wouldn't be studying tape reading if we're trying to figure out how to swing trade and hold things for 3 days. It's irrelevant. So we want to figure out how can we get in there, identify an area where we've got a push or a shove, and then it moves back away. Subsequent to that, how can we identify at any given point that here's our structure for the day? It's going to be a grind. It's going to be a sell-off. It's going to be an uptrend. It's going to be sideways chop. And I'm going to go through a couple ways that we can extrapolate that by ignoring what the RSI is supposed to tell us and using it differently. But before I do that, before I get into that, I think it's a good point just to stop. We've got 30 minutes on the tape, so I'm going to reset that. I'll be back in about 2 minutes. Any questions so far, just throw it out there as we go. In fact, any questions during the whole thing, throw it out there, and we'll just work it in as we go. Karen makes a comment here, and it's a good point. She says a good exercise for any of you guys that aren't sure what chart to use, like what tick count to use. Put 3 of them up. Use like a 50 tick, 100 tick, 500 tick, whatever you want, and then see if you can still see the swings. If you still can see the tradable swings, that's the important thing. You know, you may just want to play with it. For the purposes of what I'm going to show you here, though, I will say this: we want a short time frame because we want to identify the pushing back and forth, not necessarily the move from 310 down to 252, but can we identify the pushing back and forth, the fluctuations back and forth that we would be tracking as a tape reader. So here's what I would normally do with this. I would grab my scale down here and drag it down a little bit, and on version 7 what that's going to do is that's going to give me a fixed scale so that I can see a move outside of this. In other words, that's going to keep this from floating, and you'll find a little bit of difficulty doing that on version 6.5. You have to use something else called constant lines. And if anybody's still using 6.5 and they continue to use 6.5, I'll show you, I'll send a brief excerpt, email me. I'll send a brief excerpt showing how to do that on 6.5. But here, all we have to do is grab the scale, shrink it down a little bit. If we hit the F, that's going to take it back, let it float. But we can grab this and lock it into place so that we can see 0 and 100. Alternatively, we could right-click this. We could go to Properties, and we could say, show me a maximum of 100 and show me a minimum of 0. And that's just by right-clicking on the scale itself on version 7. And so now we've got that with its mathematical limits. RSI cannot be above 100, cannot be below 0. So we've got that pegged in here now. When you think about RSI and using a 30 to say it's oversold and it's time to start looking to buy, it will work probably 2/3 of the time. But it frequently can continue on against you. And it can get through the 30, it can get down to 25, it can get down to 20, it can get down to 17. Or it could get to 30 and just go along 30. But here's what I would do starting off the day with this to try to determine market structure is I would just watch the market for about 15 to 20 minutes. And I don't do anything. I'm not looking for trades, not trying to short it, not trying to do anything with this. I'm just letting the market trade 15, 20 minutes. In that 15, 20 minutes, you'll be able to come back in and get a feel for what's happening in the market right now with the RSI, what the structure is tending to be. You know, I think when you look at the RSI, eventually the theory behind the RSI started to change because it didn't work. And to a degree, they started saying, well, it a lot of times where it dies will depend on whether it's in an uptrend or a downtrend. Now, if you've used, has anybody here used RSI extensively? If you have, give me a yes. I've got no yeses. So there's an interesting thing about RSI, and I just wanted to know, because if I was going to say if you've used RSI extensively, you would be able to bear this out. And I do have one question here. Am I looking at the pre-market to get the fill? No, I'm not looking at the pre-market. I'm going from the 9:30 Eastern open. So the broader market open. Let things get trading. The RSI, it's still on a 24-hour chart, but I'm looking specifically from the open on. But here's what you'll find with RSI. When you get into a downtrend, and this, I'm not saying this is theory, I'm saying this is the way it is. When you get into a downtrend in a market, and you can see clearly that price is selling off, when you come down and look at your RSI, it will virtually never come back up and touch your 70. And you're going to see that come back up, and that will stall out somewhere around 55 or 60. Now, why is that beneficial to note? See, if you're sitting there waiting for a rally back to 70, it's very likely that that low, that prior low, was a bottom, and now we've got a short-term reversal in place and we're going to the upside. So if the market starts trending down, you will see that right away because it cannot get up to the 70s. In fact, if we were, let's just remove this and back up a little bit and look at this entire sell-off in the Dow that went from 345 down to 265, 80-point sell-off. It could not get back up to 70 on any of these rallies. And yet if we were to come in and measure the size of these rallies here in terms of value, here's 18 ticks. You know, you get a number of little attempts to rally. Here's 13 ticks, 15 ticks, 19 ticks. Could you scalp in there? 15, 18 ticks, 20 ticks. Could you come in if you're a one lot trader? If you could identify those points, does that give you a tradable move? And you have to say, yes, it does. That's why I'm looking at this on a short-term time frame. The little wiggles that are in there can be excellent scalping wiggles, those little swings. But you notice that these rallies, 10, 11 ticks, as that breaks down, you have to say that starts getting tougher to scalp. Where most people pay commissions, that starts to become counterproductive to try to get 7 or 8 ticks on a $5 a tick instrument. So when I look at this, you will find virtually any downtrend that it is very, very difficult to get back up to the 70. Now, if we take the market yesterday, let me compress it down a little bit more. You have to say that was a down day pretty much across the board. I mean, this is, let me draw a vertical line here. That white vertical line is, I know it's very light, but that white vertical line would be right about the close, the broader market close, and it was a downtrend all day long. But when you look at the RSI, where did it hit 70s? Let me just, I'm going to just configure this to be a color that'll show up. And then I'm going to come back in and just look at this. We just barely touched 70 here shortly after the open. And then we hit it again over here on this rally. Barely touched it right here on this rally. We barely caught it here twice. Caught it over here. And these aren't lined up perfectly, but gives us a close enough on where they are. In that entire downtrend, essentially we didn't have anything in the market hours until the very close. So when you start looking at what you can gain from that, is you say in a downtrending type market or a downtrending day, you will frequently find that it's not going to go touch 70 very much, and therefore we can't rely on that 70 level. Does that make sense? We couldn't rely on shorting 70s because it just won't touch it. It doesn't get there. So what happens then if we see a market open and we come down, and this is what I would be looking for. We get through the 30 a little bit. We come back up to the 70, and then we move back down again. If it's going to both sides, it's getting to both extremes, I would say over time, here's what you're going to find. You're going to have either a sideways market, if it's getting to both extremes, and you're likely going to have a choppy market where the moves to both sides are moves that are significant enough that you could scalp them. So rather than just saying, hey, I'm going to use 70 and 30 all the time, I encourage people, put your 70 and 30 there as an initial reference. But beyond that, just draw two horizontal lines. And when you come down and you get through that level, mark it. And when you get up here to this level, at the top side, where my cursor is, let me just mark that. So we've marked 2 points here. We've marked where it broke through to the bottom. We marked where it broke through to the top. As the day starts to unfold, those levels where it got to on the last couple pushes, those levels will tend to repeat over and over and over. And if we get back up to that point, or very close to that point, it's very likely that because we're tracking the actual structure of the day. We're not just saying arbitrarily, mathematically, 70 will stop it. We're saying today, in today's market structure, it took 81 to stop it. As that begins to unfold and we watch the market go, and again, this is something we should be able to see off of price action, but many people don't feel comfortable with it. We can sit there and look at that level and say, that level at an extreme, if we get to that point, like in a corrective rally, if we get back up to this point, like down over in here, that should give us a top. That should give us a reversal. Now, could we still be looking at this as a trend line? Whoop, didn't mean to hit two lines there. Could we still be looking at that and saying, hey, we're rallying back up into this? Yeah, you could. But if we're able to track that day by day, whatever the market gives us, if it's a bloody sell-off, we're going to see on these pushes back up in price, we're going to look down here and say, boy, we can't get back up to the 50 or 55 or 60. And so we see a little rally that comes back up into our 60. We can start looking at that as a short. Now, I have traded this out of curiosity. I have tracked this and traded this off the RSI alone without reading tape. Turn the time and sales off and trade it. And if you're analyzing it correctly and understanding what it's doing, it is a profitable setup as long as you can stay in the trade and you're giving yourself a 1-to-1. If you're the kind of guy that's going to bail out with 3-4 ticks, it's probably nothing's going to work. But if you can sit there and accurately look at the swings, you're able to make this work. So there's a couple things that I try to put in play on this setup. When you see a rally, does that rally move far enough that you could get your target with your normal stop? Just for reference on the YM, I would say at a minimum I would be looking for 15 ticks and a 15 tick stop. So I could come in and look at these rallies then, and let me turn this off. I could look at these rallies and I could measure the size of the rally and say, did we get my 15 ticks? No, we didn't. I couldn't get out of there. And if I can't get the 15 ticks out of a rally, I am not going to be buying that on a breakdown. But if I see that I can get, the rallies are running 20 and I know I could get 15 out of the middle, then I'm interested in that. If I can't get 15 ticks on a rally, then what other option do I have if I still want to trade? Anybody want to throw it out? I can't get 15 ticks out of a rally, so I'm not going to buy it as it pushes to a low. What's the only other option? Exactly, Karen. You take the shorts. Now we say, where is this rallying to then? We can take our line and say, through this period, once we had the first push up, we stuck at 70 and then it got down here even lower. And it's coming down, hugging the bottom, and we get down punching the bottom, and we get to the levels on the bottom and we're barely able to squeak a trade out. If you took this and said over here you got 20 ticks on this one when it got down to the first level, you would have had a trade. If you just simply waited for that to get all the way back down to the opening level, you would have been able to get your 15 ticks out of the 20 tick move. Karen, when your question, you say, how can you know whether you think it will reach your target to the upside? Here's what I look at. When I take an extreme move, and if I see that in the first 15-20 minutes, it actually can get through the 30, I mark that level. And in that same 15-20 minutes, if it can get through the 70, then I'm going to mark that level. And at that point, I will assume that if we touch that again, if we sell off enough to touch that line again, then I have a trade. Now, if I can read the tape, I can see the buyers step in, or I could see the sellers slow down. And then at that point, it comes back to what Tony always said that I mentioned the other day. You gotta believe. As it unfolds, though, if you're seeing that the rallies can't get there, it simply, you're saying, no, I'm not going to work it to the long side. But let's take a different type of day, and we'll just compare this on a couple different types of days. You'll notice that each of these moves that came down to that opening level, they did end up being tradable moves. You would have been able to get your 15 targets. You know, like if you're doing a 15 tick stop, 15 tick target. You know, you take this move right here, where your RSI is coming in off of that low, and we look at the size of the move that subsequently did. It went as far as 28 ticks from that sell-off on the retracement. I take those blue lines, Brian. You're asking, would I reuse those blue lines? You know, would I adjust them? Would I keep using the original levels? I will take these original levels, and then once I see what the structure of the day is doing, I may adjust it, but I will still watch that, because on a subsequent push back down, I normally would have that opportunity to get a trade off there. This is one of the few setups that I would trade back and forth both directions, where I may be going long, kill the trade, go short, kill the trade, go long, kill the trade, go short. But again, it's based on that structure. In the meantime, on that structure, you have to recognize that if you can't even get back up there, and if you're coming in here like in this area, and you look at the corresponding level down here, and you can't even get back up to the 70, you're looking for shorts. And the reason for that is, if you can't get there to the 70, that is indicative of a market that's going to trend down, if rallies can't get to 70. So if you took that on that basis in here, you would have still been safe, even if you got your first move, even though it came back and your RSI actually went higher, price didn't go higher and it rolled over again. See, this is a trade setup you could do on the basis of the chart, but if you can combine that with tape reading and you see the shift in the tape, then you have an ability to filter out a loser or two. Let's say that we get through. Let's say that we've moved this level and we're watching 60s, and we go through 60s, and we're watching our tape, and the tape is still all buyers, and they're just buy. Would we initiate the short? And you have to say no. You're going to let them continue to back it up, and when you see the sellers come back onto it, then you've got your short. But the interesting thing, and you'll find this through the time and sales, through the RSI, is you will frequently come in on your RSI, and you'll work your way from a neutral level. You'll work the downside for a while, work the upside. You'll come back to the downside, and you'll see these swings where it takes a long time to get back up. And when it gets back up, if we're downtrending, you're going to see it roll over again. Comes back to the downside, it can't get back up there, works its way back up, and you'll see that these rotations in that tape. And where the price rotates, ironically, is you'll sell off, you'll get a rally back up into a retracement zone, you sell off, you get a rally back up. By watching this and just recognizing that once we've had 3, 4, 5 touches here, it's more likely that we're going to get a longer rally. And when we get that longer rally back up, we're sitting there waiting for it again for a short. But you will see this rotation where you can't touch one side for an extended period, and then it will finally touch it. It'll finally get back through to our opening levels. So if that's the case, initially you can take these first little moves. It can't get back up there. Maybe you watch the first one and see it die. The next ones can't even get up there. You see those little rallies? You're looking at it as a short. They just can't sustain the momentum. They can't keep that movement going long enough to get back up here. You start looking at that as a retracement to short. In a sense, it becomes something that's identifying a continuation move for you. So again, you guys ask questions as we go here. I'm going to just go back and we'll keep looking at a couple different types of markets. Here we've got a sideways market. What do we see on RSI in a sideways market? We come down, we test the bottom level, we come up, we test the top level. We come back down, test the bottom level, come back up, test the top level. And you have to say, for general purposes, this day it's sideways all day. And what do we see on the RSI? Test the top a few times, test the bottom a couple times. Test the top, test the bottom. Test the top, test the bottom. So I don't know why individuals have trouble seeing that on the chart, but it seems like many people do. For some reason, it's easier for them to see it as an indicator than it is to see it as price. I could look at the price and say, boy, we got bottoms here. We're rallying back up to the same point. We get above that. We're still just working sideways down our opening levels. And you look at that all day long. Here's our close. The entire day just basically closed right about where we opened. We got below it, we got above it, got below it, got above it. So, when I look at that, I think interpreting the RSI correctly can be very beneficial because it gives us an idea of the structure. So, let's see if we can find another day. Here's another sideways day. What are we seeing? We take our opening levels, it pushed in the first few minutes to an extreme here. First 20 minutes or so, we push to an extreme level here. Touches it over here, got a little small rally. Would have probably gotten stopped out 375. Yeah, that went 30 points. Touches it again, got through it a little bit. The rally comes back up 45, 50 points. Touches the top side. The top sides of the shorts were pretty good on the top sides. If guys are able to do that, and you combine that with divergence, it can be just a full-on standalone trading method. If you see the buyers on the tape, and let's just talk about this from the standpoint of divergence. Everybody kind of familiar with the concepts of divergence between an indicator and price? Got some yeses, got a couple no's. Just in simple terms, I'm not going to go in depth on this, but we're looking at price rally back up, and we look at the highs, and the price just keeps moving higher. And we look at the slope down here on the RSI, and what is it doing? It's not moving higher. I do think for most indicators, it's probably the only thing of real value is divergence. We come up into this, and we still see buyers on the tape. And we just step aside. We come up, it takes another push higher, still buyers on the tape. We're getting back up to these levels, close to the levels that we saw pre-market, or not pre-market, but in the first 20 minutes. It was actually like right in here that this finally got above and put a cursor on. So right up here on our price, nothing that would have been any problem. 15 tick stop would have held you fine, even if you would have just blindly took it. But if you keep seeing the little pushes and then you start to see the divergence on this, again, it's indicating to you that there's a good likelihood that you're going to get a tradable move. If that's the case, what do you do? If you can read the tape, you're going to the tape. But here's where it becomes kind of ironic to me in looking at this type of methodology or this type of trading. One, you can identify the structure of the market, that it is going sideways or it's one-sided. If we can't get up to 70, you have to say right now it's one-sided, and the next time we rotate and get up there to 70, as long as we're not all of a sudden making new highs, we've got a short. We can't get down to 30 and it can only get down to 40, guaranteed it's an up move. And we take the little pullback into 40, first pullback into 40. If our buyers start grabbing it again, we jump in, we've got our trade to the upside. And then we have to realize that after it's spent a little bit of time in here in the middle between 40 and 60, you're probably going to get a bigger move following that. That bigger wave is going to take you back outside. So any market condition, when you look at those up moves, I would step into the day and say, where's the extremes for this day? And when we get to that extreme, does it give me a tradable move? Again, it's an important thing that you're trying to identify on the first pushes. You identify this as early as you can. You got a time on this. It's 10 minutes after the broader market open. You come up here and you look at your pullback. Did it give you a tradable move? Did you get 20 tick pullback so that you could get 15 out of it? And you look at that. Say, nope, 8 ticks. Next pullback, what'd you get? 10 ticks. Next pullback, what'd you get? 24 ticks. So you've had several touches there, and you can't get a tradable pullback. What would that indicate on the next pullback if you can't get a tradable pullback? Would you agree that you start watching your tape for buyers? You get the little short pullback, 8-10 tick pullback, you're watching it for buyers. Even if they pull back 10-15, you're looking at the structure saying we're grinding higher. We're not getting tradable pullbacks. So the next pullback, when I see buyers come back onto it, I'm going to go long and assume that we're going to keep grinding higher. You get a move that takes you finally back down to the 30, and it's barely a tradable pullback. You know, you would have had a tough time. I'm saying tradable, Brian. When I say tradable, I'm saying does the retracement move far enough that I could get a target out of it? Now, bear in mind when I say that, we're looking at that at this point. And actually, let me get that tick counter out of the way. We're looking at that at this point, and we're saying, okay, we got this level down here, and we're just watching it at this point because we're just watching the first 15-20 minutes. We got through this level, we got to an extreme level, got clear up to 85, and look at the pullback. Because we're just observing, we're just watching. And we say, is that tradable? Did it go far enough that I could get my 15-tick target? You measure it off, and it's right back up at the high, and you say it only went 8 ticks. It's not tradable. I don't have a pullback big enough to where I could buy that pullback. I could short that next rally, hoping to get the same size of pullback, same size of retracement back down. Well, no, it's not necessarily that you're saying you want to short the next one, but you're saying I can't short the next one. It's not tradable because it only went 8 ticks. If I'm going for 15, I'm not getting close. I'm not even getting half of what I need to get in and out and capture 15. So you're simply looking at the pullback saying, is this one tradable? Because if it's not tradable, very possible that the next one won't be tradable either. So when the next pullback occurs and we rally back up there to that level and we get our little pullback, we're watching for buyers. We're saying they could not push it back far enough to where I could make money shorting this. Therefore, I'm going to flip, and the next pullback, I want to buy that. Does that make sense with your question there? You're looking at this initially saying, okay, let's say we get right here, and you're saying, okay, we're hitting an extreme level. I'm looking for a short, but I am observing. I'm just watching this for the first 20 minutes. So let's step forward on our chart, just a candle at a time. And I know this is not, let me expand it out a little bit so you guys can see it easier. I'm just stepping forward a bar at a time here. We're watching this for a potential short and saying, okay, I'm in observe only mode. I'm only 10 minutes into the market. What happened? Was there enough room there to get a profit if I would have shorted it? And you say no. It's not big enough to short the next one. So if that's the case, if we're hugging that level again and we get another little pullback and we see that pullback can't get us back down to the 30, we take that little pullback, and as it pulls down, we start watching it for buyers, which is going to get us long right in here. We're trying to filter it out and say, if I shorted it, would I have got the target? No. If that's the case, are we going to grind higher? Look at RSI. We came up, got to an extreme level, and there was nothing for a pullback. Does that indicate that I should be able to go long then when I see buyers come back in? Exactly, Brian. The pullbacks aren't big enough for the next short, so you start looking for the opportunity to go long on the next pullback. Conversely, if you would have pulled back 20 ticks, you would have seen RSI come back in here. and the next time it rallies and gets up to that level or close to that level, you would be looking for it for the short. When it pulls back to the downside, we come back into the 30, you're going to be looking for the long. That because the previous swing was big enough to trade, we're going to assume that this very next swing will also be big enough to trade. If the previous swing wasn't big enough to trade, then we're going to assume that that this next one won't be big enough to trade. If that confuses anybody, I'll tell you guys what I will do. I will send everybody that RSI fade video. I'll just comp you guys that. And it explains it, and it shows some actual trades with it. But here's the reason that I look at things this way, or why I've mentioned to people to try this if you have a tough time seeing this. If you start focusing on this, what that forces you to do is it's forcing you to look at the pullback, look at the move. Is it tradable? Is it moving back enough to be tradable? And if that's the case, you're using an indicator, but you're using that indicator to focus you on the price action. And essentially, you let the indicator go, and that tells you at certain points, watch the price action, watch the price action, watch what's happening. Yeah, Karen, exactly. It's not getting much below 50. We're 20 minutes in. It's not gotten down to the 40 other than just one quick little move where you're basically just getting your 14 period established and your average there. So you're not getting much there, and you have to say that's likely that we're in an uptrend. Andrew, yes. You asked, do I use that for divergence? Absolutely use that for divergence. See, when you look at the waves, Karen, you've commented on this several times, and you guys probably noticed Karen's comments. I think I read it into the tape a couple times. You come into a trade, and as you take this trade, you see price moving up into a level. And Karen explained pretty thoroughly, she's sitting up here looking at this fib level. She sees price moving into this. She hesitates just a little bit. She gets in over here. And I don't say this, Karen, to make fun of you, but you've commented on this, so let's just see why the divergence could be beneficial here. You come into this and you say, you hesitate a little bit, you get in a little bit late, and then price immediately goes back, and as you've noted on crude, it goes right back through you. If you look at that, in most cases, after that's happened a couple times and they take that last push or maybe a second push, it ends up rolling over and heading all the way back, back down $1, $2. But in the meantime, you got so rattled here that you didn't enter here and you didn't enter here, and you missed the move. Accurate statement for Karen, accurate statement for me. I'd say it's probably an accurate statement for any of us. You get wiggled a couple times and it starts making you nervous. The thing that we can look at then in those type of situations, one, this is focusing us to pay attention to the structure, and is the structure giving us tradable moves? If the structure is not giving us tradable moves, we need to sit on our hands. We need to realize that. This is not the day to go for 15 ticks. By the same token, if we see a rally that runs 40 points real quickly, and it pulls back 30, and it runs 40, right here, right now, if we can identify that in the first couple moves, we may say 15 is not nearly enough. I'm going for 35 on this one. Let's see what we can do with it. But it will change, and we'll sense that change if we can pay attention to the price action. All of a sudden, we see the swings get smaller, and we're going, okay, wait a minute. No problem, Gary. I appreciate that. We'll see you tomorrow, and if you have any questions, fire me an email. We'll get that in there tomorrow. But anyhow, this is where the divergence can become beneficial. Is when we keep making the new highs, the divergence will appear, and it's not necessarily that you want to take that trade instantly on divergence. It does give you a good indication that, hey, we've had 4, 5, 6 pushes to the upside, and now the divergence is very clear. In a sense, it's going to give you the same thing that we talked about yesterday. Is the divergence can kind of give you a heads up that this move took you 45 seconds. This move took you 15 minutes. What are you saying about the momentum? You know, the movement is the momentum has changed. It's still pushing the new highs, but it's not doing it very quick. You have to say, you know, worst case, it's probably going to stall here and go sideways. Best case, we get the nice sell off back down to the opening levels. I'm gonna reset the tape real quickly here. I'm getting up about 37 minutes, and then we'll talk about this a little more. But you guys throw any questions out that you. Okay, couple of questions here. Andrew, you say right now there is divergence. What do you look for confirmation? I'm assuming, Andrew, are you talking on this visible chart, or are you talking right now in the live market? This chart, okay. Let's take a look at this. You know what Andrew is noting here. Here's our price, and here's RSI. I tend to look to that, the divergence for me. I tend to look to that. I would prefer to see 3 or 4 pushes higher before I would just take divergence on its own. But you have to say, in this case, if you saw the divergence and you took that on the first test here, you probably would have to say, under the rules of your setup, you're not going to take this push because you just realized this one didn't get you shortable. But you are noting that there's some divergence there, and it's getting lower and lower on the pushes on the RSI. What do you see in the price action right here that also indicates that things are dying? Short term, yes, we know it went higher. But short term, what do we see? They are getting 1 or 2 ticks through that high, and then it's going sideways. It's stalling out, Gerardo, yeah. So if that's stalling out and your divergence is there, what if you were taking this on the chart itself? Let's just throw this cursor back up here. Let's say that we just did this in the middle of the consolidation at 310. We've got a 15 tick stop, 15 tick target. If we saw that, price only, not tape reading, chart pattern only, we're going sideways, we hit it in the middle of the level, take the 310 short, 15 tick target, we're down to 293. So you have to say, yeah, there was 15 ticks there if you took that. Obviously, the 310 upside, you only went to 16, went 6 against you. So would you have gotten a scalp off in there? You know, you could have taken that in the middle of the range and still got your target. If you allowed that as it's going sideways, and you're noting on the chart or the tape that you're bobbling back and forth between 307 and 312, and it tries to poke higher and sellers hit it, and it tries to poke higher, could you have gotten 310, 311, 312? Yeah, you could. Again, if you're doing this in and out, it gets far enough that you can go to break even. It gets far enough that you can get a 15 tick target, have a second lot open, see if you get a breakdown. You're looking over here, opening levels. Are we going to get back down here to 270? That would make a good second target and out. But that's what I tend to look for. For divergence, it's not that you won't see it roll after just 2 pushes higher, because you will. But I do tend to prefer 3 or 4 times where it's tried to push higher and can't. It's visible on the tape. They're getting 1 tick, 2 tick new highs, and sellers come back in. The buyers aren't getting aggressive. 1 tick, 2 tick, 3 tick new highs, sellers are jumping back on. At that point, they still haven't completely rolled it over. You'll see other times where they just crash it right down with that. But it can help you avoid that fake out on the RSI where you just say, hey, it hit 70, I'm going short. You're watching it first, then you start looking at it. What is the patterns? We finally get the first pullback here. If we saw this pullback, I would say by this point, you may have convinced yourself, hey, I can trade it to either side. You get your pullback, you see buyers come back into it. What do? Take your trade, let it run. I think a guy can combine this just with what he sees on the chart. He can do it on the basis of tape reading combined with that. There's multiple ways of looking at it. You can do it purely as price action. Tom, when I go into the trades, your comment here, you say in real time you would wonder if that was a reversal. I'm assuming, Tom, you're talking right here. Okay. I always assume it's a reversal at a point like that. If I didn't think it was a reversal, I probably wouldn't be shorting it. So, do I hold on? Absolutely. When I'm scaling out, again, this is, but Tom, you're going to have to take this according to your trading, to your account, your comfort level with holding trades. I will always assume it's going to be a reversal. And do I know realistically that I'm going to be wrong? Yeah, absolutely. Would I bet my house on it? No, I wouldn't. But in my mind, I'm 100% convinced that's a reversal, because if I wasn't, I wouldn't trade it. Those are the types of trades where you get a target, maybe get two targets, and get stopped out at break even right over here. And you kind of say, well, yeah, I saw the buyers coming back onto it. When they traded off over this pivot, yeah, I felt like I should have bailed. But bottom line, I would say, to me, I go into it absolutely 100% convinced it's a reversal, because otherwise I couldn't even take the trade. But I wouldn't bet my house on it. I wouldn't get in a fist fight over it, or bet you the tip of my pinky finger or anything like that. Maybe it sounds a little bit like I'm speaking out of both sides of my mouth, but I'll tell you something that has influenced my mentality, and let me just mention this just for your guys' sake. Brian, I know that you could benefit from it as a golfer if you haven't looked at it before, but I would tell you guys the best trading book that I have ever read is a book called Golf is Not a Game of Perfect. Best trading book you'll ever read. Golfer or no golfer. Karen, I think you're a golfer. I know some of you guys like to golf. The golfers will benefit from it for their trading and their game. But for a trading book, if you read that book, Golf is Not a Game of Perfect, Bob Rotella is the author's name, and a brilliant sports psychologist. Yeah, Karen, I agree. Karen says, I think golf and trading are similar. And they are. You're constantly messing up. It's constantly changing. You're always off balance. You're always in a different place that you didn't even know it existed on the course, and now you got to hack it back out of there and keep on going towards the goal. And it's a mental game. It's a psychological game. You're playing probabilities. When this happens, same thing happens. Same thing in both endeavors. But even for a guy who's not a golfer, when you look at that book, something that he has addressed in the same sense with his players that he's coaching, you have to absolutely 100% believe that you're going to make the putt. But would you bet $1 million on it? No, because you know the odds. You know the odds are 5% of the time you could make a putt like that. But if you don't believe it, negative thinking is so powerful. Absolutely guaranteed negative thinking, you will lose on that trade. Tom, his last name is Rotella, Rotella. Bob Rotella. That's the author's name. Exactly, Karen. That negative thinking will snowball exactly the same as it will in trading. We get angry and we're punching the wall, punching the desk, throwing the mouse across the room. Total mess. Yeah, Gerardo. He's I don't know what his PhD is in. He's a doctor, PhD, some type of psychology. But if you guys look at that book and apply that to your trading, there's probably more of value there psychologically than any other trading book, any other psychology book you'll ever read. And if you're a golfer and you can apply that, you'll shoot a lower score to boot. So I actually found that That was my biggest problem, was the psychology with golf. And I ironically, I saw the same thing in my golf game. I actually got from a 14 handicap down to a 6, primarily from applying the principles in that book. And there was nothing there about swing changes and grips and anything else. It's psychology. And I saw a tremendous impact on my game. Same thing goes for the trading. So we come into a situation like this. We'll get back to our discussion on trading. Kind of the thing that kicked us off there was the question: do I believe that it's going to reverse there? And yeah, I do. I believe that I'm reversing here with my 19 quarter short, and yet I know there's a realistic chance that that is going to wiggle me out of the trade. But would I take it again? I take another push up, I see another break, and it breaks from 25 up to 1250. Am I going to do the same thing again? Absolutely. If I see that and I sense that and I believe that, I will do it again. And I have to go in there 100% confident if I'm going to eliminate second guessing, bailing out, chickening out, not being able to manage the trade. So the video, I won't go a whole lot more in depth on this today. We've been running over at least 20 to 30 minutes every day, and I think for most of you guys that are here in the States, it's not as much of an issue. I know for poor Pete over there in Thailand, we're starting at midnight for him, so the time change coming right in the middle of this was definitely not friendly. It was bad enough that he was starting at 11 at night, but now he's starting at midnight, and so he had to bail early as well. He'll have his baby screaming at him first thing in the morning and drive him crazy. So, but anyways, I like I say, I'm going to just comp you guys that video. I do think, especially for you newer traders, it's worth taking a look at. Look at the trades with it. I explain it a lot more in depth there than I did here. But it is something that, to me, it does make a visible way of identifying the market structure right here, right now. It's not that it can't change in an hour, not that it can't change in 5 minutes, but right here, right now, this is what it is. Frequently, if I've sensed that, let's say that we come to this point in the day, this line, and I don't have a position, and I'm looking at the structure of the market, and I say this is our first pullback of any size all day, would I start looking at that for a potential long? In my mind, I have to say yes, I would. Would I wait for it? This arrow here, would I wait for it to break this swing high? That's definitely a possibility. If I felt comfortable on the tape, I would take it off the basis of the tape. If I waited for it to break the swing high and come back up, would I take the next pullback? I see this next pullback can't get anywhere, down here on the RSI. Would I at that point take the trade back to the long side? If I've got room for a target here, absolutely. Yeah, Karen, if you're looking at that overall structure, like you say, looks like a 618 pullback that has divergence. It's essentially what happened. You had several pushes to the upside, it rotates back to the downside, and then immediately resumes the uptrend. We wouldn't know that going in. All we're trying to say right here, right now, was the last pullback tradable? Because if it was, I'll take it. Right here, right now, was the last rally shortable? It wasn't. If there was no way that we could have gotten a target out of it, why would we short the next one? If it happens 3-4 times, we see something change on the chart, we see divergence there, we see something on the price action that indicates it's getting toppy, we look at it and say, do I have room? Guys, it's something that I always am looking at. Do I have room to get to a profit? The trade that was up on last night's video, I cut the profit down significantly, and I taped that trade specifically to make a point when I was working with a couple guys back in February. I wanted to make the point on there. If you see the channel, you see the size, you see that the target's not there, can you still take the trade? Yeah, but don't go for the 15-point move. You hold on to something just in case you get the 15-point move, but bottom line, you're looking at this saying, right here, right now, we're in this channel. I'm unloading most of my position in this channel. If we break the channel and I get more, great. If I don't, I don't. Again, not everyone will be able to do that due to account size. If you can't do that, if you ever intend to succeed as a trader, I would say it still would behoove you to go over, put your little account, do some of this on the 6E, where you can scale, where you can get used to that mentality of saying, realistically, this is a good objective. But bottom line, if we do this, here's where I see the potential to go, and put some targets down there too. That's what ultimately, as the account grows, that's where your thinking ultimately will have to go. I would say I tapped out as far as what I can do scalping. And I think there's two things that got me up against the wall. At some point, you will reach a size level where you don't make good decisions. I remember a couple of you I've mentioned the story to, but I was talking with a trader one time who had been doing 20 lots, had a lot of money, but he'd been doing like 20 lots, and he felt pretty comfortable with 20 lots, and his goal was to be a 100-lot trader. So he just decides one day, I've got enough money, I'm gonna be a 100-lot trader. I'm gonna put the trade on. Puts a 100-lot trade on. It goes against him 2 ticks. Now you think about what that does at a 100-lot level. That's $2,500 negative in 2 ticks. And at that point, reality hit him, and he realized that his normal 6-tick stop, he couldn't tolerate it. And he said he just projectile vomited right onto his keyboard, actually ruined his keyboard. And he said he didn't even feel it coming. He said it was like tick, tick, and he threw up. And he said, I realized at that point, I'm not a 100-lot trader. Yeah, Brian, time to change your shorts. I've always told guys, keep a roll of toilet paper sitting on the desk just in case. You never know when something like that's going to just ruin your day. So, when I look at that from my perspective, at some point, I still get to feeling that I'm not making the same quality of decision that I normally would make. And that's the point where you need to back away a little bit. You've realized that you've reached your limit. For scalping, I've always liked scalping the YM. Could I come in there and scalp 50 lots? And I have to say, I'm not comfortable with that. I know that frequently I could get 50 lots on an entry without moving it, but maybe 2 or 3 ticks at worst. But what makes me nervous is the explosion downwards in the stop when volume evaporates, like some bad news, some negative news hits. And I realize I could lose 15, 20 ticks trying to get out of that 50 lot. Just the slippage that's there if something went wrong. So I look at that and say I'm not comfortable with that. Would I do 50 on the S&P and feel like I could get out within 1 tick? Yeah, I would. So in a sense, at some point, your account will be big enough, your size will be big enough. You will hit a wall where you say, I can't keep scalping. I can't put more size on. I can't scalp 1,000 lots here for 3 ticks. And when that time comes, hopefully it comes for all of you guys, that time comes, about all you can do is start looking at that scaling out. Multiple targets, bigger targets, let the trade work for you. And you'll find that is where the money really starts rolling in. I felt when I went from 1 to 3, I felt it was easier to make money with 3 than it was with 1. I'm a perfectionist. I would admit that, and I've got that problem of wanting to come in every time and be right. And if I got out too early, I was furious. I would rather get stopped than get out too early. And all of a sudden I could get out of something at a logical place and still have more to run. And to me, it was easier. I don't know if anybody's experienced that, where you guys are at. But to me, I looked at it and said, man, it was easier for me to do that. I've known other people, Casey, you've talked about that for you trying to go to scaling is not been real successful. It's not comfortable for you to go to scaling. You're more comfortable just being in and out. Just take one lot in and out, in and out, in and out. So you guys will vary, in your preferences there with what you do. Well, I think if we have any questions about this setup, go ahead and put it out, and I'll address it quickly. But like I said, I don't mind just sending you guys a video that will explain it very in depth with some recorded trades, with some examples to look at. But the other thing that I would say with this, let me just explain what I'm going to do. I will send out today's video, just our recording, and then I'm going to send you a second download. That second download will have that RSI fade video. And I'm only going to make it, I will send it to everybody, but you're going to need to download it and save it to your disk, save it to your hard drive, because I will not send it out twice. I'm going to send it out one time, and I'm going to ask you guys, I can come back in and see who downloaded it, but I'm going to ask you guys just honor that one download a piece, save it to your hard drive. I will make it available to each of you that are here, but there will only be enough downloads to allow each person to download it once. So download that, save it to your drive. It won't be there in 14 days. And if somebody comes in and downloads it twice, it's going to short somebody else from getting it. So if you tried to download it and you had some kind of a problem with it, tell me, and I'll send you a separate invitation to download it again. I want to be fair with it. I'll give it to you guys, but I ask that you respect that and be fair back with it. So, and I've always said the same thing. Same thing goes for the workshop. I provide you the recording. I try to make something that you're getting good value for the money, and I just ask that you respect that and don't pass it around to everybody you know. So, thanks Brian. Thanks Andrew. Appreciate your comments there. If we don't have any questions on this, I think we'll probably go ahead and stop for today. We're right at 2 hours today. We'll come back in tomorrow. Any questions, please email it. Send me an email, and we'll address that in the morning. And then we will also, at that point, we're going to try to wrap everything up and come full circle with what we've done here. And then, if you guys don't mind, for you guys that are here on the live attendance, tell me what would work best in terms of a day of the week for getting together in roughly 2 weeks and addressing any follow-up, any additional questions, anything else that we need to cover. Just send me an email if you don't mind. Let me know what would work best. I will review that across the board from everybody. We'll try to come up with something that would work good for everybody. And then, as far as the asking about the live trading, Andrew, watch those videos. That will give you the concepts very clearly. I will continue to send some trades out, and I'll post some other trades up online as well, and I'll direct you guys to where you can go view those online. Andrew, I'm not scared of taking live trades. All of the guys in the room know that I put my trades out live every time. I don't have any problem taking trades in front of people, but because I'm recording this and I would like to have something that eventually I may make the recording available to other individuals who weren't here, I don't want to have something recorded that's full of frustration because you guys can't see it fast enough and I'm trying to answer questions and somebody's saying, where you're looking, I don't see it on mine. It kind of creates a mess. So I have no problem trading live with somebody, and I don't mind. My next week, actually my next 2 weeks is pretty trashed, but I wouldn't mind. I'll just extend the offer to you guys. I wouldn't mind when we get our final day. I wouldn't mind taking a couple hours and just trading, like an hour at the open, comment on things, answer questions, maybe spend 3 hours or so, 3.5 hours that final day. We could do some live trading at that point. Anybody that can make it in for the live trading is fine. And then we could do the, just some final questions as you guys think about things over the next couple weeks. Well, yeah, Gerardo, that's what where you're saying maybe do some live trading but no recording. I could record it clear on my end, but you guys probably aren't going to see it clear, and it's just I'm speaking from past experience. I'm sitting here talking about numbers and the dome and this and that, and the guys can't see it on their chart, and they can't see me gesturing because I'm trying to get my voice to them as fast as possible and trying to do it voice only. I could still record it on my end, and the recording would be clear. But then the problem that I've ran into is it gets so distracting with questions where guys are going, oh, wait a minute, I don't see that. Where are you talking? And it's just a constant interruption trying to say, no, it's over here, it's over there. And I've ran into that frustration just one-on-one. So when I get 18, 19 guys sitting in here and nobody can see what I'm doing, I just don't foresee that working real well. So that's why that final day we'll go through there and do some live trading, and then we'll go ahead and record final questions and answers and put it all together. So, well, guys, I sure appreciate it. Like I say, please get me an email with your preference. If you don't care and you're usually available, just tell me that. Just put that in the email. If you've got conflicts, some of you are overseas, and that affects the time differential affects you. For some of you guys, it's going to be work schedule. Some of you work and then trade in the afternoons and so forth. So just if you don't care, if you're usually there most days in the market and you don't work, you're usually there in the market, just let me know that it doesn't matter. So, well, sounds good, guys. I appreciate all the kind comments and the input there. Yeah, Karen, it's a good suggestion. I'm still kind of toying with that idea. Karen says, I think a good thing to do is see some of the levels that I've referenced and note down the day and time, and then go back on market replay and see what the tape actually did. I have been toying with that just as an educational tool, of sending out a little short newsletter at the end of the day, couple, 3 times a week, and saying, these are some trades I took. Here was the time. This was the instrument. Go look at the market replay from point A to point B, and then you guys can go back in and watch it and see what actually happened on the tape. Let's see, Gerardo, you said you came in a bit late. Is there anything else that you need to vote on? I think just the final day. Let me know for a couple weeks out if there's any restrictions time-wise that would affect you. And guys, I don't think I mentioned anything else for voting on. We had talked yesterday a little bit about whether to cancel 2 days or not, and I think the disruption to things, I would rather be able to wrap everything up with my planned session tomorrow, tie this up full circle, make a tape, a recording of this that would make sense for somebody that wasn't here, and then do a little bit of live trading in 2 weeks when I get this put together and I get my schedule back to normal. So just let me know that. And again, if you haven't yet, I have gotten some comments from several of you guys, but if you haven't done it yet, please send me just your comments on your impressions of the workshop, good, bad, or negative. I would like to know if there's things I can improve in. I would also like to know what specifically benefited you or what your specific feelings were about it. So please do that if you haven't. Yeah, Karen, good point. Tomorrow is a Veterans Day anyways, so you're going to have a lot of banks, bank closures. And I shouldn't say bank closures. That sounds like a bad thing. There will be banks closed, and not necessarily a good day to work live markets anyways. Well, guys, I sure appreciate all the comments, and I hope that you're finding it beneficial, and we'll come in tomorrow, 12 p.m. Eastern. We'll get everything kind of wrapped up here. Well, good morning, everyone. Hopefully we have sound here for our final day. Maybe we could get a quick sound check and see if you guys have audio there. Okay, looks like so far people have sound. Well, we're going to go through kind of a review for today of the key points that we set out to accomplish when we started this. And we're also going to address some questions. And so if you guys have questions, please throw those out as we go. Don't hesitate or hold up on my behalf. I'll work it in wherever it works best as we come to it. But I think what I'm going to do before we get into the rest of this presentation, I do have a couple of questions that were emailed to me, and we're going to go through those questions briefly, and then we'll get started. One of the questions, and it wasn't as much a question as it was kind of a comment / question, but I do want to address this. The comment that was made here was dealing with the management issues and one lot traders specifically. I commented on it in the course of the presentation that when I looked at it as a one lot trader, you really have to take a logical approach to say realistically on the chart right now, what can I get out of this? And that's where you need to put your target. And if your risk reward ratio isn't good, it's better off not doing it. Kind of comes down to what you see there, what your risk reward ratio is. But you may be able to come in a situation and get 2 or 3 to 1, or you may look at the chart and say, boy, I can barely get 1 to 1, and it's all going to vary on that basis. But he made a comment here. He said one of the things that he was trying to do was to use my entry type plan and use my first target as his plan. And he says that's what I'm employing with great success. So he was basically taking a look at that. And I'm assuming, Marty, that in your comment there, you're talking about taking that at least 1 to 1, take that first logical target, taking it off, looking for the next trade. I guess I'm assuming that's kind of what you mean by that. Okay. So, guys, just if you go back through and review this a little bit on the day that we talked about the management, we did address that to a small degree. And, the management as a one lot trader, if you see that there's a resistance and we're rallying up and we're actually finally showing some strength and we've got resistance overhead and it's 4 points away, 5 points away, a couple things would make sense to me in a scenario like that. And I'm going to just add this in here without drawing it, but you guys can visualize this, no doubt. One of them would be to take your Fibonacci, look where a 618 would be, because frequently you'll get up to that 618 and that's where you're going to get kicked back, and then you're going to start going sideways, and then you may eventually break higher, you may not. But I do like using the Fibonacci retracement areas as targets. So if we had a nice move down and our resistance is up overhead, significant distance away, we're taking a bounce there, take a look at those Fibonacci's for potential targets. It can be a very, very effective place. And one of the nice things about that, it may get to the Fibonacci and go sideways for a while and go higher. But frequently, if you're using those Fibonacci's as a target, you will get up there, get your target, and as you get that target, you're out, and you don't have to sit there going sideways for the next 2 hours, feeling frustrated and wondering whether you should just bail on it when you're moving along sideways. So give some thought to that. This would be the scenario where you have a real sharp breakdown. You've got plenty of room overhead. You played the reversal. You picked a good reversal spot. Don't just necessarily be content with getting 8 ticks because you used an 8 tick stop. Look for a good place. The Fibonacci's make great targets. Just a question before we go further. Are you guys seeing the presentation okay? Does it look normal size, or is it coming through kind of strange? Looks okay, everybody? Okay. Yeah, it's just the title page. I was just going to address a couple questions while I was waiting for everybody to finish getting in this morning. But for some reason on the little screen that I see, it shows the presentation being about the I don't know, it's about 1/4 of an inch wide, and normally I can read it, but it just shows a little teeny thing in the middle of the window. So maybe I'll just close that and reopen it and see if that changes anything. Well, as long as you guys are seeing it, that's the important thing. It's all good on my end. I can tape it and it'll all be there on the video, but I just wanted to make sure it wasn't coming out goofy to you guys. Second question here, and I'm going to just address this, couple comments here about this. Uh, one of the gentlemen has been looking at the Forex market and realizing that as a new trader, it wouldn't behoove him to come in and start trading futures yet. He had a couple questions about that market, and one of the things he asked here makes sense. I think it's a good question. He said, in order to trade successfully, it is important to understand the market. That is time consuming, and how long one takes to get the hang of a particular market will vary from individual to individual. That being said, for someone who is a beginner like me, does it make sense to spend X amount of time on the spot Forex and then migrate to the futures and spend time trying to understand futures? He said, I do recognize the value of being able to trade live in the spot market with very little money and gain confidence. Now, this is coming from someone who has not yet placed a live trade. So you can kind of see the danger. You guys, any of you guys that have gone through it, you can see the danger that you have when you place your first live trades into the futures market and get whooped, and right away it messes with your confidence. So he can see that. But the question that he had, is that a good investment in terms of time, even if you didn't intend to continue trading the spot market on into the future? And I would say absolutely it is. You got to remember with the trading, there's I would say two primary components to your trading as an intraday trader. One of those components is going to be the actual analysis that gets you into the trade. You know, the entire thought process, the setup, everything that you go through that gets you into the trade. And then the second factor is going to be the way you manage the trade. That's two critical areas in our trading. So by looking at the suggestions I made earlier for people with smaller accounts, for people who are sim trading, for people who are not 100% confident, by taking their trades in the spot Forex, yes, you do get a little bit familiar with the spot Forex, but in reality, you would not be sitting there analyzing the spot Forex market. You're doing your analysis, your tape reading, your chart reading, everything you're doing is coming off of the 6E. And at the moment that you go to execute, you're executing into a different market. So I don't think there is any conflict when we think of the time that's invested, because all of the primary portion of getting in that trade, you're going to be doing in the market that I guess eventually will end up trading. So don't feel like you're wasting your time doing this. The 6E can be a nice instrument to trade either way. For a smaller trader, it's definitely safer to come in and scale down a little bit on the size, and then you'll learn the good management techniques. You can ramp that up gradually as that gets closer and closer in size to what the actual futures contract would be for tick value, and you can still scale. You still realize you can get 3 or 4 lots. At that point, it would be good if you want to rotate full on into futures, rotate. If you like it and you're making money, stay there. Subsequent to that, he also asked, do I know anyone who's making a good living off the spot market year after year? I actually do. I know a number of individuals who have been pulling money out year after year on that market. So it is just like any other market. You've got 5 to 10% losers, winners, and you got 90-95% that are just in there flailing around, chasing momentum or doing whatnot, and not managing good, and they're losing money. So one additional question that he had asked, who is generating the prices at Oanda? Is it Oanda? You'll find that that's the case with any currency firm that you go to. They will generate their own prices for those markets. What do they base it on? Well, most of the firms as we discussed when we talked about the Forex firms, most of those are basing it on what's bad for you and what's good for them. But in the case of Owanda, what they're basing their price quotes on, they're actually taking that off of the tier one banks, off of uh, their feed, their interbank feed. And they look at those rates and they actually want to be able to hedge into that market if you place a trade. So they're basing their quotes off of that Reuters feed, which is what the big banks, the tier one banks, are using. And it's not that they'll be literally to the tick, to the thousandth of a cent, same price, but they'll be within 2 or 3 ticks of what the interbank price actually is. So they're computer correlated. They're generating those quotes based on where the interbank market actually is, where the big boys are. So, additional question, was wondering if there's a good source for understanding Fibonacci. He says, I noticed that you use it a lot. Karen, you could probably speak more to the experience that you had with Carolyn. I know you know Carolyn and have worked with Carolyn Baroden quite extensively. Would I adopt her methodology? No, I wouldn't. I don't think it needs to go to that extent in order to be successful with it. The Fibonacci, you notice that I use 2 basic tenets. I do not look for multiple levels from multiple time frames and hope that everything lines up. As we get a thrust or a move, I'm simply drawing the Fibonacci on there, and I want to see retracements that run between the 50 and 60%. Technically the 618%, but between 50 and 61.8%. Somewhere in there, that's where I would start looking for sellers to come in or buyers to come in, or that's where I would start taking profits. Hopefully that answers that question. I think if you spent an extensive amount of time understanding Fibonacci, a lot of what you're taught won't really matter in the real world. Take a couple simple tenets out of that. When you think about Karen made a comment. She says she thinks it's important to understand the basis for fibs and what the significant levels are. I've got a warped opinion about it. For someone that uses it, daily, I don't use it because I agree with the underlying premise. I don't use it because I think that there's something magical about those levels. I do use it because other people think there's something magical about levels. So if we see, the majority of market participants have a viewpoint that these retracements are turning points, it's likely that we're going to find turning points there. I do think in some ways it's like most other common technical analysis type styles. If a lot of people use it, it becomes almost self-fulfilling. No specific reason that a floor pivot should work. Mathematical calculation that makes absolutely no sense. Nothing that's remotely sophisticated about it. So why does it seem to work sometimes? Well, we went through that with our random lines, and random lines work. I honestly feel random lines work more often than floor pivots, but it works to a degree because other people are watching it. So when you look at significant levels, you've got 3 levels that are most significant. That would be your 38%, your 50%, your 62%, if you want to just round it. Beyond that, would I start reading tape looking for it at a 76.4? Would I start looking at it at 24%? No, I wouldn't. I'm looking at, to me, the levels that frequently come up, frequent retracements between the 50 and 60%. Yeah, Karen, with your comment, you say you think it's good to know what the levels are because other people will be looking at it. I still think that a guy can spin his wheels trying to gain a really deep understanding of Fibonacci, and he won't gain anything more beyond what I just said. I've seen that. I don't have a chart here. I could probably put it up after one of the breaks, but I've seen that with auto fibs where I worked with a trader that had auto fibs from so many time frames and so many different fib levels that were fib numbers that you literally could not find the price candles. They were not visible on the chart. You had to study extremely hard to find it. And the end result of that was paralysis. He couldn't take a trade because there were too many levels. He couldn't figure out where to look, what to do, which one was real, which one meant more. And there was literally, when I was looking at this as he was trading the S&P, he literally had a line every two ticks, sometimes every one tick. There was a fib level. And so to go on an in-depth study of that and start looking at that many levels, the end result is going to hurt most traders. So if you take just your basic primary levels, you see this on the tick charts, those levels come over and over and over and over. Those are the levels that typically a guy is better off trading. There's a couple other questions there by the same gentleman. I will address those questions privately with you because these are things that don't really matter probably to the rest of the group. These are more setup type questions. Things that are just not, I'm not going to slow everything down today for those questions. Any other questions, you guys throw them out there. Feel free. Like I said, as we go on the fly today, throw the questions out. I'm going to go ahead and get into our topics for today, the things that we're going to be discussing. And the thing that I'm going to go back to was the little video I made before we even started this. It was a little video that gave an overview of what we were going to do. And these were some key points that I wanted to come across to you guys. So as we go through this, I want to just use this to kind of review the most important concepts that we covered in here. You know, I realize that the recording, you're going to have a recording of the whole thing, but you may not want to go back and look through it and hunt through it. You may not have time to go back and look through it and hunt through it. So let's focus for a minute on those key concepts, you know, that we talked about in here. That really a guy has to walk through. When it comes to the setup, one of the things I mentioned coming into this, if it isn't done right, you're going to miss the information. So we talked a bit about the setup, you know, what was required there for this setup. I've got my presentation kind of messed up here, it looks like, too. The key things with the setup. Remember, we talked about the coloration and we realized there was a little confusion with the coloration on the dome and the coloration on the time and sales. And when I talk about prints coming in that are red or prints coming in that are green, I'm talking about the time and sales. One rule of thumb, and I think it was Karen, I think you mentioned this, that somebody told you when you set up your time and sales, make sure you color it the opposite of the dome. So, in other words, if you have a dome, let me just get a dome open here. If you have a dome where your buy column is green and your sell column is red, your bids are green, you know, your offers or your asks are red, you're going to change the color of that. Go the opposite of that on your time and sales. That's going to allow you to see what the market entry orders are doing, the aggressive traders. So as you go through that setup, you know, that is covered in the video on our first day. If you have questions about it, you know, easy enough to go back and review that, look at that first day, and it will take you extensively through the setup. Second factor to the setup that I think is important, as quickly as you can get migrated to version 7, try to get migrated to version 7, because you'll be able to then run it without the time compression. On version 6.5, most of you will have to run that with the timer refresh set to true, with a 250 millisecond compression, and it kind of takes away the fluidity of the tape. So when you do that setup, as quickly as you can get over there to version 7, get to version 7, get your time compression set to 0, and that way you'll have a tape that comes in fluid and you can see the acceleration and the changes in momentum rather than just getting fed a slideshow. Yeah, I'm going to have to stop here for a minute. Let's let's do this. I'm going to stop, and somehow this ended up putting some animations in here, which is not wanting to just change the slide. So I'm going to stop the presentation just for a minute and change this. And I will be back in just a couple minutes. I'm going to just reset the tape while I do it. So I'll be back as quickly as I can get that change. It should only take about 3 minutes or so. Okay, got that taken care of. It had some transitions in there that was trying to, or some animations in there that was trying to make it appear one line at a time, which is what I used on the video, and had to clean those out. As far as our setup goes, any questions on that, throw it out. We're going to go through a number of topics, so as we hit the topics, start firing questions if you still have questions or you want something re-explained there. Another thing that I mentioned we would look at, and we talked about this briefly, that was to be able to come into a market, look at a market, observe it for a while, and see what method is going to work best. There's a couple things that we can look at when we're trying to gain an understanding of those individual instruments. Remember, there's factors like our DOM, and we look at the DOM, and on some contracts at our 5 visible levels, we may have 6,000 or 7,000 contracts visible on each side of the book. We may have 15, 18,000 visible on each side of the book, or we may have 100, 125 visible on each side of the book. And one of the first things you want to look at is, what does the book look like? Because that's going to tell you a lot about what you need to do. Best rule of thumb, if you look at the book, and by the book, let me pull my time and sales back in. This is what I'm referring to as a book, would be those visible levels, the bids and the offers that are there. And we look at a book here and we see 7,000, 8,000, we see, depth at every level. What would that automatically tell you? Maybe you guys can throw this out. We'll talk about a couple of these things and see what your thoughts are. And I'm going to change this real quick while I'm looking at this to fit it on the screen. Any thoughts on that based on our conversations? We've got a real thick book. What are we going to expect to see on the tape? What would we need to see on the tape? Right. See, we look at a real thick book on that. This isn't the kind of thing that we're going to come in and have one print with size and say, okay, that's what the big traders are doing. This is the kind of market that we're going to need to see a flurry of prints right now under current tick reporting. We're going to have to see a flurry come through that would indicate a large market order hit us. And when we had that flurry, we had that on the filtered side of the tape, then we could truly say, okay, large traders are coming in with us. We see a little thin book. Let's come over here to, let's come back to our beans. We look at our book here. What does that immediately tell us? We see one large trade, 2 large trades. That may be the confirmation that we're going to get. We're not going to expect to see a lot of 50 lot market orders. So very quickly, when we start looking at that book, we're going to be able to get a feel for the type of market that we have, what we're going to need to see on the tape. We wouldn't expect to see lots of 10 lots in a market like this, just because the book is thin. Something else we learned just from 30 seconds of looking at a DOM. If the DOM is thin, like this here, we've got a light book, there's not room for a lot of manipulation on the DOM. So if there's not room for a lot of manipulation on the DOM, you would walk into this the majority of the time saying, I will trust that what's there is there. And yes, some people will always pull their orders as price is coming in. But you can look at that and say 8 times out of 10, what's there is real. You come into something with a thick book, real heavy bids and offers in there, it's prime territory for spoofers and flippers and our ping orders and our HFTs to come in there and try to play games on that book. So we come back into this again, the reason why. How are they going to come try to manipulate and make this look heavy if they run the risk of only having 20 contracts in front of their order? They can't risk it. They're going to get filled on the side of the market that they don't want to get filled on. Occasionally you will see it happen. I've seen that in the beans occasionally. I think what happens sometimes is you get a fund, like a commodities fund, who's used to playing these games in the S&P comes in and tries to play these games in here, and they get shredded by the commercials and they leave. So by and large, you get those little thin books. You have to say there's not a whole lot of manipulation that goes on there. Again, these are things that you can tell in just a few seconds, just looking at the dome. As you start to watch the tape, remember our comments on that on the tape. We have 90 lines on our time and sales from top to bottom. We watch 90 lines print. What is significant? A 7 lot, that's the biggest one there. Watch it again, 90 lines run down. What's the biggest thing there? 6 lot. We quickly come to the conclusion that that market isn't getting very many big hits. You know, a 10 lot is fairly significant. That would be like seeing a 200 lot on the S&P. So just a little short amount of observation tells us a lot. And then we start looking at it, a couple of other things we can look at. How quickly does this ratchet up and down the dome if we want to watch it on the dome? Or if we're watching the tape, how quickly does that go 32 quarters, halves, 3/4, 33? Does it come right back to 32s? Is it like a jumpy instrument like the Russell or Crude or the DAX? Or does it sit there and chew away level after level after level? See, very quickly we can build a character for that market where we see what the average participants are doing size-wise. We see what the average speed of the prints coming in. We see how quickly it's changing price levels. We can gain a very good feel for that in just a few minutes. Does that mean it's going to hold true through a news release? No, but we start building a little database. This is what this instrument is. Very quickly you can come in there and start trading that. So any questions there, feel free, again, fire them in as we go. Just trying to recover these key things here at the end. Something else we said we were going to do here was to come back and correlate the tape with what we see on the dome and on the chart. Remember, we talked about several different facets of this as we went through the topics here. I'm going to just go to a blank black screen here for just a minute, and I'm going to draw this again just to try to get it in here and re-illustrate this. We think about the time and sales and what we would see on the time and sales. And let's just imagine a time and sales screen where our prints, and remember these prints are scrolling in from the top to the bottom, but let's say that our final digits on the price are 32, and we see 33s, and we see 34s, and we see 35s. And let's just go down here and say we're seeing this string of numbers, and this flows in where we get a few 39s, and then we get a few 38s and a few 37s, and this is scrolling down as we go. So the most recent print that we have right here would be a 32 with a 39 high. Now we have to stop and say, what would that look like on a 5-minute candle? Let's assume that we started watching those 39s print right as that 5-minute candle opened. What would that look like if we had to correlate that back? So we take our candlestick charting, and we realize that our high prints came first. So we had opened up here at the top, and then we traded down all the way down, red candle, and now our candle's down here. We take a scenario like that, we could color this in and say in that type of a situation on a 5-minute candle, we're going to have a big solid red candle closing right at the low. Again, this would be assuming that we started trading, the 39 traded right as this candle opened, and now the 32s are trading. Now, if we came over here and we saw these numbers to continue to push down, and let's say that it pushed down to 27 and then it came back to 32, that's where we would start leaving the wick. We would see that wick come down here to 27, but prices pushed back up. So if we're correlating that back in our mind on a 5-minute, this is what we're looking at. You can kind of see the difficulty if you're looking at that as a sign of a reversal is this candle is going to be slow forming. It's not going to be a real quick, immediate feedback that sellers are coming into this until it does push down here and until we see it form. But we might see that momentum go very quickly on the tape. 39s to 38s, 38s to 37s. We see a bunch of guys pull at 36. 36 is one print, and we're hitting 35s. So on the tape, we see that drop very quickly. On a 5-minute chart, we're probably looking at where that 5-minute candle closes. Now, if we take the same thing and we correlate that back to a tick chart, let's imagine the same scenario on a tick chart. Let's say that we have, before this 39, let's come back in here and say that we had, 38, 39, 40. Boy, I don't like those fours. 40, 41s. If we had some highs coming in there, and we look at that on a tick chart, essentially on the tick chart, we're going to see price, that had worked its way up somewhere as high as 41s, and then we're going to see that turn red and start selling off. Now you think of the difference, and that's one of the reasons why I like the tick charts, is that you can see that change fairly quick. You can see the rollover. You can see the rounding in the top. You're not looking at just one big candle that slowly waffles up and down, but you're seeing candles start to form. You can see acceleration start to pick up. So wherever you watch it, to me, if you can't see it on the tape, next fastest is the tick chart. And then your 5-minute, that's going to show you a big broad view, a big overall view. So when we try to correlate these things together, I would say here's something to look at if you're going to look at these 5-minute candles. One of the key things on a 5-minute candle is going to be tails, topping tails and bottoming tails, or wicks, however you term it. You think about what we see on a candle, and let's just imagine again that we've got this 5-minute candle, and here's our real body, and we know that this is red. This is sold off over the course of that candle. Current price is lower than where it opened, but we see up here a big wick, and we see down here a big wick. What would we correlate that back to on our tape? Let's say that these lows down here, let's say that these are 20s, and up here these are 40s, and here we are fighting back and forth in the middle. See, if we can't get it on the tape, I would say that the tails are more relevant than the candle itself. And the reason for that is we can make an assumption on that tape that sellers grabbed this at some point, and sellers pushed this down, but they found a spot where buyers were willing to come in, and the buyers grabbed it, brought it back up. Does that make sense? We know that it came down and it printed 29, 28, 27, 26, 25s, 24s, 23s, 22s, 21s, 20s, and very quickly they came back in and pushed it back up here to 28, 29. If we see a candle like that, we could make an assumption on the tape and be accurate the majority of the time as to which came first. If we opened up here at this price level, we would probably expect the majority of the time that they pushed higher first and it got rejected, and then it pushed all the way down and got rejected and came back up. So if we can correlate that back and forth, if we find over the coming weeks, we try to do the drills, we try to make sense of this, and we come to the point and say we can't do it, I can't track those numbers fast enough, then just realize you can still get the same thing off your chart. But then use the tape simply for the color change and the momentum. If you can't look at the numbers and see the numbers and build the chart in your head, you can still use the tape to get the momentum, still use the tape to get the color shift where it goes from seller control to buyer control. We take the same scenario on our tick chart, like this candle here. We would see in that type of a scenario, typically a series of green candles that pushed up into that high. We would see it turn red. We would have that run back down into the low. As it came back down into the low, we would see the transition to buyers grabbing it again, and it's pushing it back up to current price. So we're going to be able to see inside of that candle. It gives us a little bit of a historical feel for what happened on the tape. Again, it's multiple ways of looking at the same information, and you're going to find it the quickest on your time and sales, because that's what just happened. That information is then going to power the rest of your platform. Any questions on that before I delete this beautiful work of art here? I see why John Madden always likes playing with that telestrator on a football game. They're kind of fun to fiddle around with. Okay, no questions. I'm going to go ahead and delete it here. But again, the key point, what is it on the chart? What is it on a tick chart? What is it on a 5-minute candle? And how does that correlate back to what we just saw on the tape? Multiple ways of getting the same picture. One thing that you guys could do if you wanted a secondary drill, take a look at a 5-minute candle. Try to figure out what happened in that candle. Mark that little time frame off. Or do this, maybe make it even better. Do this on a 10 or 15-minute candle. And as you look at that candle, try to figure out what came first. What was the price action like inside of that candle? What would you have seen there in real time? And then switch it over to a tick chart and look at the same exact 5-minute or 10-minute window. What was the wiggle like inside of that thing? And as you do that, that's going to give you a good indication of what came through on your tape. What did you see on the tape? If you're on version 7 of Ninja, even if you didn't have your platform open on version 7, you can go back in and download a replay and get an accurate time and sales. So take that candle you watched, note the time, go back in on your market replay, and then watch the time and sales. Were you correct? Is that the way it really formed? Do you see now on the tape what you expected to see when you analyze the 5-minute candle? If we can correlate those back and forth, it helps us to get all of that in our memory base. We see that coming in on the tape. Automatically, we picture the candle, we picture the tick chart, we can understand where our dome is, and we may not need those things to a great extent other than picking levels. So I will get rid of this. Maybe I'll get rid of this. There we go. Let's go to the next point. Both of these 2 points I covered in the introduction to our material. One of them was for the guys that are already price action trading. And they're looking at their charts. They want to understand how to confirm an existing chart setup with the tape. And the flip side of that scenario would be a guy who's using a couple indicators, and he wants to come in and see how he can benefit from the tape. So you got to remember with the tape, there's an important thing on the tape that we want to try to conquer or gain from the tape. The tape is not used as a primary setup tool. Whether we use indicators doesn't matter, nothing wrong with that. Or we use price action, nothing wrong with that. Both methods will work if you are comfortable using it and you understand how to use it, and you can make money with either one. But you have to ask, how does the tape fit into either method? And that would be the things that we've discussed over the course of the last 2 weeks, that it is to filter the entry, to either blow it off and say, no, not here, not now, or it's to come in and say, okay, that fits the criteria that I need to see to convince me I'm not going in here fighting the big boys. I'm not going in here alone. Only guy in the entire market that sees this as a top, and I'm going to jump in here and hope I can stick it. See, that's something that, as we started out talking about it, the majority of the time, tape will act as noise. And if tape is noise, the majority of the time, we have to caution ourselves there, because we see a big burst of red does not mean we have a short. Because we have a big burst of green does not mean we have a long entry. See, that is a dangerous way to try to use tape. And frequently, if you look around videos where you have guys putting videos up of so-called tape reading, usually they're not using the tape, they're not using the time and sales. If they are, they're waiting until they see this big burst of momentum, and they'll watch the momentum and watch the momentum and watch the momentum, and then they say, man, I got to go with this. It's just all red. We got a waterfall here. They're too slow. They're too far behind. So what we're trying to do, whether we're using an indicator or whether we're using the actual price action, is we're coming to a setup that we know is 50%, 55% accurate. And then we're watching that order flow at that point in time to try to get an indication of whether this is going to be one of the 4 or 5 losers, or is this going to be one of the 4 or 5 winners. It's not the only way that you can use tape, but that's the quickest way that you can put it to use in your life. And I would say, bottom line, for most people, will be the most beneficial way that you can put it to use. If you want to trade 100% off the tape, I have got tape trades with that. I actually put one up on my screencast account. I was going to send you guys just a link to go view it. The tough thing about doing that is difficult to learn. It's difficult to teach, largely because of technology, and it takes a lot of time spent watching it. But we've kind of detailed that out. But I would say, the way that we've addressed this, take your existing setups that you're comfortable with, and then tweak what you need to tweak, and then use that tape at the moment of truth to make your final decision on the trade. Now, how do we go about doing that? Remember, we discussed this back on day 2, and we went very in-depth on this on day 2. This was the whole basis of looking at the order flow. We talked about the 5 important factors that we would see on the tape. The speed, the speed that the prints were coming in. We'd see the size of the prints coming in. We could see who was in control, buyers or sellers, who's more aggressive, who's running the tape right now, and especially seeing the change in control. We see the results. Are they getting anything for all the size that they throw into the market? We see thousands of lots being sold at the market, and they can't get price to move. It's being absorbed. They can't get results. They're probably not going to get it rolled over there. And then we also see levels of interest. We might see that a couple different ways. We might see that buyers just will not step into this market, and all of a sudden we find a level where they're trying to hold it. They start coming back onto the tape. Very closely related to the control. They're trying to come back and take in control. There's other ways that we might see this. Some of this we didn't talk about as in depth, but there might be levels that keep coming back over and over. And we watch this number that keeps appearing, and they move away from it and they come right back to that. See, there is some kind of interest in that level, something going on there. So these are things that we're going to look at. And again, go back to day 2 and review this. By understanding these things, by doing the drills that I gave, remember, that's what allows you to come back in, use these things, identify these things, and then we talked about practical applications of that. Again, I'm not going to go through this in depth here. We spent over an hour on this on the second day. That was the primary thrust of our second day. And so remember, we use this to identify a reversal in our example, but we could see the same thing. If we were looking at buying a pullback, we're going to be looking at the same basic things in the pullback, or let's say that we've been in a downtrend and we're looking to short that downtrend, and now we've had a little bit of a retracement rally. See, we could come in and still view that in a sense as a reversal. We're looking for the one-lot buyers, to perhaps speed up. We're looking for the large buyers to disappear. We see kind of a stall, kind of a freeze where it just all of a sudden nothing happens. We come up into a level like that, and there's a price that they keep trying to get bid, and they can't get the bid to stay there. We're looking at the dome. There's a little small offer out there. Nobody will step in and hit it at the market. And then you see the large sell orders come in. Several rows at once drop into place on our time and sales. We've just identified the point in that retracement where it's safest to enter and get back in line with the trend. So we're going to use these same factors over and over on our tape. Now remember, this is something that we're going to do whether we're price action trading from a chart or whether we're using an indicator or two. We talk about improving the win-loss ratio. Remember, we discussed that. Identifying situations where we think we have a trade set up, and then the tape tells us, no, not yet. It's not here right now. It improves that win-loss ratio. So any questions on that, I would say go back to day 2, review that session. That's where the bulk of the information was for the market flow, for identifying what's truly going on. The next thing that we said we were going to discuss was the sim trading. Now we've already addressed this morning a couple of questions about the Forex, and I've gotten comments back from several of you guys already that have already went and opened up accounts and they're trying to put this to work, and I would applaud you guys for your efforts there. You know, within 48 hours you can have that account open and funded. And even if you just put 20 bucks in there to keep you busy when you're bored, at least you're going to learn something, and you're going to learn effective management, and you're going to learn that it's real money and you can't just, piddle it away. You're still going to treat that as serious because it matters. It's not like a sim account. So for you guys that have already done that, if you have questions on an ongoing basis, some of you that have done this have had some experience with spot Forex, moved away from it at some point, and now you're saying, yeah, you know what, that makes sense. But bottom line, we have to trade smart. The game that we're in, we've got one primary thing that has to happen to succeed, and that is we have to stay in the game. And so depending on the income that we have and the money that we have to tailor that as we pick an instrument to trade and we pick a size to trade. Because if we don't, I would say take your account and go to Vegas, play games, because at least you get free beer. You go in there and lose a bunch of money. I think if there's any questions about the Forex, I've debated about doing a little Forex workshop just to have it on recording. I may do that in the future. If anybody has interest in it, let me know. But, Forex is kind of different. It can be kind of intimidating to people at times. But in reality, there's some very basic precepts that we can take over there and still trade. Ken, with your question, you said, is there any advantage of trading from the tape only? I would say the biggest advantage of trading from the tape only is bragging rights when you get around other traders and they can't understand it. Honestly, for the majority of situations, there really is not an advantage. If you had to try to come up with an advantage, and I think it would still be a bit of a stretch, probably the only advantage that would give you is you've got no setup, no reason in the world to take a trade, and you could come in on the order flow and try to scalp. If you're trying to scalp, though, I think you can get the same exact thing using your tick chart. Watch for your little retracements, watch your swing highs and lows, watch your little retracement, jump in there with it if we see it rotate on the tape. So I have to say, for all the trouble to go 100% from the tape, there really is not a good advantage. I've encouraged people in conversations, in emails, in the Tape Reading Made Simple video, is don't waste your time trying to learn that. It is something that for most people will take a year or two of practice, and then once you do that, you're able to go nip off 5-6 tick trades on the YM. To me, that's it's mentally exhausting. I can go 20 to 30 minutes and I feel like I've been sitting there for 14 hours. Not a lot of advantage or reason to do it. Other topics for discussion, and I kind of cheated on this because of what we had going on. We've had a lot of good questions, and we've spent more time on some of those questions than I had allotted to cover all of our material. So remember when we talked about this, I mentioned this, and some of you, actually, there's some of you here today that weren't here yesterday, but you probably noticed you've got a couple videos sent to you last night, and these were videos that were for sale on my site. But I put those videos in here because I wanted you guys to have a broader understanding, and we just were running out of time here. So when it comes to dealing with the damaging emotions, you would have received a video download link yesterday, and that video download link, that was for dealing with fear and doubt and hesitation. And you can basically flip the same tenets, the same principles, if your monster is greed. I think more people have problems dealing with fear than they do dealing with greed. So I appreciate that, Gerardo. Those videos, again, we're in a situation, probably the best thing we could have is a psychologist to sit with us. You look at all the, again, we'll go back to the golfing arena, and it's not enough to have a swing coach. Now you got to have a swing coach and a short game coach and a putting coach, and you got to have a psychologist. It is a mind game, but for many people they can't afford it, and we end up having to medicate ourselves. So, and hopefully we don't go the same route that some choose to medicate themselves. I don't think Jack Daniels and Coke is going to be a good combination with trading. But you know, when we look at those factors in our psychology, there are some principles that we can try to work through, that we can try to apply. And I would say it's still some of the best things when we're putting it all together. Some of the best things that we can do is keeping that journal, write it by hand, and prove to ourselves the logic of what we're doing. If we've back tested this and we've worked it and worked it and worked it and worked it, the danger that we have if we keep doing that is market conditions are going to change, and about the time we finally get the confidence and go live with it, it's going to change so much that it doesn't work anymore. Keep those thoughts in mind. Try to apply that as quickly as we can. A question here, Karen, you say quick Forex thing. With Forex, is it not true that one does not have to deal with contracts expiring? That is very true. One of the points that you make here, and this is something that I said earlier, and for you guys that have traded with me, you've seen this. It's one of the things that I like about Awanda is I can trade off over the weekend. Even though the Forex market is closed, they will still allow me to trade up to 10 million a click. Now, if that's the case, and it's a continuous contract which never expires, what does that suit it for? Swing trading. We got a market that has beautiful, beautiful trend moves. The trends go so much further than you ever think they're capable of going. Week after week after week, these trends will continue. We got a continuous contract. We can scale it as big or as little as we want. We can be protected over the weekend. Our stop will still work. You see how it's suited so well for the swing trader. So you can come in, like I mentioned earlier, even if it's just a little side account, you can come in and put some swing trades that are 20 cents a tick, 30 cents a tick, and take a little $50 account, take little positions, a little $5 risk, $3 risk, $4 risk. You can pick up swing trades. I think the largest trade that I've had this year on the Forex has been 1,700 ticks, and I guarantee you I never came close to that on any futures trade. We would call it pips in Forex, but since most of you guys aren't Forex traders, we'll call it a tick. 1,700. And it's just because of picking it up and letting it run and run and run and run. Ironically, just on a personal note, with my trading for the year, the largest money I made this year, and this was I just closed the trade out, but the largest amount of money I made, which was actually more by 6 figures more than all of my other 7,000 odd lots put together, was based on currency. And it's a position that's been open for a couple years. So, yeah, Karen, you say you're already looking at that with the smaller account that you already had, um, where you didn't realize even or weren't even thinking about being able to trade forex. You're already doing that, and like you say, you're on the right track. That will be the thing that helps you with scaling. When you start looking out there at a 400 or 500 tick target, and you say, okay, I've got $2,000 worth of position here, and I can take it off $100 at a time. This is where I'm going to scale out. As you examine that, you're saying these are the logical areas, and that in itself is going to help you with the current topic, which is dealing with the fear and the greed. Usually if we're afraid, we're probably realistic that we know we're in over our heads. And that point I do make in the video. For a lot of people, when we look at the fear and we say, is that fear rational? Does it make any sense? Frequently the answer is yes. We should be scared because we're doing something really stupid. And if that's the case, this is one avenue to get back around that. I'm going to stop here, reset the tape. Any questions, put your questions out as we go. If I missed your questions, please put your questions back in. The questions, for some reason, it's kind of flickering and tweaking out on me on the platform here today. So if I missed a question, put it back in, and I'll be back in 2 minutes. Okay, so we got a comment here, and Karen, if you don't mind, I'm going to just mention this because I think most of us have gone through it. I know I have. I'm sure everybody has. And you say sometimes you still freak out because you got stopped out so many times before, and that has not gone away yet. Those negative experiences need to be replaced with positive ones. It is something that when you think about negative experiences typically leave a much stronger impression in your mind than positive ones do. And that is one of the difficult things that we have to deal with, whether we're golfing, we're trading. We come back to these negative experiences. So, sometimes it is a matter of rebuilding ourselves where we have to come back and trade for a month from a smaller position and say, that wasn't so bad. That wasn't so scary. I got my butt whooped all month and I lost, $12. I can deal with that. And we start building ourselves up. I think for most of us, we're probably in a position where we've had to pick ourselves up by our own bootstraps. It is a good way to go about dealing with it. And if you can take a negative experience and it really didn't cost you a lot of money, it actually doesn't leave that bad of an impression. Once we're able to figure it out and become consistent on the trading, then we up the size and we've got a decent memory base now because we don't have these terrifying trades that just totally whooped us. I remember a trade that shook me. This was back in 2000, and I entered a trade 1,000 lots of a real high flying stock, and that trade went positive very quickly. And just I don't know, something had happened right at the open, right after I got in it, and I was $3 positive on that trade with 1,000 shares. And this happened. When I went back and looked at it, in my mind, it was 3 or 4 seconds. It was actually about 45 seconds that I went from entry to $3,000 positive. And then the stock whipped around, and I have never seen such a draft where, and if you've ever traded equities, you realize back at that point with the platforms you had to go hit somebody. Otherwise, you're just placing orders that will never get filled. And the entire book just disappeared. And it was news that had hit that was not a scheduled news release, and it completely changed the mentality of the market. And I placed 4 orders and canceled those 4 orders because the price was already gone. and it just left me a limit order hanging. Price was already gone. And I, at that point, considered myself faster than average, more decisive than average. And I was trying to hit market makers that just kick it away and won't touch it and disappear. And I was fast enough to get the order to them, but they wouldn't fill it. So I came in, I finally saw down in the book, I saw Island hanging out there. Island at the time was the ECN that most individual traders were using. Archipelago was just becoming more widely used. Island was the big boy, which later merged with Instinet. And I saw Island sitting down there, and I killed the order I had, and I shot the order straight into Island and was able to hit somebody who was snoozing. I went back and I looked at my order log, and that entire thing happened in 18 seconds. In 18 seconds, I had to place those orders, try to hit them. They rejected, moved away, killed the order, try to hit somebody else. They reject it. And you had to wait a couple seconds to get your confirmation back. In that 18 seconds, I went from $3,000 positive to $8,000 negative. And it made me, it affected my confidence literally for weeks after that I was scared to trade. I had never seen anything draft like that or move like that. I was always cautious. I always stepped out at the news releases, and I got nailed by something that was not a scheduled release. So you take one negative experience like that and sit there for week after week after week that I could not enter a trade. And here I was trading thousand lots of $250 stocks prior to that. So those negative experiences, all of us have had them, all of us will have them, and at times it means going back. I had to go back to 100 lots and just trade 100 lots and build myself back up and say, okay, it hadn't happened to you before in 4 years. It's probably not going to happen to you again for 4 years. So just get over it. And I had to build myself back up. So that kind of stuff happens, and it sticks with us. And that's why the danger that I see, frequently the trader goes back to sim. And as soon as you go back to sim, you're not dealing with reality. I know, we laughed about Kevin with his sim Maserati. We laugh about Victor with his sim steak, sim lunch, with his wife. But bottom line, those are the problems, and we get beat up. We go back to sim, and then we start learning bad habits. So I do think that these two topics are related: learning management and dealing with fear and greed. Both of those can be resolved to a large degree by trading a size that is fit to our account. And usually, for most of us that are just getting started, that's going to mean going back over there to a Forex account, or if we're overseas, going to CFDs. We'll keep going here. Another one of the items that we mentioned we were going to cover was managing the trades. When I look at the strategies, we talked about that fairly in depth. There's a few things that I would encourage people to look at. If you're trading reversals, you have to be able to see the potential if you're right when it comes time for management. And the problem that you'll have as a one-lot trader is you look at the potential and you say, if I'm right, frequently, let's take the S&P as an example. Frequently, we come up here and we get a new high of day by 3-4 ticks. We've ground up all morning. We get a new high of day, 3-4 ticks. We see sellers hit it. We take our short. We're out in 8 ticks, and it runs 15 points to the low of day. You're in a rough spot as a one-lot trader, because if you try every time for the 15-point move, you're going to have a lot of scratch trades. You're going to get up your 2 points. You're going to go to break even. You're going to get stopped. You get up a couple points, come back, get stopped at entry. And it's tough to do that time after time after time and not make some kind of forward progress. Again, when I look at the management, you will learn more about management coming over, taking a small Forex account at Awanda, take $1,000 position, scale out of it in 10 or 12 places. That is where you're going to learn money management. That is where you're going to learn how to take care of your trades. This isn't hypothetical money. This isn't sim. This isn't something so big that we can only trade one lot. This allows us to size it correctly, teach us what a professional trader would do, and we can scale out and scale out and scale out. When you do that, it goes back to what we were just talking about. You're building positive experience. And eventually you'll be able to take that experience and put it into the futures arena if you want to go large and trade that route, and you'll be able to handle it just as effectively. Does anyone have questions as far as strategies go? We talked about it. I addressed one comment on it already this morning with the one lots. I would say the most important things with management, it starts with your entry. Get a good entry. When you have that entry, you should already have a fairly good idea of where your dream target would be. This is where I would like to see it end up. But then you're also looking at reality, and I would say for me, I look at that before I ever even get in the trade. And if I can't see at least a 1-to-1, I'm not even going to take the trade. I have to have at least a 1-to-1 and a few ticks to spare before I run into the next support or resistance. Otherwise, I won't touch it. So pick a good target, know that in advance, make sure that your risk reward is there in advance, that you'll be able to get out without being required to get a new high, and start chewing away at that. If you get in the position and you're trying to manage a runner, go to a longer time frame than what you entered from. If you entered off a 500 tick, go to a 1 minute, go to a 2-minute chart, go to a 5-minute chart, and just look at that. If you picked a reversal, what potential do you have on a 5-minute chart? Trade it out with your volume spikes. We covered some very effective things. Go back through and review those if necessary. The trading plan, we talked a little bit about the action plan. Sitting down in the morning, picking a few levels, deciding how you're going to trade those levels. For me, because I do prefer reversals, that gives me scenarios at the high and the low. It gives me scenarios at any support and resistance level. And when I get to that level, it's either going to go through it or it's going to get rejected. So if you've got just a simple action plan there, that's going to put you in good stead, because now you don't have to sit there and try to force a trade out of thin air. I do think that choosing levels, regardless of how you choose them, is going to be one of the best things you can do. As you choose a level, whatever the basis, it's a random line, who cares? Gauge the reaction coming into that level. I want to thank Karen again, and I got the video changed. I'm going to be sending out the alert indicator that Karen made this afternoon. I got the video made and I just need to get it uploaded. But that is something that I have enjoyed so much, because I could put multiple levels on a chart, and then I can just lean back, take a nap, do whatever I want to do. Just wait for the alert to fire off. It's the best plan a guy could have, is wait for it to get to a good price and then watch the reaction and take your trade. So I want to thank Karen again on behalf of everybody. And again, I just ask that you guys that have requested this, please remember what Karen asked. Don't pass it around. Don't post it on a forum. She's been very gracious sharing this with everyone. Andrew, your question, does that work only on 6.5 or also on 7? That will work either way. And there's a little bit of coding that you change, and you've got to make sure that your sound alerts are in the right folders. Unless, Karen, did that last version you sent me, they'll still need to either change it for 6.5 to look in the 6.5 folder or the 7 folder, if I understand correctly, right? It's not going to do it automatically. And Andrew, what I'm referring to in the coding of this indicator, it tells it to go to a certain folder to pull the sound file that you're going to play. So if the indicator was coded for 6.5 and you're using 7, you have to go in and say, don't look in the 6.5 folder. You change one line, look in the 7 folder, and the video will show you how to change that. It'll show you how to change that and how to compile it so that it works. I had some trouble with it initially because I had mine installed into an F drive, and being on the F drive, it was looking in the C drive, and the sound file wasn't there in the C drive. Couldn't get it to work, and then it finally dawns on me that it was trying to pull a sound file that didn't exist on the C drive. So the video will show you how to come in and change it. Yeah, actually, Karen, on that, Karen makes a comment that they'll probably need some type of a digitization program to create a WAV file. I go through, and in the video I show how to create your own file, because I created some goofy sound files. So the video shows how to come in and just create your own custom sound file. I wanted mine created so that it would call me to a specific chart. I did one for the instruments I trade. So I've got one that will call me to the S&P. I've got one that'll call me to crude, one that'll call me to the NQ, and so forth. And I created just it runs for about 8 or 9 seconds, plays a little music, and it's got me being an idiot, saying the name of the instrument, just messing around. And so when it goes off, I know exactly what chart to open. I know what's firing. I don't have to come in. It's not just ringing a bell and I'm going, stink, I don't know what that bell is. So it'll show you how to set that up. Several of the guys here, again, are saying thanks, Karen. They appreciate you doing that. Even though they haven't received it, they're saying thanks in advance. So again, if anybody else there wanted to get that, let me know. Some said, please send it, and some said nothing. I shouldn't say they said anything. They're just no email. So I will be sending that out today to the ones that requested it. Trading plan, if you have questions on an ongoing basis going forward, I don't mind people sending me an email here and there, saying, hey, I was looking at this or looking at that. Just feel free. If you run into some problems with it and you're trying to figure something out for trading plan, for management, just let me know. Something else we said we were going to do, I was hoping to have some time in live markets to do this. I made you guys that are attending an offer that I would go ahead and just, we could go ahead and set a day to trade together. And I will still do that. We'll deal with that in a few minutes. But we're going to just review this again real quickly when it comes to trying to track those market manipulators. Remember, we saw kind of a live example of tracking this on the soybeans on 2 occasions, where we looked at our dome and the level 2, and we saw large size out there. And remember, the second time when we turned that on, we were able to watch that print off on the time and sales. Usually for the manipulation, it will catch your attention first on the dome. Something is going on the dome. So let me just pull a dome in here. If I can find it, here we go. And what we'll see on the dome that will usually catch our attention first is something unusual will appear on our dome when it comes to the size. Now, when I look at the things that I would refer to as manipulation, let's talk about just a couple of examples real quickly. We do have scenario when we've got a thin book like this that we may have some big size. We may have size that just sticks out like a sore thumb, and we come in here and we see 700 up here at a level. And when we've got a thin book and you see that, we're looking up ahead in our level 2 and saying, is he here, and is he here, and is he here? Because if he is, and he can flag in a buyer, we're going to see it continue to run until this guy is done. So how do we find out whether this is real? It's going to be going back to our time and sales. We move into that area. If we move into it, 1, that tells us we've got a buyer. There's a buyer in the market. 2, what does he do when he gets here? Does he just chew into this, start taking him out? If he whips into that level and starts taking him out, we're going to see it on the time and sales. But if that 700 just disappears, and we look at our prints and there was 3 lots went off there, what does that tell you? Someone's trying to manipulate the market. They were trying to spoof in or trying to pull in a buyer, but they really weren't there to sell. They were just trying to wiggle the price up a little bit. So You won't see that as often on the S&P. That type of behavior. They're not necessarily going to try to flag someone in. But you get on these thinner markets, especially the real contracts like your commodities, this type of stuff will be fairly common, where they will try to bring it in and get the hedge off. It is by far the most common on the soybeans of any market out there. Now, when we talk about the 6E, will they put orders out there specifically to flag in somebody else? Not very likely, not very often. You'll see it maybe once or twice a month where something like that catches your attention, but it's not going to be common. It's not like the beans. When you come into this time of year, they're harvesting, the crops are being brought in, farmers are taking hedges off, the storage facilities are taking hedges off, the end users are taking hedges off. It goes crazy for uh, September, October, November into December in the soybeans, this type of behavior. When that rotates back down South America way, with Brazil and Argentina, which are the number 2 and number 3 producers in the world, you'll see it pick back up to a limited degree as they start to harvest in our spring, but it's the most common coming into our harvest here in the fall in the States. The games, if we were to look at this from the standpoint of the S&P, what we're going to see is the big thick prices coming in at every level. And we look at it ever since May 6th when the flash crash occurred. Our visible book went from around 12 to 15,000 down around 4 to 6,000. You see that pick up, and all of a sudden it's up there 14, 15,000, and this side is still 6,000. Again, it gives us an indication that someone is there trying to manipulate the dome. And you're going to see this most frequently on the S&P, the Euro Stoxx 50, the German treasuries. And they're trying to get people to step in front and come over here and hit the bid. So we start watching that. You've got a little small bid. Again, we go back to our time and sales, and we look at the time and sales, and we see print after print after print after print, and we realize, hey, 400 or 500 has gone through, but there was only 100 showing here, and they just keep printing and printing and printing and printing and printing. It's going to go higher. Very likely they're getting ready to punch it higher. What do? You go in with them, follow them in when you identify it. If you were getting ready to take a short, let's say that we're in a sideways consolidation, and we see that start to break down, what will happen? They'll put an iceberg order out there. They start accumulating size. They start making it look heavy, make it look like it's going to break down. They wiggle it down 3, 4, 5 ticks. They start wiggling the thing down. We get in with them. We need a small stop, and we know that they're going to try to punch it through and get some stops above the consolidation. We've got a trade. Get in with them. So again, we take what appears to be an anomaly, something goofy that's not normally there. We watch what's actually happening. What are the prints actually doing? And that can give us a trade with them if they're there. If we don't understand it, then try to learn something from it for next time. A couple questions here on that. Yeah, Sean, that's what I just said with the manipulation on the 6E. That's what I was referring to when I talked about not seeing this type of behavior that we see on the beans where they're trying to flag in a seller. And yet at the same time, the dome is not thick enough that a big manipulator can come in and stack 4,000 lots there to make it look heavy. So when you look for the manipulation on the dome, that is going to be most common when we come in contracts that have at least 1,000 lots of level. If you look at your dome and there's not 1,000 lots of level, there's not going to be a whole lot of manipulation. You can still spot iceberg orders if you're paying attention. I spot them on the YM, I spot them on the NQ, and you see guys accumulating a big position with an iceberg order. But rule of thumb, if they don't have some size over here to hide behind, they're not going to put size out that they don't want filled. They know they can't cancel it fast enough. If a big aggressive trader says, hey, I know what you're doing, I'll take you out on that offer, and he comes and hits him, he may sweep him 6, 7 levels, and he didn't want to sell right there, and this guy runs right through him. So you have to say, that's the danger they face. And if there's not enough size on the dome, they can't play that game very easy. Again, the iceberg orders, it'll catch your attention at weird places. You get a little tiny offer on the NQ, 10, 12 ticks. I mean 10, 12 contracts on the offer or on the bid, either side, and then you see a flurry go through there, 100, 150 contracts go through there, and yet it still says 10. Somebody's accumulating a position with an iceberg. If that's the case, we've got to decide risk reward. Does it make sense at this point to go in with the guy on the iceberg and trust that he's going to go further, trust that he knows something we don't? The danger with that type of strategy is the guy could just be accumulating a couple thousand lot position that he plans on keeping until January 32nd. That ain't going to happen. January 22nd. Be an idiot here. Pull random numbers out of your head. I guess you got to be below 31. He's going to hold this position until the middle of January, and we go in hoping he's going to move it right now this afternoon. If you see the behavior in the market you're trading, watch what they do with it. Usually for the manipulators, I find it most common that the manipulators are trying to get 6, 8 ticks, 10 ticks, and out. And if they've got some position left and it runs further than that when they hit stops, then they look at it and say, more power to us. But their goal is get out of the trade as they hit into the other stops. Let me get this down. We had some material that I went through that initially I was not intending to put into this presentation. And I didn't talk about it at length, but I decided to put it in there. A couple things that I want to take away from this. Do you guys remember, as we discuss this, the strategies that will affect us? You got your program trading, which is very short time frame. They're less than 2 minutes. Doesn't usually move the market very far. You've got your, and when I say program trading, I'm talking primarily index arb. You've got your guys that are doing the longer term moves, your 2 hour and less. Those guys are primarily using a what they call mean revision. I've always called reversion to the mean, but they take a move that's gotten out there a little extended and they're going to fade it back into the average. If you're seeing that in your market, and it may change going forward from here, but if you see that becomes more and more common, it's really forcing us to pick a level in advance when it appears that the market is rallying, and it's causing us to step in and say, no, I'm going to short it and let this thing go back. That if that's the strategy they're using in our market, we're going to have to work with them. I asked the question initially, can we trade against them? Our goal ultimately would be, if we can identify what they're doing and how they're doing it, not to trade against them, but to trade with them. So if we see in our market that the move gets out extended, we get a nice run up, we make a new high by 3, 4 ticks, and sellers clobber it, then we're going to look at that and say that's a good strategy for me. Where do I see that? I see that in the S&P. That's why I'm always looking at those new highs. We get 3, 4 tick new highs, you're going to find me in there looking for a short. Why? Because they knock it back frequently far enough that I can get a first target, get to break even, and if they reverse it and take it to the low of day, I know I can still be in the trade. If you're trading the 6E, is that an effective strategy? That's probably a good way to get tore up, because the moves tend to keep going. On the 6E, you watch the wiggles on the 6E, and they will push it back and forth 15, 20 ticks. If they're pushing that back and forth 15, 20 ticks in a candle, what does that tell you? Here's the wave coming up on the beach. We see the speed, we see the momentum. They stopped it right here in the last 5-minute candle. Let's take it again. We'll do it 1 candle, maybe 2 candles, and then we'll step away and let them play with it again. The 6E, I prefer a 5-minute chart, and I like looking at the tails. If I see a tail that indicates aggressive buyers came in and pushed it back up, I know they will push it back down there again 8 times out of 10. And then from there, probably 7 times out of 10, they will push it right back. Does that allow me a 10 tick scalp? Absolutely. I do it frequently. Pull that trade back off, throw that back into the euro US dollar, or put that on the 6E if the market's open and running good. I'm just hitting 29 minutes, and Andrew put me a reminder here. Thanks, Andrew. I'm hitting 29 minutes, so I'm going to reset, and then any questions that are there, I'll answer as soon as I come back. Okay, so a couple questions here. Karen, you say, I've mentioned that some markets are primarily fading markets, some are not. Can I review that? You'll find frequently that the indices, the new highs are faded very quickly. So let's get rid of this for a moment. For some of you guys that may not have traded as long, I'm going to just diagram it out just so we've got a good understanding of what I'm referring to. Let's say that we look at a market, and here's our overnight high, and it's also the high of our morning session. And we've looked at that level and marked that level. And actually, let me do this. Let's just color code this. And let's say that we've had our overnight low, and it's also our session low for the morning session. This is our low. And frequently what you will find is that price will rally up, and we hit this level, and we get through it 3 or 4 ticks, and immediately you'll see sellers come back in and jump that, and they're going to knock this thing right back down. Now, as a scalp goes, you've got essentially a few ticks in here, 6, 8 ticks, 10 ticks on the S&P, that they will frequently knock it back, and they may come right back after it, and they'll come into that level again, and they'll get another couple tick new high, and immediately you'll see sellers come back in. They'll knock that thing back 6, 8 ticks. And you have to say, if you go back and look at tick charts where you can actually see these little swings, and you examine the S&P and the Dow and the NQ, you will see that the majority of moves that were up at the high, the majority of moves that come all the way back to the low of day, come off of this pattern right here. They take it up 2, 3 ticks, new high, get in some breakout traders, get some stops down here, and they'll fire it off all the way through the low. So if that's the case, that's what I would call, this would be what I would say is a fading market. In other words, when we get those new highs, we fade it, or if it's running into us coming up, we're going to sell it as soon as we see the sellers. If we come into the bottom, it's being sold, it comes down into the bottom, and what are we going to do? We're going to fade it. We're going to buy it for a move back up off of that bottom. The danger to this, the first move is where your danger is, because they may just keep right on going up. Second move, third move, it increases the likelihood that they're going to fade it, knock it right back down. So you see a big hairy move that just runs and runs and runs and runs right up into the high, I would say be cautious the first time. Come right back, it makes another new high, you look for the sellers, take a scalp on it. Comes back, takes another new high, take a scalp on it. Because of the way I trade, when I hit that in an area like that, I now have an entry right up here 3, 4 ticks off the high, and I can view it as a scalp, and I'm getting out part of my position here. But if they crack it, which they eventually will, and head for the low of day, that's where my target is. Because they do it so often, I look at it and say those are the 8, 10, 15 point moves that I get on the S&P, is where they just came off of a new high and they run it right down to the low of day. The rest of the time, here you get a target scratch on the final portion. You may do that 2 or 3 times. You get your first target, stop out at break even. Get your first target, stop out at entry. And then you catch it and you run for the other side. And those are the situations where one lot traders have trouble, because at that point, you've got to just view it as a scalp. And you view it as a scalp and you get out right here and then it falls 15 points and drives you crazy. That's the curse of being a one-lot trader. But you have to, over time, build the account up, get the account big enough that you can stay in there for the big runs. A couple other questions here then in dealing with this, the opposite of this, what would we be talking about? Well, this would be something where, again, we've got our high of day and our low of day, so let's just put those in here. Here's our high of day, here's our low of day, and the opposite to this would be the scenario where we buy up into that high of day, we pull back, just stay right along that high of day, and then we break and it doesn't get faded. It comes back, if anything, let's say it comes back to this level real quickly, and then immediately they just buy it up and it runs and runs and runs and runs. And as they get up to a double top area, it looks like it's going to pull back, and it pulls back just a couple ticks, and it may pull back to a prior pivot, and then it just breaks again and runs and runs and runs. That kind of behavior you'll see like in your currencies, where the breakouts on a longer time frame, like a 5-minute, 15-minute chart, those moves tend to run. So when you come in and you see the consolidation, if you're on a 5-minute chart, you may have some nice trades appear there, but you have to always keep in mind that it's a continuation pattern. A consolidation is usually a continuation pattern in that type of market. When we come into that and we're trading that, we have to understand what that market's going to do. On the 6E, what do I like to see? 6E, I actually like to see a scenario where a 5-minute candle trades up and we've got some real bars and we come up into a level, and this last candle forms solid green candle, but it leaves a tail, and this tail may be 10 or 12 ticks. The very next candle, as we come back up here to this level and this candle is forming, it's going to be a solid green candle. I would be coming in and shorting it right up in here, because once we come up and find sellers, as we come back up into that, it's very likely that they'll be there again. And what I'm trying to do is I'm trying to get into that trade and hope that this candle does the same thing, leaves the wick. That will happen frequently on the 6E, where you'll see on the 5-minute candles, and we'll just label this 5-minute, you will see that happen 4, 5, 6 candles in a row. Or in other words, we're talking 20 to 30 minutes, and then it will go tearing on up out of there, heading for the highs, keep on moving. So when I see the big tails on the 6E, that's where I would be, for an intraday trade, that's where I would be most likely to take the trade. We push up, we have a 20 tick candle from high to low, we push up, leave a 10 or 12 tick tail, we push up again, it's probably going to leave a 10 or 12 tick tail. That leaves me room to get 6, 8 ticks out of it, and I don't need but 3 or 4 to prove myself wrong. So as quickly as you can identify that consolidation forming, play it once and be gone. Take your scalp and be gone. Thank you very much. Take your money and run. That is where Ken's stick comes in handy, and you pull that you pull that money back off the table. So, Karen, your question, you say you often see in indices the fading behavior. Is that usually true in the grains? Yes, the grains frequently will come up, and it's not even so much. I look at the grains a little differently. The grains, when you come into the high, if it can get through it by about 2 cents, I'm cautious. That would be the equivalent of 2 points in the S&P. I'm cautious because usually then, if you get through it by 2 cents, you're going to have this little pullback, and then when it comes back to that high, it's going to fire higher. So to me, when I look at that, like on the beans, I would look at that at the high and say I would view that high as a reversal point, and it's likely to reverse there. But if they get through it 2 to 3 cents, I would be more likely to buy the pullback than I would be to try to short it. But if it comes up there and it goes through 1 tick and I see sellers hit it, I'm going short. The thing you got to remember, like in the grains, that's different here than the S&P. And I guess, yeah, the S&P is a real product, but we're talking something real with a cost of production. We know that beans, on average in the United States, $7.25 a bushel to produce. It has a real tangible cost, and it's a real tangible item. So if that's the case, when we find a value area, and let's say that we came up to yesterday's high, and it fought that price several times, what's going to happen when it comes back up into that high again? If farmers look at that and say, you know what, I really wish I would have just put my hedge on yesterday, they're going to come in there and short it coming into those highs. Anybody that's trying to time the market, they're finally in there watching the futures, they're trying to decide what to do. They're going to come in there, and you're going to have your producers step in, and they're going to say, boy, if we come into those highs again, I'm going to just sell and lock it in. That was pretty rich, and I'll take that for my crop. I want to lock in that in case the price falls, and if it continues to run against me, it doesn't matter, because now I'm hedged and I'm completely neutral. I know I got 10,000 bushels in the field, and I've got to short for two contracts, 5,000 bushels apiece, and now price can do whatever it wants to do. I don't care, because I just locked in $13.35 a bushel. So they do tend to be faded very frequently. They'll catch little ranges, and they'll go through these ranges for days or weeks, and then they'll break the range and they'll establish a new range, and they'll go for days to weeks in the new range. The question here, Karen, what is the difference between a big trader that is a hedger versus a speculator? You know, the industry, when they talk about hedgers, they're not necessarily talking about a guy that can concurrently buys the ES and then also sells the ES at the same time. Usually in the industry, when they're talking about hedgers, what they're referring to is an institution, and let's just clear this out and start over. They're looking at an institution, and this institution owns, you know, when you look at their buy side, let's say that between the Dow components, you know, these 30 companies that make up the Dow Jones Industrial Average, let's say that they own 45 million shares of those 30 companies. So they look at their risk over here, and how do they protect themselves from that risk? Well, that is by hedging. So they'll come in and they look at the contract, they look at the mini Dow, for example, if they're going to hedge directly off against the Dow index itself, and they'll say that trades at $5 per point, and they'll look at the current price, let's say 11,250. They'll multiply that 11,250 by $5. And when they do that, essentially what they come up with is that contract is worth right about $56,000. When that happens, they're going to look at the value of their shares, and they're going to say the value of these shares, let's just assume that the value of their shares is 150 million. And they look at that and say, our exposure, because we think the market is going to drop, but we're not going to sell this position, our exposure, they can do the math and say we need to pick up the equivalent of 20 or 30,000 contracts to hedge our risk over here while the market pulls back. And once the market pulls back, they take this position off, and now they let their stock go back and increase in value. So a hedger owns something, and he's trying to protect himself from risk. The speculator, he just looks at it and says, I think the market's going down. What do I want to do? I'm going to short the Dow. I'm going to short the, that YM. I'm going to short the ES. I think it's going down. So the speculator is not trying to protect a position. He's just speculating on which way it's going to move. The hedger is trying to protect himself and shield himself from risk. So when we come into the commodities, let's take several examples. We look at gold. Who are the hedgers in gold? Anybody want to throw out some ideas? Let's do the same thing. We got beans. Who are the hedgers? We talk about gold. What are the producers? We have mines. Your mining companies. You have uh, oh, didn't make a very good O there. Gold owners, people that have a large inventory of gold. Are they exposed to risk if they bought a lot of that gold at 1,200, 1,300 an ounce? Are they at risk when it pulls back? Absolutely. So they're going to try to find a way to hedge their exposure to that. They've got physical gold sitting there in their vault, and if they see price patterns or fundamentals change and they think it's going to fall in value, they're going to come in and short contracts. Same thing with beans. We've got our farmers. We've got our storage facilities. We have our end users. And you're going to see the same thing in gold. The end users, it may be jewelry companies, it may be someone that's producing coins or trinkets or who knows what. But these guys have vested interests that they have to protect. We come in, look at the same thing on the S&P. What do we have? We have individuals who own stocks. That's going to be your big hedgers. They own positions in stocks, and they need to protect those positions in stocks. In any instrument that you look at, futures is there to allow them to alleviate their risk or protect themselves from the risk. And so that's what they would refer to as a hedger. It's not talking about a hedge in the sense that they buy and sell the same contract and they have a long and a short position and they're waiting to see what happens. It's usually two different things that are interrelated or interconnected. The questions, I think we've covered the questions. Yeah, Karen, your comment here, you say the test of a prior high is an interesting thing. You read an article about the psychology of what is a perceived high price. And then you refer back to yesterday when I said someone got greedy, thought the market would go higher. It reverses. They wish they had taken the trade-off at that price because now it seems to have been the high of the time period. When it gets up there the next time, the people that wish they got out at what was the high, they want to get out at that price. So you're looking at that, how it influences the trader. That is the whole underlying principle behind support and resistance. You've got guys that wish they would have shorted it there because they saw it fall. What are they going to do? They're going to short it again. You've got guys that wish they would have taken profits there. What are they going to do? It gets there again, they're going to sell it. You got guys that have been underwater for 3-4 days and they've been sweating bullets. It comes back to their entry price. What are they going to do? They're going to bail. That creates support and resistance. That's why those are valid areas to look for some type of reversal, some type of change in the current move, because people have a memory. If you guys have ever gone into a seminar, like a multi-day seminar, or if you think back to school, what happens when you walk in and take a seat? You go in, you look around the room, you look for a seat that's comfortable, you go sit down there. What happens tomorrow when you come back? Somebody's sitting there in your seat. You're like, get out of my seat, dude. That's my seat. That's where I sit. See, we become very, very much creatures of habit. You go to church, what happens when you walk in there? You sit in the same place every time. We're creatures of habit. We find something comfortable and we go back and we go to that over and over and over. So same thing happens in the stock market. People have something happen there. They missed it. They kicked themselves. They beat themselves up for 2 days. It comes back and they're like, oh man, I'm not going to miss it this time. So that's the whole underlying principle behind our markets. Our technical analysis is just the fact that people do it over and over and over. The presentation here, a couple final suggestions that I want to go through. We've talked about this as we've gone through here so far. But I would say for anybody that wants to do this, focus on one market. And when you pick your market, look for a market that trades the way that you like it to trade. If you like fading new highs, picking off reversals, don't try to go trade the 6E and fade new highs. Don't try to trade gold and fade new highs. You're going to go over there to markets that tend to be faded. So pick something that suits your temperament. If you like continuation moves, you like trend moves, go trade things that trend. We want to stack the odds in our favor. But when we do that, take one market. If we're going to trade the 6E and the ES, what do we have to do? See, we have to kind of, in some ways, become a split personality. We're looking at one saying that one's going to run. We're looking at this one saying that one's going to reverse. We have to think differently. And if we're having a tough time trading, we can't afford to sit there and split our mind and say, well, this one does this and this one does that. So if this one goes here, I'm going to do this. And if this one goes here, I'm going to do that. We're better off taking one market that trades the way we like to trade and then look for our setup in that market. Am I a hypocrite because I got 4 instruments up? Probably. I probably do better when I'm just trading one market, but because I work frequently with people, in the room that are trading different markets, I'm willing to look at different markets because of that. But I have traded enough instruments and enough different ways of trading those instruments that I really feel comfortable. I don't care what it is. I will come into any instrument, analyze it for a little while, look at what the tendency is, and then I'm just going to adjust to it. I do tend to come back to certain things because I like the way they move. To begin though, one market, one trading setup. And when you have that setup, sit down in the morning before the market opens, spend a few minutes, decide exactly how you're going to attack it. If you're trading a level, you've got 2 scenarios. You're either going to stop and reverse, you're going to go through it. You've got 2 possible trades. So just wait for it to get there, watch the tape, take your trade. Very simple action plan, but too many people avoid that. Here's what I see frequently happens. Market opens and a guy's looking for a gap trade. Gapped up, YM gapped up 45 points. So they've sat for a little while in Carter's chat room, or they read Carter's book, and they remember that Hubert said something about that being a 70% play. So the gap opens, they decide they're going to try to trade the gap. What happens? It may or may not work. They didn't realize that, yes, that means it fills by the end of the day. So they get in a trade, doesn't work, maybe it works. They sit there bored because it's not doing anything. They start looking for something else. They see something moving. They look at the euro, and the euro's running, like, oh, it's running. Maybe I better jump on that. Do they even remotely have a plan? You have to say no. Are they profitable? Very likely, no, they're not. They don't have a clue what to do, when to do it, and they're just trying to react to whatever happens around them. I would never be cocky enough to say I can move the market or I'm going to tell the market what to do. I have tremendous respect for what the market can do to anybody. But I still would view myself as a proactive trader rather than a reactive trader. Because in advance, I am saying I am going to do this when it comes here, unless I see clear warning that that's a bad idea. I'm not going to sit there and react and say, "Gall, guys, euro's running, get in the euro, quick, chase it." That's how people get messed up. About the time it convinces you to get on board, it's going to reverse and it's going to stop you out. And then it's going to keep right on going the original direction until you're convinced to do it again, and it's going to reverse and stop you out. So when you sit down and you have a clear-cut plan and say, I am only going to do this today. I'm going to put 3 alerts, and I'm going to sit on my hands, and I'm going to wait for the alerts, and then I'm going to take my trade. You may only get 1 or 2 trades today, but the chances are, if you've set your trade in motion correctly, and you've taken a setup that works, and you read the tape, you've got good odds in your favor to take that trade and make it work for you. But I would say for each of you guys, it's the most advantageous thing you can do. Pick one market, one trading setup off of a chart, read the tape coming into it, have a plan when you sit down, set some price alerts, and then just go execute. At that point, if you're doing that every day, review the trades 20 at a time and say, is it working? I've done this 20 days in a row. I'm looking at my journal. I can't point to any flaws in my execution, or the flaws really didn't matter. I saw it. I jumped on it. It didn't work. I saw this one, jumped on it. It did work. And you look at it over the course of 20 trades. Are you net positive? If you are, do it 20 more. Same thing. Do it 20 more. Tom won't be here tomorrow. So I remember we decided that everybody was comfortable with taking the last day putting that out 2 weeks, trying to get some questions and answers once you've had some time to play with this. So I will send everybody an update. Speaking of that, I was going to address it in a minute. Tom, just watch your email because I'll send an update. I only had one person who had an opinion on when it should be. So I'll remind you guys again at the end today. If you've got an opinion or a schedule that says I can't do such and such time, let me know. If you don't care, then don't email me. But so far I only have one person that had some restrictions on their time where they just couldn't make it at a certain time. Sounds good, Tom. Have a nice day. Another suggestion here, and again, this is something that if you're serious about it, you're looking at this is an investment, this is an education. You guys obviously spent some time trying to learn this. You spent some money to try to come in here and learn this. Don't just walk away and start looking for a holy grail. That it's something that I see very frequently where an individual is constantly trying to find something that's always right, and it doesn't exist. If you talk to any successful trader who's ever made it, you will have absolute agreement with that statement. There is nothing that exists that is right all the time. Nothing that exists realistically that we're going to find that's right 90% of the time. We're not good enough to be right 80% of the time. We're frequently not good enough to be right 70% of the time. So if that's the case, if you see the value and you see the logic of this, don't wander off next week and start looking for something that's just going to turn red and green and show you exactly what to do. Spend a little bit of time, do the drills that we talked about. And as you do those drills, focus on it. Take 5 minutes a day for each of those drills, 20 minutes out of your life. If you're waiting for your price level to be reached, do the drills. Stop scanning 43 instruments trying to find something that's moving. Take that 20 minutes, do the drills. Because that's what's going to make it second nature. That's what's going to give you the ability to sit down and just have it click into place and say, yep, it's there, time to go. I would say if you don't, it will never work. You just keep on looking for something. I would say for individuals who are looking for something that is consistent, that works perfectly, there's one thing that we can do. Look at what Goldman Sachs does. Look at what any of these HFTs are doing. With billions of dollars at each firm, what do they come up with? Have they come up with something that always works? The most common strategy they've come up with is try to get the half-cent rebate in the equities. Try to front run alongside fund bought and get the half-cent, because that's the one thing that they can consistently do. So with all the billions of dollars that they've invested, with tens of thousands of quants working at this full-time, they have not been able to come up with a red dot, green dot system that always makes money. If they can't do it, why should we waste our time looking for it? See, really, to me, as a trader, and this is something that I've always tried to help traders do, I want to see you as a trader become a discretionary trader who owns something. You own your setup. And you don't care that it's unconventional, it's not cool, doesn't matter whether it's full tape reading, whether it's indicators. You own your setup, and you come in there as a discretionary trader and you simply trade it every day and take out money. Every mentorship client I've ever worked with, that was my goal. Every student that I ever talked to, that's what I want to see them able to do. Come in as a discretionary trader, think for yourself, and pull money out of this market. We're small enough that we can do it. Goldman can't do what we do. They can't reverse that quickly. They move the market too far. So if that's the case, we need to accept that there's not likely a black box system that's going to do it for us. There's not a set of indicators that's going to do it for us. Take something simple enough that you can repeat it day after day after day after day, and just simply sit in there and repeat it day after day after day. Be like this bond trader. His entire career, over 30 years, same setup every single day of his career. He was tempted to go in the S&P pit when the bonds closed. He didn't do it. Traded the same setup. Was it boring? Yes. But this gentleman pulled out many, many millions of dollars doing this. So that's my pep speech. That's my rally. That's all I have to say to conclude this. Invest the time, do the drills, take your setup, and tweak it as little as you can to make it work, and go in there and be a discretionary trader and take back that money. So I will quit there as far as this part goes. I'm going to go through just a couple courses of a couple slides of things. I apologize. Just upcoming matters. First of all, the final recording of the event. The final recording, my goal is to have that out to everybody by the 16th. And just an update, if you guys are curious about things like this, the recording, when we're done today, is about 65 gig. 65 gig of information here. When I produce that into a video, we're going to be sitting, it's probably going to be sitting right about 8 gig. And I'm going to compress this down, and it should be deliverable to you somewhere around 4 gig. I'm going to deliver this one to everybody a little bit differently. In the files that you get, you're going to be downloading an executable file. And this executable file is going to automatically, when you download it and you click on it, it's going to automatically unpack and decompress everything for you. So you're going to get a file, and this is going to be a WinRAR file. That file, you will have to use WinRAR to make things work with most of my videos. But this one is going to just, when you click it, it's going to automatically unpack. When that happens, this full presentation is indexed, and I've been indexing it as I go through. You will be able to skip back through most of the major points using that table of contents. But I'm going to have a short video that comes with this. It's just going to be a link on your email that will take you to Screencast, and it will show you how to make everything work correctly. Yeah, Brian, Firefox, it should be able to play in Firefox, Explorer, Chrome, Opera, whatever you're using for a browser. The file itself is going to unpack, and it's going to leave you a media folder, and it's going to leave you an HTML link. And if you go into the media folder, the video will play, but you'll have no table of contents. If you have some difficulties with it, sometimes a version of Firefox doesn't want to play. Sometimes a version of Explorer doesn't want to play. Try a different browser. You can right-click the link if you've got Vista or XP. You can right-click that HTML document, and you can say open with Firefox, open with Explorer, open with Chrome. This email is going to come through YouSendIt, Brian. And the file itself, I actually couldn't even email it to you. It will consider it a dangerous file or a virus of some sort. And so I can't even attach the file to an email. It has to come through YouSendIt. And YouSendIt will allow me to post it up online, and then you'll download it. And it's going to be just like any program that you would install. You click on it, and it's going to ask you, do you want to run this? And you say yes, and it's just going to unpack and put your folders all there and your links all there, decompress it for you. Marty, you say the S&P did just what I described as far as a double top at a new high. I see that so frequently on the ES. I love trading the ES because of that. I love just sitting there waiting for it to try to tick above a prior high, 3-4 ticks, just enough get stops that are there, and then fade it. Karen, I appreciate your comment very much. I try not to promise people things that I don't think they're going to be able to achieve. Karen's comment, I'm going to just read it. It says, "Those are some of the most powerful words I have heard in any training session. In every other one I took, they told you that you would be rich doing what they sold you." I I have been bothered by that for as long as I've looked at education, as long as I tried to find somebody to teach me things. It's not that easy. It's not that likely that people are going to make it. And to buy something and then have somebody say it's easy, you're going to be rich next month at this time, it's not likely. I mean, it takes work, and we have to go in there and gut it out and become a trader. We can't go up against the best in the world and just think we're going to pick their pocket day after day after day. You know, if we're not willing to do the time and do the drills and own our setup, it's never going to happen. So I've always been bothered by that when companies come in and say you're going to get rich doing this. A couple of you that are sitting here right now know I tried to talk you out of even trading or even coming in here. As it just, I look at it and say you've got a lot stacked against you. It doesn't mean you can't do it, but you have to be realistic and say, your head is in the guillotine, and you got to recognize that. It's true, Karen. When you come in under those kind of circumstances, like Karen says, you lose money, and then you feel like you're the only person who has that problem. You think I'm the only idiot. I can't figure this out, and it does destroy you emotionally. So that's why you guys, any of you that have worked with me, I've always tried to present this in such a way to tell you, develop yourself as a trader. Know yourself as a trader. Know what you're capable of. Know where your weak spots are. When you get to that point, you're going to be successful. You're not even going to be thinking about it. You get to that point that you just say, you know what, there is no easy way. It's tough, but I'm going to do this. This is simple enough that I can do this much, and I'm going to practice it, and I'm going to be the best in the world at this right here. Appreciate that, Ken. Thanks for the comments. Let's see. So the final recording, I think we've addressed that. You should have that by Tuesday. Now we're going to meet in 2 weeks. That meeting is going to be designed. I'm not going to have an agenda. That is for you guys to ask questions. So if you have questions in the meantime, write them down. You can email them to me if you want. But that meeting, I'm not going to come in here to talk through anything in specific. This is for you guys, the final session. This is for you guys that attended this live to tell me this is where I've been having some trouble. This is where I'm running into it. You guys just, keep jotting notes down. You can email it to me in advance, or you can throw it out there live. Either way, this entire presentation, if you guys want to know, and I don't want to sound flippant about the way I view it, but I have not had a single word of notes. In fact, I wouldn't even have the slides there, except I've got to put something up for you guys to look at while you're sitting there bored. So I don't mind questions on the fly. So whichever feels more comfortable for you guys. Thanks, Brian. I appreciate that. Final session. Again, you guys, if you have conflicts in your schedule where you're only able to do certain times of day, please let me know. What I was thinking about doing was coming in, trading at the open for an hour at the 9:30 Eastern Open, trading at the open for an hour, and then taking about 2 hours, and I should say up to 2 hours, whatever we need, but take about 2 hours for any questions. If we get through in half an hour, great. That means I did my job and you guys are doing your job. If it takes us 4 hours, we'll spend 4 hours. Does that seem reasonable? So if you guys, I've only got one person that has a restriction on their schedule. So anybody else, let me know, and then I'll send an email out, let you know that final presentation. In addition to what you have here, I am going to be sending you guys some additional trades. You'll be able to go back and review through those trades. The advantage that we have from those recorded trades is you can go back and watch it over and over and over. And if I comment on it in real time, it's here and gone. And it may be tough to pick up. Let's see, Ken, your question, just mechanics on the presentation. Ken asks, how do you change drawing tools and colors so fast? That is memorizing the hotkeys. On Camtasia, changing the colors, I can go R, G, B, Y, W for white. I can change colors real quickly just by hitting the key. And then the drawing tools, I don't have to go to a pull down menu. I hit A for arrow, P for pin, L for line, E for ellipse, and F for frame if I want to draw a square. So it's just from memorizing the hotkeys. That's how I change the drawing tools and the colors. No, that's not off of Ninja. Well, actually on Ninja I'm doing the same thing. When I'm drawing on my charts, let me find a chart here. I'm still sitting here in no man's land. I take the ones that I primarily use. I know that F3 will give me an extended ray. If I want to come in like my horizontal line, F6, I just hit F6 and draw it. F7 gives me a vertical line. F8 is going to give me my Fibonacci. That's basically what I'm doing. Okay, so anyways, Ken, when you're talking about changing the colors on Ninja, if I have to come in and change the colors, I have to double click the item. When I double click the item that I'm trying to change, then I can come in and change the color on it. But the quick color changes, that would be using, and this is probably what you're talking about, is this cursor here. And I can come in and draw in green. If I hit R, I go red, B for blue, come in and draw white, yellow. So that will allow me to change colors very quickly just by hitting one key. And then I can come in and hit A, draw an arrow. Like I was mentioning, I can draw an ellipse or I can draw a frame, whatever I need to do there. If I want to change the size, I can hit the numeral 8, and that makes a big fat one. I can hit 1, makes a little skinny one inside of that, and so forth. That is all done off of Camtasia. That's not part of Ninja. I wish Ninja was that easy, but that is off of Camtasia. The hotkeys, if you come up into your drawing tools, you'll see the list of all your hotkeys, for any of the drawing tools that you could use on Ninja. And I use some of them frequently enough that I just memorize those. Get rid of all this junk. I'm still in my trade, still not going anywhere, but it didn't stop me out. So I guess, what do you do? I still have 18 left, and I'm hoping that we can get some, kicked out and break down at some point over the next couple days. Let's see, a couple other questions here. Gerardo, what do you think of a trader keeping and commenting his trades? I think that is a pivotal thing for success. My personal experience, I have always, I don't want to sound cocky by saying this, but I've always thought, I can think pretty fast on my feet. And I felt I don't need to do that because I've got a good memory. I've always told people I'm not smart, I have a good memory. So I always felt I don't really need to do that, and I could not break through until I started doing that. But my own personal experience with that was that if I printed the chart out and wrote on it with a pencil, it made more of an impression than just looking at the chart or taking the chart and just drawing on it with a drawing tool. If I printed that out and I forced myself to stop, I had to think to go back and find where the entry was. And I had to circle that entry, and I had to write down why I entered there. And it takes a few minutes to do that. When I was trading 2-3 trades a day, it wasn't that big of a deal. When I got up and was trading 40 or 50 trades a day, I was like, there's no possible way. I have always felt there's some definite value in coming in there and drawing on it with a pen, with a pencil, put it in a 3-ring binder. You review that. Sit down in the morning. If you've got a demon or a problem that you just can't beat, come back in there and look at that 3-ring binder every morning and say, what is the consistent problem? Is it leaving money on the table? If that's the case, this is what I'm working on today. Is it getting in too early? Is it staying in too late? You know, you start identifying those problems and then look at it first thing in the morning and review that as to what you're going to work on today. We don't want to do it in a negative sense, like I always do this, but I do think it's good to go back and look at that and say, okay, here's my goal. Today, uh, I'm going to work on this problem. Not once today am I going to bail out of a trade with 2 ticks when I was going for 3 points. And doing that, it makes a lot of progress. Let's see, some other questions. Ken, I don't know if I addressed your second one. How do you get the drawing function to show along with the tool? That is out of Camtasia. I'm assuming that's what you're talking about there. That is part of Camtasia's drawing tool. Let's see, Brian, quick question on Ninja. How do you place one item on top of another, like an MA going over the candle instead of under? Let's put a, just for simplicity, you can grab this. This is version 7. Actually, let me undo that. I'm going to do this slow so that you guys can see it display through on your end. I'm going to grab this RSI and I'm going to start to drag it up, and you're going to see the dots, the black dots on the RSI, and then you can see my cursor as it comes up. Looks like a little piece of paper with a chart drawn on it. And when I let go, that puts my RSI up on top of my chart. And then I've got my scale for the RSI down the left side. I've got my price scale for the instrument down the right side. But let's say that this RSI, that I've got a really, let's see where it's at. This RSI, I've got a really chunky line here, like 10 ticks wide, and it's, well, I'll just leave it that color. And all of a sudden you can't see your price candles. You can click one time, just left click, and you can make the indicator active, or you can left click the price and make the price active, and then you hold down shift and use your scroll wheel. Now I'm holding down shift, and when I scroll, you're going to see by my cursor it says level 10 of 11. That means I've got 11 things on this chart. It would be line drawings, indicators, price, whatever I have. And if I scroll this to where it says level 11 of 11, that's putting the price, because my price is active right now. Price is at the very back of everything. And if I scroll the other way, I can bring that all the way up to 1 of 11. Do you see the change there? Now the price is on top of the indicator. So it's just you hold down shift and then you scroll. Now you can do the same thing. If I get rid of the indicator, you could do the same thing. Let's say that my trend lines, let's say that my trend lines again are real heavy chunky lines, but I don't like the way it looks where price is underneath that. I can just left click that, hold down shift, and I can scroll that back to the back and put that trend line behind the price, or I can click the price, hold down shift, and I can scroll on it to bring it up to number 1. So that's how that's done. It's just using the shift and your scroll. You take whatever you want to move around, make it active, you know, left click it once to make that active, get your black dots on it, and then hold down shift and scroll. Very handy feature, you know, if you like to get something to the front or the back, and that's how you yank those around. Other questions here. Ken, that cracks me up. Ken says he was looking all over Ninja to try to figure out how I was changing colors with my drawing tools. So sorry for all the confusion. It's probably been 2 weeks of hell for you then, going through that, trying to figure it out. Karen asks, do I find that the NQ and the YM mimic the ES? To a large degree, they do. And the primary difference is we've got to adjust, we have to adjust the way we view the number of ticks just a little bit. The reason for that, S&P is thick, doesn't trade as many points across the day. You know, if we see the S&P has moved 10 points during the course of the day, the Dow's moved 100. So if we come in on the ES and say at 3 to 4 ticks above a high or a swing high, we should see stops and be done with whatever stops are there, or we get the acceleration because there's more stops. At the same time, we would say 3 to 4 ticks on the YM may not be enough. We may need 7 or 8 or 9. Same thing goes for the NQ. We may need 7, 8, 9, 10 ticks through it before that's enough to say, okay, here come the sellers. They feel they've got all the stops there. Now the sellers are coming back after it. We go to something like crude. We may need 15 to 20 before we get the same kind of reaction. So again, instrument by instrument, we'll make that determination. But yeah, as far as the actual being like a fading type market, to me, the indices definitely are fading markets. They will. It's not that they can't have breakout and run days where they just go all day long, and those are the days. I think I mentioned it earlier in the sessions. We have a 200-point move on the Dow, and I inevitably will get 2 or 3 emails from buddies that don't trade, and they'll say, "Man, you must have killed it today. I saw on the news the Dow's up 200 points. What happened?" And I'm sitting there going, "I didn't take any trades today. I came up there, I was getting ready to fade it. Here's my setup, I'm ready to fade it, and there's no sellers, and I don't buy new highs. So I just sat there and watched all day, and I didn't take a single trade. The days that it's like, market moved 4 points, and they're just like, oh yeah, I bet he didn't even trade today. Those are the days I'm tearing it up, printing money. Well, I don't see any other questions here. I do appreciate all of the comments from everyone. And if you haven't had an opportunity to do it yet, I would still welcome you guys. Shoot me an email. Let me know what you thought. Let me know if there's areas where you would like to see some improvement. Anything of that sort. Sean, no, we've gone through this a couple times. We're not meeting tomorrow. The next session, I will be sending you guys an email with a date and time. I would like some feedback from you guys as to restrictions on your schedule that would prevent you from doing a certain time of day. But if we can put that 2 weeks ahead, most guys can make allowance. By the way, that final session, whatever we do for the final question session, I will make one final recording for that session and then send that back out to everybody. But in the meantime, I'll get you the finished product up to that last session. Well, guys, I sure appreciate this. I've enjoyed working with you over the last 2 weeks. I have, in some ways, I feel made some new friends. I'm going to go cruising at some point with Kevin in his Sim Maserati. I'm going to go hang out with Mary somewhere at some point. And, if I ever get down into Central America, or I get over to Thailand, I know that I've met new people, friends in Canada, people that I could talk to. And I really appreciate that about what we're doing together here. But I also, I am interested in your ongoing success. If you find you're having some problems with it, don't hesitate to send me an email. I try to answer that as I have time, and I don't like watching TV, so if I've got emails to answer, it gives me something to do. So don't hesitate if you run into some issues. If I can help you with it quickly, or I've got something there that would be of value, I'll share it. I don't mind doing that. Yeah, I got to get down there. I've got a definite advantage with Karen and Brian. Where they're at is you can actually get green chili. It drives me crazy out here in Oregon. The Mexican restaurants, you guys would get disgusted out here. I think they have. You go into Mexican restaurant. Every one we've been in here, and everything is smothered with a sauce that's made from blended carrots with lemon juice in it. And I don't know what region of Mexico they were from around here, but we've been in probably 8 or 9 Mexican restaurants, and every single one of them, that's what the sauce is. You'll see chunks of mashed carrot in there, and it's like the carrots are for Gerber baby food. That's it. There's no other reason for carrots to exist, and you definitely don't boil it and mash it and put it on top of a burrito. So I know what you're saying with the chilies, man. I really miss that. We buy them out here. You can still buy them some places, but they're not. You don't get the good Hatch chilies or the Pueblo chilies that we would get there in Colorado. So. Yeah, it's been a brutal experience. I walk in there and there's a carrot sitting on my burrito and a chunk of lemon, and I'm like, what in the world is going on? So, well, sounds good, guys. I really appreciate all the comments, and we'll look forward to being back together here in a couple of weeks, and any additional questions we'll address and go through.